Hey everybody, thanks for coming. My name is Gibby. We'll be kicking off day 6 of the Traders Conference. It's so good to see you. Thank you for being here. Thank you for being part of the event. Let's go ahead and kind of kick it off. What I'm going to do first is I'm going to read this legal disclaimer. Oh,
I'm sorry for interrupting. Now you're coming in a little bit soft. I don't know if you moved too far from your mic, or I don't know.
Maybe I'm too comfortable here at my house.
Yeah.
Is that better?
A little better, yeah.
All right. Let's go ahead and read the legal disclaimer. We want to make sure that's nice and clear. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in this presentation should be construed as investment advice or the solicitation to buy a security. So, as we get started today, I want to give you a big warm welcome. Thanks for coming. If you're watching this and you like the session today, and you're watching this on YouTube, hit like and subscribe. It helps a great deal. We appreciate it. If you have questions, if you just want to say hi, let us know in the chat that you're here. And we'd love to see kind of those comments. We're very good at answering them. So I think that's what I wanted to say. If you're watching on GoToWebinar, there's a questions button that you can click on and you can submit questions. That's how you kind of interact with us today. In YouTube, you know where the chat is. I will say in the YouTube chat, at the top of the chat, there will be soon a pinned comment. And if you've not registered for the sessions this week, you should. Because all day long between every speaker today, we're going to be giving away valuable prizes. And in order to be eligible for the valuable prizes, you'll want to be there. I want to say thank you for a couple of the sponsors that have been a lot of help for us in terms of pulling off this event and making it possible. The first one is the CMT Association. We've talked a lot about the CMT Association. We actually have CMT Association coming in to kind of talk a lot about technical analysis and the designations that they have today, how they can be helpful for you, that kind of stuff. You can find out more about the CMT Association if you go to cmtassociation.org. Want to thank Stocks and Commodities magazine, always a sponsor of our events. They've sponsored every single one of them. Great magazine, 17,000 articles, 1.3 million subscribers. 1982 is when they started publishing. So www.traders.com, our thanks. If you haven't yet, join the Traders Forum, www.thetradersforum.com. There you can chat with other traders, you can learn about the markets, it's a community of traders helping other traders. We are, of course, MetaStock. We've talked about MetaStock all week. Hey, I'm curious. Actually, if today's the first time you've come to this session, let me know in the chats. I'm going to be looking for the answers. Okay, I think I know what the difference is for why I sound low, and I'll fix it in just a second. Okay. If you want to sign up for any of the offers today, you go to metastock.com/conf-promo, metastock.com/saleschat, 800-882-3040. So, without further ado, I understand my mic is a little bit soft. I made a change, so I'm going to make that change back and it'll be fine. But Zaheer is our first speaker today. I love Zaheer's kind of chart markup, the way he looks at charts, the way he kind of has everything pulled together. Very well organized. I also like the way he talks about it. So, without further ado, let's go ahead and get Zaheer started. Zaheer, how are you doing today?
Hey, Jeff. Yeah, I'm good, thank you. Yourself?
Good. I guess I sound soft.
You sound very low to me, so I don't know whether you need to just do a little reset on your mic there.
Yeah, it's okay. Let's go ahead and get you started.
Yeah, sure. I'll take over in the meantime.
Yeah. Okay. It's all you, Zaheer. I'm going to get out of the way and fix my mic.
All right, brilliant. Right, hi guys. Hope you're well. Once again, thank you to MetaStock for this wonderful opportunity, as always. Always putting wonderful events together, and I'm sure you guys have had an extremely a value-packed week. So I hope to add to that and possibly give you a slightly different view and approach to the market. So we're going to be covering the add-on that we have created here for MetaStock, which is called the MET, or the Market Edge technology, and how we use it as a strategic 3-step blueprint to navigate this sort of period that we've gone through with tariffs and make smart investment decisions, not just through tariffs, but ultimately as a repeatable system for the next 5, 10, 15, 20 years. Because guys, remember, it's tariffs today, next month is going to be something else. So there's always something going on in the media. What we need is a system that allows us to navigate through what the media is telling you, focus on what the chart and the market is actually doing, and make smart investment decisions that way. So you're about to learn a predictable and systematic way to identify the very best stocks and assets, because what I am showing you today can also be applied to commodities. For example, gold. I've been long on gold since March of last year. Currency pairs as well, if you do look at forex. So it can be applied across the board. When to enter the market for optimal returns for both a bull and bear market, blocking out all the social media noise. So again, something that people are constantly in fear of, which is, are we entering a bear market? Are we going to have a repeat of 2008 and 2000? And if that happens, what do we do? Well, you've got to be able to pivot and go from bullish to bearish to then taking long positions to taking shorting positions. So you've got to be able to manage your portfolio and position yourself accordingly. Because be aware of one thing, guys, a bear market is nothing to be fearful of. With the broker accounts that we have today, we can short the market. So it's just a way of identifying how the market and when the market has changed, and then taking the right decisions. And then ultimately how to hold, compound, and exit for maximum gains, outperforming all other strategies and money managers. And most importantly, how to adapt this process around your lifestyle so you can continue to enjoy life while your money grows in the background. I'm assuming everyone on here is busy, careers, jobs, businesses, married, kids, social life, all of that good stuff going on. What we want are smart processes that allow us to ultimately get on with our lives and do all the things that we need to do. But our money is working for us and growing. Our hard-earned money, I should add, is working and growing away for us in the background, and just requires a few minutes each week to manage. That's the kind of ideal system that we want. So today I'm going to cover how to use the Market Edge technology add-on, what we call the MET, and a trend following investment strategy in 2025 to significantly improve your portfolio performance to 30% a year every year. So we want this year to really be your breakout year, create a foundation, and really to go from there. Now, a little warning, guys. For me, this is where you start learning best practices. So the things that you're going to learn today, ultimately you can't unlearn. So there comes a point in life where you start understanding new approaches, and then you've got a choice to make, which is whether you're going to stick to doing what you're doing, which, if we look at the facts, 95% of people tend to fail or underperform. So there's a lot of room for improvement. And then the 5%, we need to look at them and see what they're doing and start adopting those processes. So this is really where you are at those crossroads, because the information that I share with you really is part of that 5% smart money approach. It is the simplest, most effective, and most profitable way to invest and compound in stocks and assets, period. And off the back of all of this sort of work and the systems that we have created, in 2023, I had my hedge fund incorporated in Luxembourg. Our track record goes all the way back to 2016, and that came in at over 30% a year. So almost a decade of over 30% a year on average. And that's what got our hedge fund incorporated in Luxembourg, called the Reversi Fund. Just a heads up on that as well, guys. It's not back tested, it's not theory. These are actual proven results. So what you're getting access to here, what you're learning to here, is an actual system that works. It's got a track record, and it's what we use to manage our fund. And also my personal finances, going all the way back to 2012. So just a little bit about my background. I have a degree in software engineering, which is where all my love for technology and MetaStock, when I came across MetaStock and how it could really help elevate my investing and trading, it just made a lot of sense to me. I worked for Oracle as an engineer. I didn't really enjoy it, guys, to be honest with you, working in a 9-to-5 sort of environment and I quit and I became a TEFL teacher, which is teaching English as a foreign language. I lived in Taiwan and Japan and the Philippines teaching English. And again, that's really where I transitioned from teaching English into mentoring people. So instead of English, it's mentoring people in their investment portfolio. So I really just took that love for teaching into what I do today. The money really started coming in for me when I got into advertising photography. We had really big clients: Coca-Cola, Harper's Bazaar, Tatler, Vogue, Barcelona Football Club. So the money really started coming through. And when I started having this money coming through, that's when I started learning to put it to good use. Like everyone else, I started day trading, realized the pitfalls of day trading, and quickly pivoted into sort of a trend following approach. Started trend following in 2007 because it just made a lot of sense to me. And the quicker you guys move towards a proven long-term approach, the better your results will be. What people tend to underestimate is the power of compound growth, which is what I'm going to cover today. Co-founded Sublime Trading in 2018, and then, as already mentioned, co-founded the Revesy Fund in 2023. So I've been on quite a journey, about 15 years personally, to get to where I am today. But one thing to take away from that, guys, is I've never worked in the city, never worked in a hedge fund or a bank or an institution. My degree is software engineering, is not economics or finance. So I should hopefully have a very relatable background to what you guys do. The only difference is that I really gravitated towards that sort of trend following approach because it just made a lot of sense to me. So this is where I am today. I'm in a blessed position to be able to speak and contribute to all of these wonderful publications. Have had a lovely relationship now with MetaStock for quite a while, and I've been blessed to be able to get this message across to a much wider audience. And my goal was to put trend following back in the limelight, as it became a forgotten art form with lesser strategies taking center stage. As I've already mentioned, short-term strategies tend to be everywhere. The success rate of these strategies is very questionable. Then there's also value investing with Warren Buffett pretty much all over our screens. Before it was Warren Buffett hoarding cash, now it's Warren Buffett retiring. We just can't get away from Warren Buffett. Yet, if you look at his strategy, is it the right strategy for the everyday individual? And you have to question that, because if you execute a Warren Buffett value investing strategy compared to a trend following strategy, you would do significantly better with trend following than value investing. So we have to question, why are we bombarded with information that we are? What are they hiding? That is one of the questions that I always like to ask. My goal was to help others have the same sort of confidence to find, invest, and compound stocks and assets. Guys, if you haven't already, do check out our Trustpilot. We've got some excellent reviews on there from some of our members, and these are genuine reviews of members that we've had for a very, very long time. So we have done this sharing the results that we've achieved and the Trustpilot that we have achieved. We've done this sharing stocks like, sorry, we'll come into that in a second. Let me just cover this slide for a second. A portfolio performance from 2023 until today. Now, reason why 2023 is because 2022 we had that big correction in the market. The S&P fell by 28%. At the beginning of 2023, we started buying back into the stock market. We have a copy service at Sublime Trading, which is based on a $20,000 starting amount. The reason why it's $20,000 is because that's typically what a lot of our community members start with. A lot of them have a lot more cash, but 20,000 is a good starting amount. February 2023 is when we started building our portfolio. Today, May 25, 2 years and a bit longer, we've got a running P&L of over 27,000, coming up to $28,000. So based on a 20K account, we've got a running P&L of around 140% profit. So think about everything that we've been through, all the talk of failing banks, the tariff wars, Ukraine war, everything going on in the Middle East. There's always something going on in the world. Yet our portfolio has nicely compounded away and is running at roughly 140% ROI. Now, the other point to note, guys, is that we've only taken 99 positions in that time. 99 positions. A lot of day traders will do that in a single day. We've taken 99 positions in total. So you can see how our process focuses on quality rather than quantity. So I want to break this down for you just a little bit more. The 99 positions, out of those 99 positions, 53% of them are winners, and these positions are still open because we abide by the philosophy of let your winners run. 19 are break even. So haven't made us money, haven't lost us money. 27% were losing positions. Typically, we don't risk more than 1% per position. So you can see how we have a very a good mix of winners, losers, and break-evens. But by keeping the winners open, letting them run and compound, we have achieved that 140% return. So a point to note here, guys, do not focus on winners versus losers. Something that people tend to ask me a lot is what is my win rate? If I told them I have a 53% win rate over the last 2 years, they wouldn't be too impressed. But I've got 140% running P&L from the 53% winners. So that is how true investors think. They don't think in terms of winning and losing. That's a gambler's mindset. You want to think in terms of profit versus loss. This is the breakdown. 83% in US stocks because it is the largest, most mature market, and it has phenomenal opportunities every year. 9% in UK stocks. I'm here in the UK. I keep an eye out on the UK market. It doesn't have the kind of opportunities as US stocks, but when it does trend, it performs very, very well. And of course, gold has been performing exceptionally well since March of last year, and we have positions running in gold. Now, out of those positions, the 53 positions that we have open, this is the breakdown. We've got 19 individual US stocks, 1 UK stock, and 1 commodity, which is gold. So we've got 21 individual positions, but we've got multiple positions running on each of those positions. This is what is known as compounding, which is where you let winners run and then you buy more of a winning asset. So again, a real sort of understand what I'm trying to get across to you guys here is focus on quality, not quantity, and then let those winning positions run. And then don't just pat yourself on the back and say, hey, I've got a winning stock. Do what elite investors do, which is when an asset is winning and returning you profit, strategically buy more. Now, how do you do that? That's where the MET comes in, and I'll break that down. I'll process in more detail. Now, also look at the sector diversification. You go online, all you ever seem to hear about is IT and tech because of Nvidia and Palantir and Microsoft. You don't hear much about the other sectors. And that, again, you have to question why, because the art to good investing is looking at the strongest sectors and then finding the strongest stocks in the strongest sectors. And then what that will help you do is really have a robust portfolio that performs well even during correction. So we've had this 20% decline, for example, because of the tariff talk. Of course, it's nicely recovering since, but a lot of stocks held very well. If you looked at sectors, healthcare, for example, performed very, very well. Some of the financial stocks like Berkshire Hathaway performed very, very well. So again, you have to question, how come Berkshire Hathaway held very well and is now setting record highs, yet everyone is focusing on Warren Buffett's hoarding cash and waiting for a market correction because he deems valuations too high? It made absolutely no sense to me. You'd make more money focusing on Warren Buffett's stock than actually Warren Buffett himself. So sector diversification is essential because during these periods of corrections, you cut out of the weaker stocks. Some of the tech stocks decline significantly. You cut out of those, but you hold on to the stocks that are performing well. When the market comes back in, the recovery comes back in, those stocks start leading the recovery, and then you start compounding further. So a very simple approach when you understand how to put a portfolio together, and that way you're then protected from all the sort of noise and misinformation that's spread all over our media channels. Now we've done this, sorry, that slide should have come in here. We've done this investing in stocks like Amphenol. Now going back to 2022, Amphenol has climbed 162%. How many of you guys are familiar with Amphenol? If you're not based in the US like me, a lot of these stocks only come to light because the scanner, again, MetaStock, has picked them up for us. And then I look at these stocks and I think, wow, why isn't anyone talking about these stocks? Amphenol is actually setting record highs as we speak. The indices are still 15, 16% off their all-time high, whereas Amphenol is already setting record highs. It's one of those leading stocks. It's climbed 162% since 2022. Berkshire Hathaway has climbed almost 100% since 2022, and as already mentioned, is one of those that's setting record highs or trading near its record highs. CBOE Global Markets, that's up 124% since 2022. Cencora, now this is a healthcare stock. Again, a stock I wasn't familiar with, but it's a stock that's doing phenomenal things in the US in the healthcare sector. It's up 120%. It's actually little sister to its big sister, which is McKesson Corporation. I think it's the biggest healthcare company, or at least the biggest stock in the healthcare sector. It's up 200% and setting record highs since 2022. Netflix up 600% since 2022. Then, of course, Nvidia is up 1,200%. Now, the reason why I'm sharing Nvidia is because Nvidia is fascinating to me. The amount of finfluencers and analysts online calling the end of Nvidia when DeepSeek first came out, and they were saying it's the end of Nvidia, it's the end of AI as we know it. But if you look at it objectively, all Nvidia is doing is consolidating. It climbed 1,200% from the low of 22 to June 24 last year, climbed 1,200%, went through a 10-to-1 stock split, and then it's consolidating, and it's using that $100 round number, which is the blue line, as a base, and it hasn't actually had a monthly close below the $100 level. And since last month, it's actually recovered by about 20-25%. All Nvidia is doing is it's creating a base. There's an expression which is after every big move, the market consolidates, and that's what Nvidia is doing, and it has a history of this. Big move, consolidation, big move, consolidation. It's done it 3 times since 2016. So what Nvidia is doing is just what's normal to Nvidia, which is it's now consolidating. So for us as investors, what we have to be able to do is look at the charts and make an informed, objective decision, because if you focus on what's happening in the media, it's a complete misrepresentation of what is actually happening. So Nvidia, I'm sharing it because it's a massive stock. I've been holding it since the beginning of 2023. I've held it through this consolidation, and I'm now waiting for the next move up so I can start compounding. And remember, with that 10-to-1 stock split, it has the potential to go back up to $1,000, which is where the 10-to-1 stock split happened last year. Sprouts Farmers Market, I mean, this is up 330% since 2022. Who's talking about this? Absolutely no one. And it's above last year's high, and it's one of those stocks that's battling and aiming towards its current all-time high. So we've achieved this using the MET. This is the add-on that I'm going to cover today, the market edge technology. Now, I just want to share some of the testimonials and some of the words of our community members that we've had over the years. So since last year, and careful position taking in my account is in near 100% profit. So you can see in line with the results that I showed you earlier, near 100% profit. I've been with Zaheer and Collar and Sublime Trading since around 2020. I've seen 110% return over the last 3 years. Last year, the S&P did 25%, I did 40%, so pretty happy with that. Compounded annual return since I started using the strategy in 2023 is around 30%, which is in line with our hedge fund, which I said is averaging over 30% a year. Now, some of the early adopters of our MET add-on, the Explorer is worth the cost alone. Job well done. So the Explorers that we have created so that those stocks that I have just shared with you can be found by you guys is worth the money alone. So you can see one of the biggest challenges that people have is stock picking. How do you pick the right stocks? If you go online, you're just going to pick the same stocks, which is always big tech. No one sort of ventures beyond big tech, but there's 11,000 US stocks. You've got commodities and currencies. You've got 6,000 UK stocks. Wherever you are in the world, you'll have your stock market. So there's a plethora of stocks out there. We want to be able to find the very best. Our Explorers will help you do that. Just subscribed and like what I've found so far, more polished than my own system. So you can see people are trying to do things, but there's always something missing. Our system will fill in those gaps for you. I've just subscribed to the MetaStock add-on. The visual representations of the different time frames are fantastic. I love the clean and impactful display of all the time frames and how easy it is to stay in alignment. So guys, what people want is to be able to understand, right, what is happening in the market so I can stay aligned with the market and not get confused and distracted by what is happening in our media channels. We'll help you do that with this add-on. Now, let's look at some numbers. Something that you'll hear a lot of old school people tell you and finfluencers tell you is you don't need anything more than a tracker fund. Just put your money in an S&P tracker fund and that's it. And that's all you need to do for the next 20 years. Dollar cost averaging, yada, yada, yada. Guys, we've moved on. We've evolved. We're better. We're smarter. We have access to technology like MetaStock that does wonderful things. Why would you want to just stick your money in a tracker fund? Let's look at the numbers. let's say you start with a tracker fund, you have 20K, or you look at stocks like we do. Either way, you start with 20K. You have an investment horizon of 20 years. You put $100 a month additional into the pot. With a tracker fund, let's be generous. Let's say you get 11% a year. With us, as already mentioned, you get over 30% a year. So let's put that as 30%. If you put it in a tracker fund, you're going to have around $250,000. Guys, think about this for a second. Think of a number in your head. What do you think would be right there in that bottom right corner at 30% a year? Often people are well off the mark. It's around $4.5 million because of that compound growth effect. So it's well worth the time and effort learning to do this. Okay, now when you're dealing with those numbers, what can we expect? Well, first of all, the confidence that comes with this, because no one's doing this at all. Everyone's underperforming. Everyone's jumping from one day trading strategy to another. No one has a simple and repeatable system that's getting them a consistent 30% a year on average every year. So confidence with this is second to none. Money's under your control. It's not locked away in some scheme and drip fed to you with taxes on top of that. Your retirement is in your own hands. Everyone has one eye on retirement. Are you on track for the wealth that you want at retirement? Most people aren't. You will be with a system like this. You can start your own business, which may have been forgotten because you've ended up on a career path which isn't one that was really chosen. One you chose is one that was dictated to you. So often you may want to start your own business. When you have that kind of wealth, absolutely you can start your own business. You can choose the contracts that you want to work. I inherently believe everyone deep down inside is good, despite all the war and the hatred that we see on our media channels. People with more money will be more generous and the world will be a happier place. Of course, why not? We want the finer things in life. I like my bespoke suits, as some of the people around me know. Why not? When you got that kind of wealth and you've deserved that kind of wealth, you can do what you want with that kind of money. You may want to upgrade your premises. Now, here's the most important thing, guys. Financial illiteracy is what the system keeps us in. Through the schooling system, we are basically taught to work, build careers, pay taxes, which is great. That's what the schooling system is for. But what it doesn't teach us is how to manage our money. It doesn't matter what career you end up in as a doctor, engineer, an artist, an athlete. We all end up with the same issue, which is what do I do with my money once I start earning it? We're not taught to manage and invest and be savvy. Someone has to break that. So with a system like this, you will break that financial illiteracy loop. You will learn a set of skills. You will get your money growing for you, and then you can train your kids and your loved ones to do the same, pass that on to them and get them to do the same. So ultimately breaking that financial illiteracy loop forever and making generational wealth more than a buzzword. So this has to start with you. Okay, so let's get into the 3-step blueprint for consistent returns in 2025. How can we navigate through all of what's going on? First and foremost, guys, use the S&P 500 to establish market conditions. I don't invest in the S&P because I like to invest in stocks doing better than the S&P. We're going to look at that in a second. But because it's an average, it's very good for understanding what the market is doing. So let's switch to MetaStock. So this is what MetaStock looks like for me when I first open it. These are some of the add-ons and the tools that we have developed that you will get access to. Break it down for you. Monthly in the top left, weekly in the top right, and the daily chart across the bottom. And then we have another daily chart down here in the bottom right. Now, what I'm looking for is multi-time frame alignment. I want the monthly, the weekly, and the daily time frames to be moving in the same direction. When I have that alignment, then particularly on the S&P 500, then I know the market is bullish. How do we do that? Well, let's start with the monthly time frame. Now we have a set of indicators on the monthly time frame, particularly this green line here. This is the high of last year. This red line, this is the low of last year. We've got a number of key levels of support and resistance. If I just compress it to bring in a little bit more information, you can see all the major levels of support and resistance are highlighted on the screen for you. They're detected and updated automatically, so you don't have to waste your time manually drawing these lines on the chart. Also notice, guys, the correction, the tariff correction, which is from April. Look at where it came to. Bang on, hit our support level, which goes back to this pivot level of 2022. Bang on, touched it, reversed, and we're now seeing the correction come in. So you can see the importance of understanding market structure, making sure you have the right support and resistance levels on the chart. That way you can see potential levels where the decline will come to and where the recovery may come in. Now, when all our indicators align, the ribbon at the bottom will tell you that it is in fact in a bullish phase. So you can see that it disconnected when the correction came in. Now that the market is recovering, at such point, all the indicators are aligned and there is full transparency and explanation of what these indicators are in the manual that comes with this. This isn't a black box system. It's a fully transparent system that you'll get to grips with. When the indicators align, you'll have a bullish ribbon here saying that the market is now bullish. If we go to the weekly time frame, same setup as well. You'll notice that there's a ribbon here at the bottom telling us bullish. That again disappeared during the correction. It found support. The market is recovering. We've got a trend filter on here. You'll notice that the bars are green. Look at the period of green. The green was from November 23 all the way through to February 25. That's how long the bull trend was in play. The correction came in because of tariffs. The ribbon disappeared, but now that the recovery is coming in, when the indicators on the weekly time frame align, the ribbon will turn bullish, telling us that the weekly and the monthly are aligned. The moving averages on here, by the way, 200 moving average and the 50 simple moving average. Look at this correction, guys. Never broke below the 200 moving average. The last time the S&P 500 broke below the 200 moving average was all the way back in 2008 during the global financial crisis. Since then, the S&P 500 has remained above the 200 weekly simple moving average. A very good indicator that the market never turned bearish. We were never in a crash, as was sort of splashed all over our media channels. You have to have a system that protects you from that, because it's all wrong and it's all very misleading. Once the weekly time frame aligns, we will have the bullet in terms of all the indicators on here. We'll get that bullish ribbon back again, and that will tell us that the weekly and the monthly are aligned. Same on the daily time frame. The way to look at this, guys, is that the daily time frame is little sister, the weekly time frame is big sister. Whatever big sister is doing, little sister must be following. So it was bullish. We had all of these bullish ribbons. Then the tariffs correction came in. The ribbons changed from bullish to bearish. Now, what is this telling us? That the short-term trend is bearish, because the long-term trend, if we go back to the weekly time frame, the long-term trend on the weekly time frame never turned bearish. It went into when there's no ribbon here, it's basically a sideways market. So again, you can see by using my indicators and my tools and the way that the MET has been programmed, I know by looking at the market whether we're in a crash, and not because some guy on the internet has told us that we're in a crash because they're trying to get clicks on their news article, because that's ultimately how they make their money. What we want is a system that actually aligns with the market and tells us whether the S&P 500 and the indices are bullish and bearish, and if they are, okay, what do we do? What do we do next? So looking at the daily time frame, guys, we can see that the bearish ribbon has disappeared because of the recovery. It's now in a sort of middle phase between switching from bearish back to bullish. When it crosses over the 200 simple moving average, the trend filter turns green. That's when we will start entering bullish territory, and the ribbons will start appearing to tell us, guys, we have now recovered from this temporary crash or correction based on all these Trump tariffs, and the market has now factored all of that in, and we're now entering a period where you must start considering buying stocks. So all of that has been programmed into the S&P 500. How do we use it to identify market conditions? Is to look at the monthly, weekly, and daily, and to look for multi-time frame alignment. Now, something else that I like, which we have done, is that each time frame, if we go to view and go to expert commentary, each time frame is programmed with the expert commentary. Basically, it's like a little voice that comes with the system that tells you exactly what is happening on each time frame, and it does it bar by bar. So if we look at the monthly time frame, let me just close that down. Sorry, let me just open up the monthly time frame, view, expert commentary. You can see that there's an upside down triangle on May's bar, and that's giving you a breakdown of what is happening in the month of May. And then if we go back, so at the top here, you can control which bar you want to be on. So if I want to go back to April, you can see now that this has switched to April's candle, and it will give you a breakdown of April's candle. So we've got that commentary on each, we've got that commentary on each time frame. So the weekly has its own commentary, and the daily, 2 daily time frames have their own commentary as well. Okay, so I'm just going to switch back to the charts. So that's step 1. Use the S&P 500 to establish market conditions by aligning with the S&P, by having the right indicators, by knowing how to look at the monthly, the weekly and daily support and resistance levels, structures, the moving averages on the weekly and daily. By having them all on your charts, having this multi-time frame set up, you can then analyze the markets and stay aligned with what the market is doing rather than what the media wants you to believe is happening, which is often very wrong and misleading. Okay, step 2. Explorers to shortlist high probability stocks. Now, you want to use the MET to invest in trending stocks that are outperforming the S&P 500. Now, what exactly does this mean? Well, the S&P 500 is an average. There'll be some stocks matching the average, some stocks underperforming, and some stocks performing far better than the average. These are the stocks that we want to find, and these are the stocks that we want to invest in. So let's look at an example here. The S&P 500 since 2022 to its all-time high climbed 77%. Where it is right now, it's around 60-61% if I'm correct. But to its all-time high, it climbed 77%. If you look at all the other stocks that I shared, Amphenol 162%, Berkshire Hathaway 98, CBOE 124, Cencora 120%, McKesson 200, Netflix 600%, Nvidia 1200%, Sprouts Farmers Market 330%. All of these stocks have moved up more than 77%, which is the average market performance, which is what the S&P 500 has done. So you can see how you boost your performance from 11% a year if you just put it in an S&P tracker fund to 30% a year through finding these stocks, going into the analysis, going through that multi-time frame alignment, and then taking positions and building your portfolio. Now, here's the thing, guys. All of these stocks go through the same pattern. All of these stocks go through the same patterns, which is phase 1, which is proven performance. All stocks that have performed well in the past are very likely to perform well in the future. We're then looking for a consolidation base, a sideways market. We're then looking for a breakout. And then that phase 4 is a new trend. That's the ones that we want to get into. What is the logic here? The logic is buy high, sell higher. Because stocks that are moving up are already moving in the right direction. They're moving in our favor. The edge is in our favor. And that is why buy low, sell high, that value investing approach never sat well with me, because whenever I did that approach and I bought these stocks that were cheap or deemed to be cheap, they kept on getting cheaper and cheaper and cheaper. So whenever I entered, they never actually moved in my favor. And a lot of these stocks I exited in negative because it took forever for them to just get to break even. So that Warren Buffett buy low, sell high approach for me should be really questioned. You know, if you've got Warren Buffett's account size where you can hold these positions in negative and collect 20 billion a year in dividends, okay, by all means, continue doing what you're doing. But a lot of people don't have that luxury. They've got one eye on retirement. They've got a time frame, 10, 15, 20 years, and they want the most efficient and simple way to grow wealth. And the way to do that is trend following, stocks that are already moving up and in the right direction. What we have to do as investors is shortlist those best stocks and then get in at the start of the next trend. We want to get in when stocks are moving from phase 3 to phase 4, because that's the bottom of the trend. Phase 1 and phase 2 is where we do the analysis. We get the scanners to do a lot of the work, and we look at the analysis, that monthly, weekly, and daily, and we apply the phase 1, phase 2. Then we look at the explorers to pick out stocks that are in phase 3, again, do some analysis, and then we want to take those positions for the very best, ride those up. Again, that's how I applied my logic to gold. Gold, same logic. I got in at March 2024. I've been holding the trend all the way since. And this, by the way, phase 4, typical holding period is 12 to 18 months, often longer. Nvidia, for example, I've been holding it since 2023. So 12 to 18 months, 24 months, that's a very good holding period for good trending stocks. Before trailing stop losses may get hit, you may rebalance the portfolio. So how do we do this? Well, we use explorers, as already mentioned, for phase 2 to phase 3. Let's switch to MetaStock. So when you first open MetaStock, guys, this is what it looks like. All the magic happens in this button here at the top, the P, top left corner, power console. This is what you're presented with. Number of buttons here, a lot. MetaStock does a lot. So we're just going to focus on some of the key features. Explore, that's really where the magic happens. Now, we have developed a number of explorers. What I like about MetaStock is that you can favorite your explorers. So I'll go to the favorites tab. And the ones that I want to look at are the ones here. These are the ones that are with the MET add-on. And what we have are two sets of explorers. We've got long setup and short setups. The one that says V200K, where my mouse is right now, that's for the large cap market, US market, for example, anything that has high volume, and we're looking for stocks of over 200K. We have an explorer for long setups, and we have an explorer for short setups. So if we were ever to have a 2000 and a 2008 bear market repeat itself, do not panic, because all we do is we switch our stance and we short the market, and we've got explorers that will help us find the best, or the stocks weakening the quickest. In a bull market, we want stocks going up the quickest. In a bear market, we want stocks going down the quickest. So we've got explorers for large cap markets, and then we've got explorers for the small to medium cap market. So here we've got long setups, and here we've got short setups. So for example, the UK market, the UK market and the Indian market, we have a growing community in India. And so for the National Stock Exchange of India, they will use the small to medium cap scanners to look for stocks. Here in the UK, same as well, where typically a good stock has volume of around 100K. These are the explorers that we have. And what's great about this is, if we focus on the markets that we look at, so I've got them checked here. North America, these are the three main markets that I like to scan. And if you look at the total number of stocks, you're looking at 11 to 12,000 stocks in the US market alone. At the click of a button, if I click long setups, click explore, start exploration here in the bottom right corner, MetaStock will scan 11,000 stocks in about 10 minutes. And it will give me a much more manageable list. So it will go through 11,000 stocks and it will say, right, here's 50 stocks that meet your criteria. So now it's much more manageable for me to do my analysis. Instead of manually going through 11,000 stocks, I program the explorers to meet a lot of the criteria that I've gone through on the S&P 500, those levels, the volumes, moving averages, they're all programmed into the explorer to find stocks that are meeting our criteria. I will go through 11,000, give me a much more manageable list. If you're in the, if you just have a quick look at the London Stock Exchange, London Stock Exchange is here, 5,602 stocks it will scan within minutes. And if we go to the National Stock Exchange of India, which is a much smaller market, you can see there, 2,914 stocks. I know, for example, there's people in the Middle East who are using this for Middle Eastern stocks. Again, I think it's a much smaller market, 800 stocks or something like that. But ultimately, even 800, to manually go through 800 stocks on a daily basis, potentially, it's a long, laborious and impossible task. Having a good scanner, it will do that for you and give you a much more manageable list. So we have gone from phase 2 to phase 3. That's what the explorers are doing. They're finding all of these stocks that are moving from phase 2 to phase 3, and we can then do our analysis to find the next set of stocks. So this is where the bespoke charting tools to maximize profit come in. Now, what we do is that once we found a stock that is entering its phase 4, it's gone from phase 2 to phase 3, and it's now moving into phase 4, it started its new fresh uptrend. Well, the question is, where do we enter? Where do we exit? How do we manage risk? How do we compound? All of these need to be thought beforehand. It's often an afterthought for a lot of people. They're excited that they bought a stock and they're just in, and it's like, oh, what happens next? Everything has to be pre-thought out. The only aspect of any investment that is out of our hands, and that's for all of us, is the outcome of the position. We have no idea whether it's going to be a winner, a loser, or a break even. Hence why we have to think in terms of probabilities. Look at what we've done, guys. We've looked at market conditions to make sure the market is in our favor. We've used scanners to find stocks that are outperforming the index, trying to continuously push the odds in our favor. And those scanners are looking at the strongest stocks, and they're finding the most robust stocks in those sectors. So again, continuously stacking the odds in our favor, so that by the time I actually pull the trigger, I have the edge in my favor. I have more chance of making a profit than a loss. But look, listen to what I'm saying. I have more chance of making a profit than a loss. It's all about probabilities. There are no guarantees. I've shown you the portfolio diversification: 53% winners, 19% break even, 27% loser. I can't remember, something along those lines. You have to think in probabilities. Cut out losers, hold and compound winners. So once we get into this stage of starting to take positions, what next? Well, let's switch to MetaStock. And specifically, I'm going to bring up a stock here. I'm going to bring up Cencora, because Cencora is one of those stocks that I just looked at and is in our portfolio, and for a very good reason. So if we look at Cencora, if we do the analysis, if you look at the monthly time frame, guys, if you look at the analysis, bullish ribbon on the monthly, bullish ribbon on the weekly, and bullish ribbon on the daily. So the monthly, the weekly, and the daily, they are all aligned. So all the indicators which are explained in the manual, again, full transparency, all those indicators that make up the checklist system that confirm that the stock is bullish are all flashing green. And so now we have to consider taking a position. And that's where the daily in the bottom right comes in. So if I open up the daily in the bottom right, now, first of all, what I like about this is that you'll notice that the bars are blue. And why the reason why the bars are blue is because it's confirming multi-time frame alignment, another slick feature of MetaStock. It's saying that the monthly, the weekly, and the daily, they are all moving in the same direction. You can see there's been some sort of pullback in the last couple of days, hence why the bars are not blue, and that's fine. That's a natural feature to the way a stock moves. It moves, it pulls back, it moves, it pulls back, but overall it's still aligned because the bars are blue. Just the last two bars haven't been blue, but also the monthly, the weekly, and the daily are still all aligned in terms of the ribbons. But here's what I like about the daily time frame. First of all, whenever there is a signal, an entry point, there's a diamond being produced. So every time there's a diamond, the software is telling you that these are entry points that you must consider buying. So let's say if you entered here on the first signal back in March, the next signal would potentially be an opportunity to compound. So you could have repeatedly bought more of Cencora. How would you have bought it? Well, you'll notice there's a green line here. That's the entry point. There's a red line here. That's a stop loss. And there's a purple line here, which is the target level or the compound level. So we take these levels. You can see here, if you go to the right-hand side, $310.94. That's your entry point. Now, there's a logic to this. Again, it's all explained in the manual. Why is the entry there and not at another level? There's a specific reason. Then there's a stop loss. The stop loss is here. Notice how far it is from price action. A really nice wide stop loss to give it plenty of space to move. For just to give you guys an idea, the stop losses are based on ATR, volatility, because every stock has its own volatility. Some stocks are more volatile than others. Tesla, for example, is very volatile. Cencora, McKesson, that we've looked at, these healthcare stocks, Berkshire Hathaway, they aren't as volatile. They're much smoother moving stocks, so the stop loss won't be as wide. So we use average true range to calculate the stop loss, again explained in the manual. And then we work on a one-to-one level. So whatever the distance is between the entry and the stop loss is typically the distance between the entry and the target level. Now remember, this is not a target level where you close your position. This is a target level where you take profit, where you buy more of the winning stock. Okay, so you can see how the add-on does everything for you, from finding those trending stocks that are outperforming the index to then allowing you to do your analysis. All of those stocks that I found from the scanners, you put them through this screener, this 4-screen screener. You look at the monthly, you do your analysis. You look at the weekly, do your analysis. Look at the daily, do your analysis. The software is helping you with the expert commentary and all the wonderful features that MetaStock has inbuilt, like the ribbons telling you that all the indicators are aligned, the bars turning blue, and then our strategy comes in, which is where the signals are produced, entry points, stop losses, target levels, all produced for you to then do a seamless transition across into your broker account. Now, the one last thing I want to show you here, guys, is if I just compress the chart, is the trailing stop loss. So you can see this red line. This is the trailing stop loss. So as the stock moves up, we have a trailing stop loss. And that trailing stop loss has been following price action since it started trending. Now you can be very robust with it and just exit when it first triggers, or you can have certain rules like I do, which is where is it in relation to a major support level. If it's close to a major support level, I don't exit at the trading stop loss. I give it a little bit more space, and then often it will bounce and continue. These are slightly more advanced techniques. We have a community for our members where we share and discuss the potential more advanced techniques that we use, but we do have the trailing stop losses all on the screen for you. If you go to something like Nvidia, for example, Nvidia is a much easier chart to engage in how well the trailing stop loss works. If I compress the chart, look at how well I entered in. I mentioned entering at 2023. Look at how well the trailing stop losses has worked on Nvidia. It did not break the trailing stop loss significantly until 2024. Again, more advanced techniques. Where is it in relation to $100? It was very close to $100, so I haven't exited my positions. I'm still holding all my positions and my compounds. But you can see that we have all the parameters that you need all nicely displayed on the charts for you. Okay, so this should make a lot more sense now, the comparative returns, how putting money in a tracker fund will get you $250,000, but investing in stocks will get you $4.5 million, and why it's really an essential skill to learn and then pass on to your kids and loved ones. We've talked about all the goals and aspirations that people have, but most importantly, the most important one out of all of these is that breaking that financial illiteracy loop and developing and learning a set of skills that you can pass on to your kids and loved ones, a simple and repeatable strategy that's grounded in fact, in truth, in performance history. This isn't hearsay. This isn't some black box system. This is a timeless system that will outlive all of us. So the 3-step blueprint, guys. Step 1, pinpoint when to invest for maximum ROI. That's look at the S&P. Identify top assets for maximum ROI. That's where the explorers and the analysis comes in. And then clarity on how to invest for maximum ROI. That's where the strategy comes in. And I've already shared all the results that our community members have made, 100% over 3 years, in line with the 30% a year that we average. This is your edge. One of the first rules of investing is that you must be able to define your edge. Most people don't know how to define their edge because they don't have one. If you cannot define your edge, guys, you don't have one. And if you don't have an edge, you will get eaten by someone who does. The reason why 95% fail or underperform is because they don't have a proven edge. The 5% who do very well have an edge. So you must be able to define your edge. This is your edge. I'll leave this open so that when you watch the recording, you can go through it. But ultimately, it's just the whole system that we have gone through in the last hour. At the bottom one, again, train 10, repeat the process for life, train your loved ones to carry on your good work, a legacy to be proud of. And that's where Revacy comes in, the name of our fund, which is Revolution and Legacy. It's a portmanteau. You take the beginning of one word, the end of another, combine it, Revacy. Revolution and legacy, they're the two things that I really associate with everything that I'm doing. So this is what you get: 4 exploration, 16 expert advisors, 11 bespoke indicators, 1 template, a very detailed manual explaining everything already mentioned, complete transparency. This isn't a black box system, and a wonderful support structure, not just from us here at Sublime Trading, but also at MetaStock. I had a little issue with my MetaStock last week, and literally someone jumped on the call and within minutes had it resolved. So the support at MetaStock is second to none, and that is a big part of why our relationship has really sort of flourished the way it is, because I really am a sucker for good customer service. Market Edge Technology, the retail price is $1,497. It is $997 on this webinar. That is a one-time offer, guys. This isn't a monthly subscription or an annual subscription. This is a one-time offer for the MET. We've also got some wonderful bonuses. There's an onboarding call for every single one of our members. That's with me. Every time I jump on an onboarding call, I get the same reaction, which is, oh, it's you. I thought it was going to be one of your sales guys. No, it's me. I make sure that everyone that comes into our community, I get to meet and discuss and make sure that we are on track for everyone's goals. We have a private community to discuss daily setups. This is live, spearheaded by myself and my co-founder, Collar. And you get a three-hour recorded boot camp and invite to future boot camps. This is in the back end of your members area once you subscribe. So all of these bonuses will be thrown in as well. So 1497 is the actual price. The bonuses will be thrown in 997 for everything. One-time offer, guys. So just to summarize, what the MET actually does, 30+ years of combined experience between the co-founders will save you thousands creating the system yourself. And I mean thousands in terms of learning to develop the software, in terms of money lost, courses. We will save you a hell of a lot of money. Endless hours creating the strategy yourself. It's a proven system which we use for our hedge fund. Peace of mind for your future is in your own hands. And as already mentioned, it's a legacy that you can pass on to your loved ones. The truth is, tried and tested and safe and simple will make a bigger long-term impact on your financial success and stability than anything else. And that may sound boring, but here's the thing. There's nothing boring about the wealth you create through compounding gains. There you have it, guys. That's $997 one-time offer. Over to you, Jeff.
Hey, Zaheer, we're having a few technical issues with the next speaker, so Greg is going to ask some questions.
That sounds, I was just about to suggest that. So there are some questions here. Is that okay?
Yeah, brilliant. Absolutely.
Questions and comments. Greg says, I bought this add-on 6 months ago and it already paid for itself 3 times over. It's an incredibly insightful tool.
Brilliant. Brilliant.
And then Reg, oh, looks like we got the other speaker going, but I'll go ahead and continue with the questions. Reg says, amen to the comment that Zaheer thinks most people are good. I will second that emotion. And then an actual question, Zaheer, from Greg. He says, does Zaheer reallocate funds when a stock like NVIDIA moves from phase 4 back to phase 3 in order to keep funds allocated to phase 4?
So it's a really good question, Greg. With NVIDIA, we haven't reallocated because it's just forming a very nice base at $100. And when it breaks out, we want that compound effect to really sort of kick off again for the next leg up. But some of the other stocks that may correct a little bit deeper, absolutely, you may want to take some profit on those, maybe leave it partially open. Greg, if you put that question in the community or email it to me, I can give you a more detailed response.
I will absolutely do that. Actually, you should be able to. Are you not able to see questions in here? Oh, I think we need to. Okay, I'll take care of that for you. You have one final question from Carlos. He says, can you use options?
Yeah, absolutely. Absolutely. I mean, options is just a route to market. Here in the UK, the option market isn't massive. I actually went to a talk the other day, and the options market is starting to apparently open up here, and people are really sort of interested in it. We have a broker account here, which is spread betting, which is similar to CFD. It's free of capital gains tax. So that's what our UK members use. But absolutely, you can use options. I'm not too familiar with it, but if options can roll over, I know there's a sort of expiry time for options. So if you're able to roll that option over because you're in profit, then yeah, absolutely, that's something you could do.
All right. Awesome. Thank you so much. So it looks like Jeff's back. I'll go ahead and bow out. Thank you so much, Zaheer. That was an awesome presentation.
Thank you. Right. Cheers, guys. Thank you, everyone. Thank you.
That was a good assist, Greg. I really appreciate it. We had to do a little bit of technical stuff. Not too bad. Not too bad at all. Let me make me the presenter real quick. I do.
I
I
should,
do
I should
really.
mention, Jeff, your audio is like 100% better. So you fixed, you get two, what do they say? Two birds in the bush. I don't know. You fixed two things. Good for you.
Well, that's be in the hand, right?
Yeah, two birds in the hand. Yeah.
Okay.
Forget those in the bush. They don't.
Barry says, "Do I need to have MetaStock with this?" And that is correct. Hey, Dave, we'll be right with you. I can see you. Oh, yeah, it looks like we have another audio issue with Dave. Okay, give me 2 minutes. I think we can fix that too. All right. Okay. Included in the MET is the template, 10 indicators, 4 explorations, 11 expert advisors. If you don't have MetaStock, Barry, we will include a free copy of MetaStock as well. Okay. In addition to that, here's all the indicators, the systems, the methods that are in there. Has the expert advisors, the screens, the scanning, everything you need with that. And works really good in MetaStock. If you're new to MetaStock and you don't have a copy, we'll give you a free copy of MetaStock, a free trial copy of MetaStock. You can try it out. You can find out why it's been rated #1 32 years in a row. We'll also give you unlimited support, free white glove service, all that kind of stuff, and unlimited access to the recording. All of that is all of that you can find at Market Edge Technology. You can get it. You can get this offer at metastock.com/conf-promo. You can go to metastock.com/saleschat. You can also give us a call at 800-882-3040. The normal price on this is $14.95. It's a one-time cost. It comes with a 30-day money-back guarantee. It comes with a trial to MetaStock. Great risk-reward option. $9.97 here at the conference. So you can get that again if you go to metastock.com/conf-promo. Greg, I need your help again. I need to call Dave real quick and just get his audio connected. It looks like he's having an issue with that.
That's fine. I can just talk about some of our sponsors for a moment.
Yeah, and you can. I'll just give him a call. It's only gonna take me a second. I just need to have him walk him through a button.
You got it. So we'd like to, of course, always give out a great thank you to the sponsors. CMT Association is one of them. If you want to see more about CMT and how you can get your CMT accreditation, which is a pretty swell thing. A lot of our partners have it. You go to this link that I'm going to share with you. Excuse me, I'm not used to having to speak and share links at the same time. You go to this link. And I should point out that if you just logged in right now, we're trying to get Dave Landry up and running so he can share with you his presentation. Another sponsor, I don't have control of the slides, but I know another sponsor we have is Traders Forum. Traders Forum is the thing that Jeff Gibby is currently overseeing and has upwards of 1,000 people.
Okay,
it is a fantastic interface.
All right.
Okay, looks like Dave Landry, I can't hear you.
Okay, so, it's working. I'm going to go ahead and hang up.
Okay.
I told you we could do it.
Okay, it looks like you guys are on. I'll go ahead and get out of the way.
All right, cool. If you want to take advantage of any of the offers today, you can give us a call, 800-882-3040, metastock.com/conf-promo, and metastock.com/saleschat. Dave, we did it.
Anything can't go wrong, will go wrong.
Yeah. And that's a good way for, like, in the future, if you can't get your audio connect, that's the way you do it in a GoToWebinar.
All right, that's the first time I've had that problem, so that's good to know. Thank you.
We've had every problem, so I know how to solve it. Let me make you the presenter. Dave, just to kind of announce or talk about Dave to the audience, Dave has what I would consider one of the best trend identification tools out there. Been in development for a number of years. I'm going to let him talk a little bit more about that. I'm just super happy that we've got his audio, we've got his video, we've got him here. It's good to have you, Dave. It's all yours. I'm going to get out of the way.
It's great to be here. Thank you, Jeffrey. I appreciate it. Today we're going to talk about simple setups for trading success. And setups don't exist in a vacuum. You really need a lot of money management and a lot of trading psychology. So I'm going to touch upon those things today too. I want to thank everybody for attending today. Looks like we've got a really good crowd this morning. Thank you so much for getting up on a Saturday. Thank you, Jeffrey, so much for having me back once again. And of course, thanks to MetaStock as usual. Business disclaimer screen, as you know, you can lose money trading, or as I often sum it up, borrowing a line from my friend Greg Morris, all predictions about the future and a lot of stuff can happen between now and then. Speaking of a lot of stuff, I'm going to go over quite a bit of stuff today, but it's not one and done. So I have probably, I don't know how many hours. I meant to look right before I got started, probably 1,000 hours of stuff on YouTube. And if you wanted all 3 of my books in PDF format, some mini courses, and the slides from this presentation, so you can have all the formulas and everything. It's not many formulas, it's just formulas for MetaStock. DaveLandry.com/slides, but you'll also have the rules for the setups. And there's tons and tons and tons of ways to contact me, so feel free to take a screenshot. You can also reach me at davelandry.com. Now, this is the patented trend following indicators that Jeffrey was talking about. As I often say, and it's been attributed to me, but it's actually Linda Rasky. If you don't know which way a market is headed, ask a 6-year-old kid, as I often preach. 6-year-old kid's not worried about his spouse being a pain or his boss being a pain or whatever the case may be, expenses, etc. And he doesn't justify things. He just looks at the charts. It's going up, it's going down, or it's going sideways. So that's something that you never need to lose sight of. Years ago, a famous trader who befriended me called me a trend following moron. Initially, we were really good friends. We actually met up and everything. And he wanted to do some stuff with me, and then he started fighting the trends, and I kept drawing my big blue arrows, so that's how I got the name Trend Following Moron, in case you were wondering about that. One of the simplest ways to identify a trend next to the arrows is what I call Landry light. Now, if you have MetaStock, it's called daylight and Landry light, and eventually, it's on my to-do list. I'm going to get together with Jeffrey, and we're going to expand that plugin, add a few things to it, and change the name on the Landry light, or daylight, I should say, the Landry light. But it's just simply the lows are greater than the moving averages. In 1996, I think I wrote it in 95, it was published in 96. I wrote an article for Stocks Commodities Magazine. I talked about a simple little system where there's a little breakout system. You could Google it if you want. You can get it. It's all over the internet. It's a 220 EMA breakout system, and you're just looking for 2 bars above the 20 EMA. Anyway, that's where daylight came from. Somebody had contacted me, and he called it daylight, and it became Dave light, and then it became Landry light. So downtrend, same thing. The bar highs or less than the moving average. Kind of a gap between the price bar and moving average is one way to think about that. Now, the count can be useful to see how long you've been in a trend. Now, if the bar touches the moving average, then Landry light equals 0. If the low is greater than the moving average, and Landry light is Landry light plus 1, and conversely on the downside, Landry light minus 1. Now, here's the MetaStock formula. If you need it, it should be built into MetaStock, but that's what it looks like should you not have it or you want to modify it. Everything I do in MetaStock, at least for now, is fully disclosed, and everything I actually do is fully disclosed. So no big deal there. Now, when you're counting the bars, you're just simply counting the number of bars that the price is above the moving average, or you're counting the number of bars that the price is below the moving average, the highs, that is, lows for uptrends and highs for downtrends. Now, again, if the bar intersects the moving average, there's no Landry light. Now, if you use it as a histogram, it could be quite useful. And again, this is straight in MetaStock. Here's the S&P 500. And, just to keep things simple in Tarzan speak, good is up and bad is down. So when you have lots and lots of green, that's a good thing. And it means the market has been going higher, at least. Remember, we're trend followers, not trend predictors. But when the green begins to alternate between green and red, that indicates a choppy market. As you can see here, the market went sideways for a while. And then the spill we had earlier this year, we had lots of highs below the moving average. So that means bad and downtrend. And it really is fairly simple when it comes to Landry light. Now, again, the reason I showed those arrows earlier is there's nothing more important than the arrows. Make sure you also draw the arrows on your chart, because sometimes, as I'll show you in 1 second, the Landry light can be increasing, but the price is actually losing momentum. And you can see, like right here, would be a good example of that. The Landry light continues to go higher, but the price is starting to lose a little momentum. So always look at price. In fact, I always look at price first and foremost. As I think I said in the previous webinars, I look at about 2,000 charts every day, 2,000 stocks plus the sectors, et cetera. And I'm looking at a blank chart with no indicators whatsoever. But the great thing about something like Landry light and proper order, which I'll talk about in 1 second, it does give you a way to quantify and kind of qualify the trend. And also, as I often say, there's no indicator. An indicator doesn't indicate what a price is going to do. I know people will try to sell you an indicator. It's going to tell you what the future price will be. Well, if I had an indicator that would tell me the future price, you'd never see my fat arse again, right? But the bottom line is it does help to illustrate. So I often call them illustrators, what's in the actual chart, because you might be wanting the stock or the market to do whatever, and it's not doing that. And you start to reason or whatever, but if you look at the actual illustrator, you'll see that, well, hang on a second, this says it's green, it could be in an uptrend. Anyway, again, don't forget to draw your arrows on the chart, especially when it's very, very obvious. So here's Bitcoin. You can see lots and lots of Landry light. And then notice that, as I alluded to a second ago, you still have Landry light because the lows are greater than the moving average, okay? But the market is beginning to lose some momentum. So always look at the chart. You can see it's beginning to go sideways there. And then the Landry light goes back to 0, and it comes up a little bit. I have a line drawn down here at 10, okay? So 10 is a good round number for a potential trend. And you can see it's below 10 there. And then it went red for a while. And even though it was mostly green, again, draw your arrows, and the market is going mostly sideways during that period. And then you have a little red, little green, and then that just means that the market is choppy. And the easiest thing to do is just look at a market. Where are you today? Where were you a few weeks ago, a week ago, a few weeks ago, a month ago, 2 months ago, a year ago, and draw a horizontal line. I call that the Rip Van Winkle sleep test. Okay, pretend you woke up, grabbed the newspaper, if they still exist. I don't know if they still exist, and looked at a stock price. And the last time you looked at the newsletter was 3 months ago. And if nothing's changed, then the net price obviously is 0. And so always pay attention to that. People ask me all the time about stocks that are going absolutely sideways. I'm a trend follower, so there's no trend to trade, especially if the price is the same as it was a few weeks ago, a few months ago, whatever. But anyway, you can see a nice trend developed again. This is Bitcoin, and we had lots and lots of green. What followed that was a choppy period, and you can look at the chart and see that, or you can look at the Landry light, which helps to, again, illustrate what's happening. Now, here's the other point again, just to reiterate. The Landry light in this case was increasing, but then the market was actually selling off. Again, in this case, it was Bitcoin. So you can see right there, and then again right here, the price is increasing. I'm sorry, the price is decreasing, but the count is increasing, and then it goes to 0, back to 0, once it intersects the moving average. So mostly green is good, again, okay? Alternating red and green is choppy. Mostly red is bad, sideways, okay? And then green, again, is good. So you kind of get the idea here. Now, getting back to the net price change, notice that I drew a horizontal line going back in time, and this was taken a few days ago, and Bitcoin's improved obviously since. But you can see that it hadn't made a whole lot of progress in a long, long time. So for me to get excited about Bitcoin, it would actually go on, it would have to make all-time highs and stay there for a while. So again, never forget to draw your arrows, never forget to look at the charts. That's a lot of overhead supply. So we are pushing into that overhead supply now in Bitcoin, but a lot of people are likely looking to get out at break even, those who bought at the prior highs. And it's human nature, and I'm kind of a man on the street kind of guy. In the gym every day, a lot of the guys are talking like, well, I'm going to sell my stocks when they get back to all-time highs. And I'm like, no, just sit on and be a trend follower. You should have sold them when the market began to spill a few months ago. Now, another way I like to gauge trend is with the bow tie moving averages. And again, these help to objectify, and I'm not mechanizing this stuff. I have one mechanical system, which is called the TFM 10% system. If you go to my website and search on my website, TFM 10%, you get the rules for that. But other than that, everything I do is discretionary, but these illustrators, so to speak, can help me do that. when I first got into this business, because I had a degree in computer science, I thought I would use it, and I programmed probably thousands of mechanical systems. Now, thousands is probably not as much as it sounds like, because a lot of them I was just tweaking this parameter or that parameter. But anyway, all that mechanical testing helped me to become a discretionary trader. But it was not a exercise of futility, because I did learn a lot about markets, and I learned that I shouldn't rely exclusively on indicators, but they can help to show you what's going on. Now, the moving averages used are a 10 simple, a 20 exponential, and a 30 exponential. And I found that the relationship between these moving averages, especially during a trend transition period, and this is really why I wanted to cover this. We just had a transition happen, obviously, in the market not that long ago. And I'll show you some, or at least one setup that happened then. But the exponential moving averages tend to front weight the data, and by the way the formula works. And the simple moving averages are a little slow to catch up, but the relationship between those moving averages I found can be really cool, especially when they go from one order to another. So the order is simply, for downtrends, the 10 is less than the 20 and the 20 is less than the 30. Uptrends just the opposite. 10 is greater than the 20 and the 20 is greater than 30. And if there's no order, it's 0 as far as the order count is concerned. And you can see right here, the 10 is in between the 20 and the 30, and the 30 is above the 20, and so it's not an uptrend proper order. But notice to the right, you can see that the moving averages are coming together. The 10 is now above the 30, and the 30 is still above the 20. So as soon as that 20 gets above the 30, the uptrend proper order count begins. Anyway, it's illustrated in a chart, and it's pretty cool that MetaStock programmed this bullish and bearish in, and I just simply added the histogram down below. And again, this will, when I get around to updating the plugin, I'll have Jeffrey add that in. But you can see, getting back to Tarzan speak, green, good, okay. And then when there's no order, or it's flipping back and forth, okay, that's bad, or bad for a trend follower because it's choppy, okay? And then again, the downtrend, same sort of thing. So look at this little spill we had in the market, and then the bow tie setup was here. It looks like you might have had one here too. I have to double check that, because you want a higher, nope, yeah, this wasn't a higher high. So if this was a higher high, that would have been a setup here. So that's a setup without the higher high, which could be not quite as accurate of a setup, but it could also get you in earlier, okay? And then the official setup is when you make a higher high and a higher low, was right there, okay? And we'll get to the bow tie setup in just 1 second and go back. It says, not a question, but it looks like an alligator. The histogram, cool. Never thought about it like that. So if you look at longer term charts, you could get a really good feel for where you are. And as I'll show you in 1 second, especially when it comes to major bull or bear market. Now, 2015, 2016 wasn't really a bear market, but it was a horrible time for the trend followers, and it's hard to see in this big drawn out chart, but the market just chopped around. It was abysmal. And the moving averages did go to downtrend proper order for a little while, and then we had a really nice thrust out of that. And then, of course, we had the pandemic slide. Now, I had daily signals trigger, including that aforementioned TFM 10% system, which is actually a weekly system, which surprised me that triggered before some of the daily stuff. But when you have a V-shaped recovery, just remember that by the time the moving averages catch up to the market, okay, it's too late. So there is going to be a lag, and as I'll show you in 1 second, the lag could actually work to your advantage, because it can keep you possibly from chasing your tail in the overall market. We had a nice little trend coming into 2022. We had a pretty serious slide there. And then, of course, the trend resumed. And then recently, the bow ties have turned back down. Now, so far, we're having a V-shaped recovery. So if we have a V-shaped recovery, then that's a false signal. But it does, again, help to alert you that the market might be in trouble when you have these longer-term weekly proper orders. Now, if we zoom into the daily in more recent times, you can see the market slid pretty hard. And here's the setup right here in the daily. Okay, you see the sell was right there based on the expert advisor, and the market had a pretty serious slide. And this was kind of a gradual rollover, or actually this was, I'm sorry, let me back this up. This was a 2008 slide. And notice in 2007, you had a gradual rollover, and right around the beginning or just before the beginning of 2008, the moving averages went to downtrend proper order. So that's the kind of rollovers that the moving averages are really good to help you to catch, is when it's a nice gradual rollover. Also, a nice gradual bottom can be great. Right now, pot stocks, marijuana stocks are beginning to look like that. It's possible uranium and a few other areas are beginning to bottom out. And by the way, as you'll see when we get to the bow ties in 1 second, the setup itself, the best ones come off of all-time highs for something like an index or a stock or whatever, and then all-time lows, which hopefully stocks will never go to all-time lows again, but for individual stocks, the best one are coming off of all-time lows. Gold stocks, not now because they're in trend following mode, but gold stocks sometimes can bottom out for a long, long time. Other commodity-related stocks such as coal, as we'll look at in 1 second, and energies in general can do that kind of longer-term nice setup. So that's what you want to look for, ideally with the transitional setups. And again, I'll walk you through that in just 1 second. Now, getting back to the Landry light, and that's just the lows greater than the EMA or highs less than the EMA, okay? You want to have about 10 to 20 bars of Landry light, but you also want to draw your arrows on the chart and look at the chart. If you have a market that's kind of rolling over a little bit, even though the Landry light is still positive, you might want to think twice about trading that market based on the momentum. Now, the market must also pull back to touch the 30 EMA. The original, I think I called this originally Kiss Ma Goodbye. So if you get the aforementioned books for free and you see Kiss Ma Goodbye, Kiss Moving Average Goodbye, it's now called a Landry Light pullback. And I use the 30 EMA now. I used to use the 20, and I did a lot of work with the 20. And now I've kind of fallen in love with the 30. I really like the 30 EMA. And in fact, when I do a weekly webinar, almost every single webinar, the Dave Landry's The Week in Charts, I point out, especially looking at crypto, that if you just avoided markets that were below the 30 EMA, you would stay out of a lot of trouble. And if you go through all those altcoins, you'll see that many of them have lost 50 and 75% or more of their value and never did touch that EMA. So if you don't walk away with anything today, just know as long as you have downside Landry light, or if the market's just closing below the EMA to begin with, you probably want to avoid that market. So we're looking for a pullback to the EMA and the Landry light go to zero. And that's the beauty of quantifying some of this pullback stuff that I do. Again, I would just look at a blank chart and say, okay, that's a buy or sell, but it also will likely be a Landry light pullback. I was kind of amazed a while back in my daily recommendations on my trading service. We had a really good string a while back of winners, and I went and looked at them, and I would say almost every single one of them, a few of which I'll show you today, were Landry light pullbacks. Now, you want to go long above the recent highs. You want to give the market a little bit of wiggle room to avoid being triggered in on noise alone. And then you want to follow the hybrid money management system that I'll talk about in just 1 second. Now, this is a live trade, and it hasn't been spectacular just yet, but it's working out okay. We're in the plus column. That's always a good thing. Notice coming into this trend, we were in a longer term downtrend, and then the market got a little choppy back here. You can see a little red. We had none here because it intersects the moving average, a little green here, and then it starts turning to green and stays green for a long, long time. In the last little run, the other thing, like I said a second ago, you want to make sure that market is still trending nicely, okay? So here it was kind of beginning to lose a little bit of steam. Net price wasn't that impressive, but it was working its way higher. But then it began to accelerate higher, and that's actually a separate pattern I call accelerating momentum strategy. So a lot of my patterns, remember, all these patterns were discovered on a blank chart. Not that I discovered pullbacks, I just spent 20-something years working on pullback related patterns for the most part and setups. But one of them, accelerating momentum strategy, you're looking for kind of, you can draw a trend line, kind of a gradual trend line, and when that trend line begins to accelerate higher, when the new trend begins to really kind of go a little parabolic, that's a good time to think about trading a market. Now, you do have a gap down here. If you know me, you know I don't like gaps against the trend, especially at a setup. However, in this particular case, this was a commodity-related stock, so I'm not going to get too excited about that. This is really clean looking for a commodity-related stock too. This is a gold and a metals type of stock. And again, you have the acceleration out, and then it pulls back to the 30 EMA. And if you're so inclined, and I think the scans, I don't know if the scans are built into MetaStock, but they might be, you can actually scan for these type of patterns. And again, the Landry light goes down to 0 because you touch the moving average. Down below, this is based on a hypothetical 100K account, although I do take these trades personally. I do have a model account where I actually would have, I think I have 700 or 800 shares in the model account. I have other shares in other accounts too. And those are the parameters I use. The entry of 2150, stop 1875, initial profit target 2425, and the risk is 275. When we get to money management in a minute, I'll show you that you're basically taking the risk and you're adding it to the entry. So if you could figure out the entry and the stop, then the initial profit target, the IPT, is set for you automatically in the spreadsheet. And then the risk is also set. And I just called it a pullback, but it was also a Landry light pullback. So the entry was there, stop was here, and the initial profit target is up here. And we take a look at what happened. So far, it's had a nice little run. I'd prefer it to be a lot bigger, obviously, but it's had a little run, and we're positive on the trade so far. So we'll see how that one shakes out. Maybe Jeffrey will have me back in 6 months, and hopefully we'll still be long this particular stock. Here's one that wasn't too long ago. Nice little pullback. It's an IPO, so there's still some excitement about the stock. Took off and then it came back in. I think I called that a first deep retracement. That's one pattern in IPOs I like, is an IPO, ideally though, when it comes public, way back in time, when it goes straight up and then comes back in really deeply, that's a good pattern to trade. In this particular case, it bottomed out over a long time. Kind of looks like a bigger picture cup and handle, so that's a good pattern too. Pull back to the moving average. The Landry light goes down to 0. There's the parameters. Now this is based again on a hypothetical 100K account. I do take these trades personally. Entry of 2350, 1850 for the stop, and 2850 for the IPT. If you want to look at the archives of all of these trades, I update these about once a month. And if you look now, I just updated the archives. If you want the newer ones going back even a few days ago, you can go to DaveLandry.com. I'm sorry, you can go to YouTube.com/Dave Landry. That's my channel, and you can access those there. It's a wonderful exercise, if I say so myself, in going through these old trades. You can see what worked, what failed miserably, and kind of get an idea of my mindset. And usually I'll point out things like the stock we looked at earlier, like, okay, well, our trend's accelerating, and I like it because the market is persisting upward and whatever else. But it's a great exercise again, and it's all free. And that's another one of those not one and done. If you can't sleep at night, just don't operate heavy machinery afterwards, you can go in and watch these old services. And I think that's a great exercise. I wish, and if there's some other guys out there that do that kind of thing, let me know. I wouldn't mind looking at somebody else's trades to figure out what they're doing beforehand, of course, without any hindsight. Everybody shows you these great trades, but what happens in between? Anyway, entry's there, stop is down there, and the initial profit target was right here. And this is what happened. A little bit of a slow start, but it did trigger and take off. It hit the initial profit target. Now, on a 100K account, you would take off half your shares. You're risking 2% per trade, and we're going to get to the money management in a little more detail in 1 second. And then at that point in time, you move your stop on the remainder to break even. Short-term trading is less risky than longer-term trading, but you don't make enough. Longer-term trading is very risky. Drawdowns are abysmal. Your accuracy is going to be really, really bad. I would say if you could be 30% accurate in long-term trading, you probably would do okay. It's going to be hard to even get 30%. And again, the drawdowns are abysmal. And that's why, not to take anything away from them, because what they did was nothing short of amazing, but that's one of the reasons why the turtles did so well. They were in a trending commodity markets, and they were trading a trend following system on a pure trend following basis, and they absolutely printed money. Unfortunately, after the program ended, most of these guys, I think there's only 1 or 2 that are really successful that are left over. And I'm not being schadenfreude. It's just like they happen to be in the right place at the right time, and we're trading a trend following system. So trend following system will print money in great markets, but it's abysmal and when the markets aren't fantastic. But this hybrid approach that I take kind of allows you to have your cake and eat it too. So in this particular case, the stock came down and stopped out on the remainder for a scratch trade. And that's okay. And we're going to get to that scratch trade in just 1 second. If you go in, make a little, go in, make a little, go in, make a little, and then you hit it out of the park, which I'll explain with the money manager in just 1 second, and ride that trend a long time, that's where the real money is. And here's an example, going back a little ways. And you can see this was an IPO. This was a first deep retracement. It was also became a Landry light pullback. And we banked $1,000, okay, based on a 100K account. And then we brought the stop up to break even, okay? Question is, are the entries and targets auto-plotted? No, because I use discretion on the entries and targets. So you can see this entry here. This was the setup back here. And this entry was, I gave it enough wiggle room to help being avoided by noise alone. And then I kind of eyeball the chart for setting that initial profit, the initial stop, which will give you the initial profit target. You want to give it enough room to where if the trade fails miserably, then you're obviously wrong. If you're newer to trading or newer to my methodology, I would encourage you to use actually wider stops and trade fewer shares. That way you're more likely to catch more trends. Anyway, once you get to the initial profit target, your stop goes up to break even, and we let that stop gradually loosen up over time. So we're shifting from the short-term trader to the long-term trader. And that's the ultimate goal. 1 or 2 of these a year will pay for your entire year. Now, I've been accused before, constructive criticisms of making it sound elusive, but it is elusive, okay? You really have to chip away at it for a long time until you finally catch a few great trends. And the biggest source of failures probably that I see with people is when the markets are choppy and they're following along my trading service, I'm telling them, don't do anything that's choppy, don't do anything that's choppy, be patient, be patient, be patient. People give up, and then the next day, 2 or 3 setups begin to trigger, and all of a sudden the market takes off. And so that's the thing about trading. It'll really wear you down if you find yourself getting bored with it and you're not patient. So I think, I'm working on a series on how a million little things will make you a successful trader. And I think that would be one of the superpowers that I've been talking about lately is patience. And if you have amazing amount of patience, I think you could become an amazing trader. And we don't have time to get into it today, but there's a psychological reason why you're not patient. And that reason, long story endless, is because in life, you're paid to take action and you have to take whatever train wreck comes along as a client or whatever. Whereas in trading, you're better off many times not doing anything. And if we have enough time, I could flesh that out a little further. Anyway, Landry light, nice Landry light here. This was a new issue. So it wasn't quite to the 30, but the 30 was right below. So that's a 20 EMA on the bottom, just to illustrate the point. There's the parameters. And again, lots of wiggle room on the entry, lots of wiggle room on the stop. So it triggers, and it took a little while, but it eventually got up to the initial profit target. Again, this is an example of patience once you're in a position. Trading is a lot of waiting, okay? You're waiting for setups, and then you're waiting for triggers, and then you're waiting for the stock to move once it triggers, okay? And so in a case like this, I'd be willing to bet some people got out right here because they're 2 weeks into the trade and they're losing money. And they're like, okay, I'm losing money, so I better just get out. But notice it hasn't even touched the 30 EMA. And again, an illustrator like that, the Landry light, can really help to keep you in the market. But it did eventually hit that initial profit target. It took a little while. It took a couple of months, or at least a month. And then again, you move your stop to break even. So you have a free roll on the position. So barring overnight gaps, the worst you could do is break even, and you'll have $1,000 in your account per 100K. The best you could do is possibly hit a home run, and that's, again, the ultimate goal. Now, in this case, didn't make a whole lot on a second loaf, but you never know when the big trend's going to come along. So again, there's the parameters right there. Let me just show you on the chart, be quicker to show you. And notice that the people at MetaStock, trending means that you have at least 10 bars of the Landry light, and you can see it pulls back to the moving average. And this is a 20 EMA and a 30 EMA. Landry light pullback, entry, stop, initial profit target. And again, you bank, this is a case where you bank 1,000 and you make a little bit more. You only make 150 on the second loaf. But the ultimate goal is to make 200, 300, 400, even 500% or more on that second loaf. And that doesn't happen every day. If it did, again, you wouldn't see my fat butt anymore, right? But you just have to keep chipping away at it, chipping away at it. And this one's a little dated, but I think I have a client that might still be long this one because I wasn't aware that it had dividends. Most of the stocks that I recommend don't have dividends, and he would adjust his stop lower on the dividend. So he might still be long. I'll have to check with him, but lots of Landry light, a little pullback to the 30 EMA, okay? Landry light goes to 0 when that happens. And this is a screenshot. And again, you can get the archives for all of these and you'll see what I've done, warts and all. But the parameters were down here. It was a cheapie stock, so we ended up with 2,000 shares. And I have it as a pullback, and it's also a pattern I call a TKO. We have a sharp thrust lower, and you'll get that pattern in the books. Entry there, stop there, initial profit target there. And again, you hit the initial profit target, you bring the stop to break even, and then you allow that stop to gradually open up over time and ride out a longer term trend. And again, I think a client might still be long this stock. So it is somewhat relevant still. I know it's dated, but it's still relevant. Now here's another case of a kind of a better than a poke in the eye stock. Begins to take off, it pulls back to the moving average. Landry light again goes to 0. There are your parameters down below, entry, stop, initial profit target. And unfortunately, we got the initial profit target out of this trade, but unfortunately, the stock imploded and we scratched out, luckily, at only break even on the remainder. Now, I haven't checked this stock, but I think it dropped much, much, much further. So let's say if you were in pure longer trend following mode, you would have lost money on the trade overall. In this case, you make a little bit of money. Now, you're not gonna get rich 1% at a time on your account, but it does help to keep the lights on. And it does help to keep you in the game. If you could stay in the game long enough, you're gonna catch some amazing trends. The secret though is staying in the game long enough. So that's the better than the poke in the eye trade. Now it's interesting when the market is kind of choppy where we hit the initial profit target, stop at a break even, hit the initial profit target, stop at a tiny profit like the one I just showed you, and so on and so forth. Clients email me and say, Dave, why don't we keep the full position? Why don't we take 100% of the profits? It's like, well, no, because should that market take off, or should the overall market really begin to trend, you're never going to catch a big enough trend, and you're never going to be able to pay for all this, okay? Now, just the opposite, they ask, well, Dave, everything's taken off lately, last 5 or 10 trades or whatever, why don't we just keep 100% on? It's like, no, because what's going to happen is you're going to get creamed enough and often enough on other trades to where the risks are going to be high. That puts you back in the mode of longer term trend follower. And again, your drawdowns are going to be abysmal, and so will you actually be. Now, bow ties a little bit more advanced type of setup, but they're important to know when a market is making transition. So these would have been good to know a few months ago, obviously, but now you've got some stocks that are bottoming out. Again, the pot stocks, possibly uranium and a few other areas. So it might be worth paying attention to. So I purposely drew this as an inverted cup and handle, especially with the bow ties, because that's what the market will look like. Kind of makes a gradual rollover. And then after that first correction, it has an accelerated move higher. Now, tops could be a process and bottoms could be a process, or they could be an event. When they're a process, you get this gradual rollover. When they're an event, it's more like a bam lower. And sometimes the bow ties will catch up really quick when that happens, but other times you're better off watching for what I call a first thrust. And the first thrust is just a sharp thrust lower, followed by a little bit of a retrace. Even a 1-bar pullback is plenty for that pattern. But again, the tops and bottoms can be a process or an event. Now, the rules are pretty simple. After a major low or high, if you're shorting, the moving averages flip from downtrend proper order to uptrend proper order, ideally over a few days. and that gives him the appearance of a bow tie spreading out. Now the stock or whatever other market, I believe markets are markets, by the way, so this will work in all coins, this will work in Bitcoin. Ideally, you want to be trading more inefficient markets. You notice a lot of the stocks that I showed tend to be a little bit more inefficient type of stocks, as opposed to something that's more well established. You're not going to beat a market with stocks that are very efficient, that aren't as volatile or more volatile ideally than the overall market. But anyway, once you have these transitional type of patterns, all you need is a 1 bar pullback. And the reason just a 1 bar pullback is because when a market begins to sell off, it begins to rally a little bit, anybody who's still long kind of breathes a sigh of relief. Now remember, everything I do is 1, simple, and 2, psychologically based, and it's also conceptually correct. Psychologically based means that I'm looking to take advantage of the situation of people might be looking to get out if that stock begins to roll back over. And people tend to not get out at the first signs of adversity, but wait to see what happens. And when that trend begins to accelerate lower, that's when a lot of times they'll throw in the towel and that market will implode. Or on the upside, that's when sometimes you have a parabolic run, especially if the shorts are shorting the market. So anyway, here you have the 30 greater than the 20, greater than the 10. So that's uptrend proper order. I'm sorry, downtrend proper order. So this was a market that was coming down and bottoming out, and those moving averages were still turning, were still technically an uptrend proper order, but they'd begun to turn up. And when they come together and spread out, again, it gives appearance of a bow tie. Very easy to recognize either through scanning or eyeballing. And again, we just need a 1 bar pullback. And in the case earlier I showed you, it was like just a higher high, but not a higher low, whatever the case may be. Here you have a lower low and a lower high. Again, a 1 bar pullback. And you want to look to get in above that bar, and again, give it a little wiggle room to avoid being triggered on noise alarm. So here's a live trade. This is CCL, Carnival Carp, and you can see that it wasn't making a whole lot of forward progress. It did break out, but then it came back in. So again, always look at your chart, okay? The bow tie moving averages came together and spread out, given the appearance of the bow tie. Notice that they went from uptrend proper order, which is bullish, okay, to downtrend proper order. Now, again, even though you had uptrend proper order, notice that this market had already begun to drop. So always, again, I can't emphasize this enough, look at the charts. And you can see it triggered an entry. There's the parameters. Again, you could look at these archives if you want, davelandry.com/archives, or you can go to my YouTube channel, youtube.com/Dave Landry. Anyway, you got a little bit of a pullback here. Entry was here. Stop was up here. And again, the stop placement, something that I won't have enough time to really get into today, but you can see way up here, if you short this market and it goes way up here, then obviously you are wrong and you might need to exit the trade. But anyway, I did hit that initial profit target. The stop was trailed down first to break even, and then we continued to trail it lower, and now the stop is right here. And this was the open portfolio at least a few days ago. We banked 1% profit, again, on a hypothetical 100K. And then the remainder, the trend following part of the position is at $1,200, better than a poke in the eye for now, at least. Now, this was a recent trade. Notice they made all-time highs. And again, notice the bow tie moving averages still headed higher, proper order, right? Notice this is bullish here still. But look at what happens in the chart. You made an all-time high, and then you drop fairly hard. And then you start chopping around. And again, that net price movement. So you've got about a month of trading here where this stock didn't do anything. Now, at a new high, again, getting back to that psychological thing of the players, all the players are happy because everybody's making money. But when that market begins to drop, they begin losing money. So you have the bow tie, and the market begins to pull back a little bit. The parameters are down below. Entry was here, stop was up here, initial profit target. Now this one dropped down. This is another one of those better than a poke in the eye trades, okay? We trail the stop lower and we got stopped out on the remainder, and it keeps you in the game. Now, don't just, like, I remember a while back, somebody was showing me something, and I'm like, that's kind of cool. I don't fully understand what you're doing. How long have you been doing this? It's like, well, I read about it this morning. I'm like, oh God, you want to do your due diligence. You want to find some setups that worked, but more importantly, you want to play devil's advocates and you want to find some setups that fail miserably. You want to make sure you're picking the best and leaving the rest. I kind of alluded to a few of those things: acceleration in trend, persistency in trend, and of course, you want to eyeball the trend and draw your big blue arrows. Make sure that the trend is significant and ideally persistent and accelerating, okay? I get questioned about stocks all the time that look like an electrocardiogram. If you come to the weekend charts, you go to davelandry.com/webinar and sign up there. Come to the weekend charts and you'll see a lot of people ask about stocks that look like electrocardiograms. And I realize you have to start somewhere, but work to find the best stocks as opposed to shooting anything that moves. So again, look at my archives. Now I'm going to show you something that a guru has never shown you, okay? This is a stock. This is what I call a TKO, trend knockout. You have a nice, in this case, accelerating trend. All of a sudden you get this big knockout move. Great pattern of trade, little simple 1-bar pattern, okay? Also was a Landry light pullback. Entry was here, stop was here. Initial profit target up here. We got long, and we were wrong and lost 1.7% or $1,700 on the entire account. So it happens. We did get a little bit of a dividend out of it, but not enough to make a difference, obviously. All right, real quick, we sort of talked about money management quite a bit already. The basic money management is you want to risk 2% on every trade if stopped out, okay? That's going to vary based on the volatility of the stock. Go in and look at those archives. I've got a little percent risk on each trade, okay? Percent risk if stopped out. Now you're risking 2% overall, but that might be 20% on some stocks and 15% on others, or even 10% on others. I tend to trade more volatile stops. Some of my best setups have like a 30% stop. Well, you're like, Dave, that sounds ludicrous. Even ludicrous would say that's ludicrous. It's like, well, if the stock, if 30% is only that far away from where the bar is and it's bouncing around 15 and 20% a day, then it's not that big of a stop. And I've had clients tell me, no, I didn't take that trade because I can't use a 30% stop. And it's kind of like the line from Caddyshack. It's like, well, you don't get no Coke. You know, that's what it calls for. So that's what you have to use. So the stop is going to be based on the volatility of the stock. If it's bouncing around 2 or 3 points a day and you go in with a 1-point stop, I can all but guarantee you're going to be stopped out. I've fixed, so to speak, a lot of people over my career by telling them to loosen your stops and trade fewer shares. And of course, get your stock picking, work on your stock picking too to get better at that going in, but then loosen your stop a little bit and you're going to catch more trends. Now we're going to take partial profits when the reward equals the initial risk. Now this is 1 for 1. Now the system designers get their panties in a wad when I say this because they're, I believe in 2 to 1 or 3 to 1 or 4 to 1. Well, let's say using 3 to 1, you're 3 times more likely to get stopped out than you already hit that initial profit target. Now statistics don't work a lot in markets and statistics are useless. 73.2% of all people know that. But that's one case where statistics do work. Again, if statistically it's bouncing around 2, 3, 4 points a day and you put a stop within that normal noise, I can all but guarantee you'll get stopped out. Now, you want to take partial profits on a 1-to-1 basis again, and the real money is made in the second loaf. So you might make 10 to 1 or 20 to 1 in that second loaf. It can happen. It doesn't happen that often, but it can happen, right? And if the trend takes off, again, you're still in. If it comes right back in, barring an overnight gap, then you only lose a small amount. Okay, and then you want to make that transition on the remainder by allowing the stop to slowly loosen over time. So when you start out, your trailing stop is more of like a stair step higher. It goes up 10 cents, you go up 10 cents. But once you hit the initial profit target, you begin to make that transition into longer term trader. And a lot of times it might not, It might be by doing nothing, okay? Let's say the market goes up 10 cents, 15 cents, whatever the case may be. Unless it's a really cheap stock, I call that keep the change. So I just leave my stop where it is. And another thing I'll show you in 1 second is, let's say you're blessed with like a 3-point move. You might only bump your stop up 2 points, okay? So you've opened that stop up by 1 point total, and you're gaining ground. So if you get stopped out, you're still gonna make more money than before. So again, that's a secret sauce. If there is a secret sauce to trading, stock selection would be number 1. And number 2, a solid money management plan, of course, the psychology to follow it. But letting that stop loosen up over time to capture the longer term trend can really, really help. I had a hedge fund manager once. I was on a project with him, and he announced the whole team. He's like, that's pretty cool what Dave's doing about making that transition. So I thought everyone knew this, but to me, everyone does it. Obviously, it's kind of the secret sauce to longer term trading. So again, you're going to let that stop gradually loosen up over time to catch a longer term trade. Now, we've now come to the most difficult part of trading, and that would be you. If you follow me, you know that I spend a lot of time talking about trading psychology. I know everybody's a setup junkie, so I talked about setups today, and if MetaStock is kind enough to have me back, I'm sure I'll talk about setups again then too. But the bottom line is you really have to get your psychology down pat. The bottom line is attitude is more important than aptitude. Eckert has a really good quote on that. And he basically says average intelligence is enough. He knows super smart people who can't trade to save their lives, and people who are not so smart who could trade fairly well. Like a trend following moron, I guess. Now, one thing that's hit me, and this was about 15 years ago, I was speaking in San Francisco, and Denise Shaw was speaking, she was talking about neurology. You can't make any decision without emotion. So people say, you've got to control your emotions. You have to eliminate your emotions. And I say you have to embrace them, because you can't make any decisions whatsoever, not even what you're going to have lunch. I mean, I'll give you an example. I looked in the fridge and the cupboard was bare. It's like we usually go do a little shopping probably this afternoon on a Saturday, but it's like, what am I going to eat before the webinar? So that was a very kind of emotional decision if you think about it. If I eat the wrong thing, like I ate something that's a little salty, so now I'm drinking water the whole time. So every decision down to what you're gonna have for breakfast is an emotional one. And if you start embracing all these little decisions in your life, you're gonna realize what an emotional being you are. Now, I've done quite a bit on how to fail at trading, and things aren't brought about by thinking about the opposite. But a lot of times you have to understand, you have to have that, what are they words, a negative capability, or I forget what it's actually called, but I've done presentations just on that in and of itself. I want to say it's negative capability, like anything can happen. So you have a fight with your wife or your girlfriend or both, okay? If you have both, you might not want to be trading. You got other problems, but you'll find yourself influenced by like, oh, I'll show her. You'll go in and short a market that's going up or whatever because you think you're smarter than the market. Lots and lots of extraneous influences. A huge part of trading is identifying those. I used to make a trade every time I walked in the office and I couldn't figure it out, and I'd lose on a trade. I'm like, why am I doing this? And then I probably reread the story of their Israeli judges who were giving very harsh sentences right before lunch, and then very lenient sentences after. This was the what do they call that? I can't think of the guy's name on the fly, but you could Google it. It's the hangry judge effect. Dan Ariely, I think is the guy's name. So what I was doing, and I have a little bit of a sugar problem, not diagnosed. If I don't eat, I tend to be an a-hole. Sometimes my wife's like, "Do you need to eat?" And even if I just ate, because I realize she's basically calling me that, I'm like, "Oh yeah, I better eat something, baby." Hopefully that made sense. Anyway, the bottom line is, when it comes to psychology, in 5 minutes, you know what you're doing wrong? You know what you're doing wrong. And my favorite story there, and let me see if I give you the Reader's Digest. I've told this 1,000 times, but I had a client was trading my service, and he said, he's a Italian guy from Pennsylvania, tough little Italian guy. And he said, "Dave, I can't make any money." I'm like, okay. I looked at my charts and my stuff and everything. It's like, okay, well, not a great period, but you should be making a little money. He goes, no, I can't make any money. He insisted that I look at all his trades. I'm like, well, it's for educational purposes only, and we're not supposed to be doing this. He goes, you need to look at my trades. And so I spreadsheeted all his trades, and he made money. He followed everything to a T beautifully, and he made a little money, not enough to brag about. It's one of those choppy periods where you make a little, lose a little, and so on and so forth. No big trades were caught, but he was up by a few $100s over a few months. And I said, okay, I got good news. You actually made money following everything to a T. You did a great job. However, you took these 20-day trades. It was in Continental Air, which no longer exists. And I said, you lost $5,000 on those. And before I could finish, she said, I know. So a lot of times, you know what you're doing wrong. And it's like the old doctor joke. It hurts when I do this. And the simple solution is don't do that. So in summary, you want to find something simple, study the heck out of it, please. You want to pick the best and leave the rest. Persistency, acceleration, all those things I talked about earlier. Use proper money management, and make sure you identify and separate the extraneous from your trades. If you need money, sometimes it's a bad time to be trading. If you have money, you might get a little careless. Like Tom McClellan's late mother, Mary McClellan, once said, paraphrasing, some people, everybody uses timing in their investing. Some people buy when they have money, some people sell when they need money, and others use more sophisticated methods. So that's it. May the trend be with you. There's all my contact information. I just started a Substack, by the way, and I'm really liking that. So please subscribe to that. It's free. At least there's free stuff there, and there are some paid advantages too. But there's a lot of good free stuff there to check out. Okay, we've got a couple of minutes. Jeffrey, you want to shut things down, or we have time for a question or two? Or
we don't have a lot of questions. We did have somebody that said thank you kindly.
Okay.
Randall wanted to say thank you very much for being in there. And we've got the links. It's interesting. You're the second person I know that's got on Substack. Why do you like Substack?
I like Substack because it's a platform, from what I could tell, and I'm just scratching the surface, but it's geared for the writer, for the content provider, as opposed to like Facebook or YouTube or whatever, which has got geared for them to make money. This platform is to encourage you to do things and to bring your clients to the platform, as opposed to they keeping the clients. Like if I make a mistake on YouTube and they shut me down, God forbid, I lose every single one of those subscribers. Whereas on the other platform, they're my subscribers to begin with, and any new subscribers that come along become my subscribers. So it's a good way from a content provider's standpoint. It's also a good way for somebody who consumes the content because of the delivery through the app and everything else. It's just really neat.
Cool. All right.
Yeah, you guys need to get on it for sure. Absolutely.
Let's see. Dave, want to say thank you for coming, joining us on a Saturday. Thanks for the methodologies that we put into MetaStock because of you. All of the methodologies you showed today are just part of MetaStock. So that's very, very cool. Thanks again.
Thank you, Jeffrey. Thank you so much.
All right. Let me go ahead and make me the presenter real quick. I'm going to do this, show my screen. And we'll just make sure that the correct screen is being shown. Let's see. Thanks again, Dave. All right. Okay, let me do, okay. Oh, yes, okay. Reg says, great webinar. Reg says, I want you to say that if you want to know what to eat prior to a webinar, I suggest ice cream. It has all the essential nutrients and is not necessarily salty. Good advice, I'll try that out. As kind of David talked about, all of his methodologies, they're included as part of MetaStock. They include expert advisors, their scans, everything in there. And all of that is just provided as part of the subscription. We've been talking about MetaStock all day. We've been talking about scanning markets, testing trading ideas, forecasting probable price movements, the real-time alerts, commentaries. MetaStock's been rated the best software in its price category for 32 years in a row. Pricing on it starts at $75 per month. That includes intraday updates and the ability to scan the market during the actual day. You can go to metastock.com/promo to do that. You can call us at 800-882-3040, and you can also go to metastock.com/saleschat. Greg, Lewis, are you around? Are you available?
I'm here. I'm available. I'm here for you, Jeff.
Reg said, "Hey, that was a great webinar." We did have a question about how when are the recordings going to be available? And I was going to answer that, but since I brought you on here already, let's go ahead and have you answer that.
Oh, yeah, they're available right now. We record this as it's happening on YouTube. So if you are watching this and go to webinar, the best thing you can do if you want to see the recording is go to youtube.com/metastock, and you'll see a playlist there for all 6 days of this event.
I'm going to give away this book.
Ooh.
Now, just so everybody knows, if you're watching us on YouTube, if you're watching us on GoToWebinar, you're already eligible to get the book or prizes, to win prizes. If you're watching us on YouTube, there's going to be a pinned comment at the top. We have about five more prizes, maybe 4. I don't know. We have a few more prizes to give away. Make sure you get registered so that you can get on the list. This book right here was written by Steve Bigelow, the late Steve Bigelow, great friend of MetaStock, huge technician. Talked a lot about candlesticks. It's called Eliminating Emotions. Greg, what I need from you, I'm just going to kind of go over to my list of registrations here, and I just need you to pick a number between 1 and 6,937.
All right, 6,937. According to Google Random Number Generator, that's a high one, 5,947.
Okay.
5,947. I see that Lewis is already logged in and ready to roll, so Lewis will be with you in just a second. You can stay right there. Don't go anywhere.
Yeah. You're welcome. Smile, though. You're on camera. Yeah. Miro P in the USA just won that. So I'll make a note of that as soon as we get Lewis started. Greg, as always, appreciate the assist. Good to have you. All right. Lewis is going to come and talk. We've talked about the CMT Association. We've talked about it all week long. CMT Association. Lewis would probably talk a little bit about how if you want to work for a bank, having a CMT designation after your name might help. If you do work for a bank and you want to have more assets under management, having a CMT designation might help. If you want more responsibilities, a CMT. If you just want to feel cooler, a CMT designation might help. So CMT Association has been a partner of MetaStock. They've sponsored our seminars that we do, our conferences that we do for several years now. Very, very well respected, very well reputed organization. So it's Lewis's first time. We usually have Tyler in here to talk. So I'm very interested to see kind of the differences. But I have some information about him. He serves as the curriculum director for CMT Association. He led the rewrite of the launch of the 2025 digital curriculum. He works for a boutique wealth management firm in New Jersey. He's developed his technical analysis expertise through years of deeply committed study and hands-on experience. So that's what I'm going to say about you, Lewis. Lewis, welcome to the room.
Well, thank you so much. Can you hear me?
I can hear you, yeah. And I'm going to send, do you have any experience with GoToWebinar?
Watch me, man.
Okay. Well, I just made you the presenter, so I should just pop up a thing and say, do you want to share your screen? It's really easy.
Oh, beautiful.
And you've got everything figured out so far. Your audio is working, your video is working. And now I can see, I'm not sure you're sharing the screen that you mean to screen because I do see your Outlook. But it could be that you just want to maximize your PowerPoint. I also see an email from me.
How do I change the screen?
Okay, so on the console, there will be like the yellow box or the gray box. On sharing, if you click on the sharing button, it'll expand down. I think you already did it.
Yeah.
I think we're seeing exactly what you wanted to show. So your slideshow starts with our banner. You're ready to go.
Ooh.
All right. I'm going to go ahead and get out of the way. It's your turn, Lewis. Thanks for joining us.
Thank you. Well, hi, everybody. And thank you to Jeff and MetaStock for hosting this event. It was really great to see Dave's presentation and all of the other terrific speakers. So I'm Louis Spector, and I'm the Curriculum Director for the CMT Association. And I want to share with you timeless market principles and helpful tools. And I hope that they're going to help make you better traders and smarter investors and more confident decision makers. So the CMT Association, CMT stands for Chartered Market Technician, and the association itself is a global credentialing body. Our mission is to advance the discipline of technical analysis. It's an art and a science. It started in the 1960s by just a few technicians, I mean a handful, and we've evolved into a global association. FINRA recognizes our curriculum and our exams, and earning the charter itself, it's the gold standard. It's, you know, technical analysis, education gold standard. So I wanted to ask everybody, especially lately, how often have you been hearing this has never happened before, or this is unprecedented, or this is a crisis? Well, I consistently hear these things. It feels like multiple times a day. And Mark Twain is credited with saying, history never repeats, but it often rhymes. And this is a good thing for us because most things have happened before, just not in our lifetimes or even in our parents' lifetimes. But it's likely all happened before, and this is good news for us trying to understand markets. So here's a crazy chart I found online. So let's look at this blue line. This blue line represents the average tariff rate, the percentage average tariff rate, going back to 1820. And I put two charts together. This red line is a continuation of the blue line. So here we are today in 2025. And so tariffs have never been this high. That's what I'm hearing on the news, friends, family. So today it's around 14.5%. But look, in the 1930s, it was 20%. In the 1890s, it was 30%. In 1865, it was 45%. In 1830, it was 55%. So tariffs have indeed been this high in our history. So just that's all. What about inflation? Inflation's out of control. Inflation's unprecedented. Here's inflation going back to 1913, the year the Federal Reserve began. Here we are in 2025, and so we had some inflation. But look at it in the 70s. Look at it in the 40s. Look at it in the 19 teens. Yeah, we have inflation. Gas prices are higher. Supermarket prices are higher. But is it unprecedented? No. What about this country has never been so divided? So in 1800, our fourth presidential election, Thomas Jefferson, John Adams. In a newspaper, a Connecticut newspaper, they wrote, if you're planning, to the people voting for Thomas Jefferson, are you prepared to see your dwellings in flames, your female chastity violated, and your children writhing on a pike? This was in a newspaper. Well, it appears they were. Thomas Jefferson won the election. Some years later, in 1828, the 11th presidential election, Andrew Jackson and John Quincy Adams, the son of John Adams, Jackson supporters, they accused John Adams of being a pimp, you know, in the newspapers. And on the other side, the Adams supporters wrote of Jackson that his mother was a prostitute, his father a mulatto, which is a slur, look it up, and his wife a bigamist. So mudslinging and division has been a part of history forever. Oh yeah, AI is going to destroy humanity. All right, so what's my point? My point is that things usually feel unprecedented, and that's okay. We can still operate successfully, especially by studying technical analysis. So a lot of things have happened in financial markets over the years. Shift to electronic trading, phasing out the specialist system, going all electronic on the floors by 2016, decimalization in 2001, high frequency algorithmic trading, the ETFization of markets, zero DTE options, circuit breakers, retail, all of this stuff. The more things change, the more the things stay the same. History does not repeat, but it often rhymes. And so human behavior is a constant in life and in markets, and studying that is what's going to give us an edge. So how will this help us make money? How is this going to help us create a better life? Well, the answer is the CMT Association. Well, really, it's studying technical analysis. It's studying human behavior. And what is technical analysis? That's a great question. Professor Damodaran of NYU, he is a fundamentalist. He writes for CFA. He lives and breathes discounted cash flows. And he emphasizes the distinction between these drivers of intrinsic value, fundamentals, cash flow, management, growth, market share, margins, all the fundamentals. And then he discusses market price. And market price is derived from human behavior. It's different from the fundamentals. So, drivers of market price. This is what market technicians study. So to go into a little detail and express it in another way, Ralph Acampora, one of our association's founders, he's been teaching at the Institute of Finance in New York for 50 years. He explains it this way. He says we've got the fundamental data, price ratios, price to book, price to sales, price to earnings. We've got the balance sheet and the profit and loss and the cash flow statement and management and return on equity and margins and products and competitions. And then we have the stock. This is the market data that technicians study. Supply and demand, volatility, risk management, price volume, human psychology. And together, this makes up the whole picture. We've got the company and fundamental data, and we've got the stock or market data. And it doesn't have to be a stock. It could be other asset classes. Fundamentals and technicals, it's two sides of the same coin. And together, they offer a complete picture. So what is technical analysis? It's the systematic evaluation of market data generated by human behavior. And that's the key, is that all of this is generated by human behavior, which is unchanging through time. The more things change, the more they stay the same. And we use it to assess the probabilities of future market behavior. So tune out the noise and the news and our biases and focus on price. Focus on price, which is essentially human behavior. And as Ralph Acampora says, price is a fact. We restate earnings estimates. We revise price targets. We update unemployment numbers. But price is never restated. Price charts don't change. I mean, maybe you have a split or a dividend payout, but it's all the same in relation to each other. Price is a fact. And in price, there's knowledge. So I want to now share with you some things that are going to help you be better traders, better investors, better at understanding human behavior, your own, others, your families. So hopefully these ideas are going to help you to understand markets, create a foundation of knowledge, remove guesswork, and assign probabilities, because that's how markets operate, on probabilities. And it's going to help build a sustainable and disciplined approach to markets And as Dave was saying, we have emotions. You can't block them out. You can't ignore them or pretend they don't exist, because they do. But you can still acknowledge them and operate in a way where they're not driving your behavior. They're informing your decision, but you're still making a logical decision. So first principles, these are core concepts which remain consistent. It doesn't matter if a trader was trading in the 1890s, 1950s, or 2025. It's still human behavior. It's still supply and demand. It's still human psychology. It's still risk management. You can get a trade right. You can have profit. But if you give it all back, where's that risk management? So it's really important to trading, to investing, to everything. And then some first principles also include your data. If you're doing data analysis, or if you're just looking at market data, you have to really understand the details. Here's an example. I saw a chart on X, and someone was showing market breadth, but they had weekly price action, and the breadth data they were showing was daily data. It wasn't the aggregate of everything that happened in the trading week. So even though they clicked weekly, the actual data series they were showing wasn't the weekly data summed. It was just the data for a Friday. So we have to really understand and make sure we're looking at the right thing, and that the data is answering the question that we want to question. Charles Dow, I'm sure everybody's heard of him. Charles Henry Dow, he's the original trend follower. So he's a co-founder of Dow Jones and Company, started 1882. They published all sorts of things, not just financial publications. But they started the Wall Street Journal, or he did specifically in 1889, and he was the first editor. And he never created Dow theory. Instead, it's based on editorials he wrote. And Robert Ray and William Hamilton went back and looked at his work. And here is, I know it's not the greatest picture, but here's the first ever issue, July 8th, of the Wall Street Journal. And over here is where he's presenting the stock prices of the Dow Industrial Average that he created. You see, before him, nobody thought to plot the market trend as a whole. They charted market prices for individual companies, but he really said, wait, let's find the trend of the market. And he also shared first principles of trend, higher highs and higher lows. That's how price stair steps higher, and lower lows and higher lows. And he called them lines, which we would call rectangles or consolidation zones. He was the first to really bring this stuff to light. He also talked to us about multiple time frames. I mean, this is 1900, 1901, 1902, and he's describing primary trends which last months to years, intermediate term trends which last week to months, and the minor price movements which he thought were pretty insignificant, which for him could be days to weeks. But now we've got intraday data. We can go down to tick data. He also described markets as discounting mechanisms where they lead the economy. The stock market is a leading economic indicator. The National Bureau of Economic Research, when they're looking at recessions and all that stuff, markets go first. Markets lead the economy. And the idea of confirmation. He wanted his industrial average and transportation average to confirm each other. He also discussed how volume would confirm price. And something that we still do to this day, we assume trend continuation, that trends are going to persist until we see a reversal signal. And Dow theory is not infallible. We have to think in probabilities. Another pioneer, another legend, another first principle himself, Richard D. Wyckoff. So Dow was the original trend follower, and for me, Wyckoff was the original market technician. Living legend. celebrity. He was a celebrity. He published a magazine of Wall Street, which had over 200,000 subscribers. And it's because he was really accurate. And he wrote a book which everybody should read. And here's a first signed edition of the book, only $12,500 if anybody wants to pick it up. And here are some magazine covers. I just thought it was really cool to see these early publications. And what did he talk about? He talked about market structure. I'm gonna share a little more about what these things are next, but they're so important. Accumulation and distribution are lines, are consolidation areas, and he's got schematics for these things. He also came up with the composite operator, and for him, market price and averages, it's the sum of all attitudes, hopes, expectations on all time frames. So his idea of the composite operator, and price ranges, analyzing, is this accumulation? Is this distribution? What's happening? He also came up with the law and cause effect, or at least he stated it. So today we hear the bigger in base, the bigger the base, the higher in space, or the larger the top. The bigger the top, the larger the drop. And this came from him. He was estimating price targets based on these bases using point and figure methods. So here's his schematic. Accumulation. Markup is a trend, distribution, selling, markdown is a downtrend. So accumulation, what happens here? Well, this is where large institutions establish positions. The smart money's buying. The public doesn't care. It's doing nothing. We have upthrusts and springs and shakeouts, and it goes sideways. Brian Shannon, he likes to say, if they don't wear you out, they'll scare you out. That's what happens in these trading ranges. Price action sideways, supply and demand are in equilibrium. The composite operator is buying. Price breaks out, and we have uptrends called markup or accumulation, reaccumulation. All right, so price moves higher in these markup, in these uptrends, and the public starts participating. Hey, have you seen this stock? It's going up. It's, it's rocketing higher to the moon. Classic uptrend. And the shares are generally that are being purchased are generally being sold by the large institutions that bought them all during the accumulation phase. And these guys are selling into strength. Guys and gals are selling into strength. Classic uptrend with retracements. Sometimes there's periods of reaccumulation where price will go sideways before continuing higher. Here, supply is weaker than demand. Demand is stronger than supply. Then we've got distributions. We've got tops. And large institution, by the time we get here, the institutions have sold a lot. They've been selling on the way up. They're taking their final profits here. They sell to the public. The public's in a frenzy and want to buy everything, and the people that cut your hair are telling you to buy, and the cab drivers and the doormen, and the general public is pumped. By this time, it's generally too late. And so price is going sideways, supply and demand are equilibrium, and then we have markdown. Price breaks down and starts trending lower. Now, the public that just bought all the shares from the institutions, they're losing money, and they begin selling. And maybe the CEO has gone short, and they're short covering rallies, and they're violent. And price continues lower, and the public panics. And that extreme panic generally marks the end of markdown or another period of accumulation. So this structure happens on all time frames to all charts. Here's an example. Here's the weekly bar chart of Royal Caribbean up till its price action for this week. Here's a sideways range. Here's a fast markdown into COVID. Here's a range, a big shakeout, back into the range, false breakout, drive lower, and then finally we get this breakout into a markup phase. What's happening now? It's too early to say, but it looks like either a reaccumulation, potentially distribution. Here's another weekly chart of Boeing. The average is a 40-period moving average. It's essentially equivalent to 200-day. Institutions believe that they just quickly look at that to get a quick gauge. Is it going up, sideways, or down? Long-term trend. So here's Boeing. I mean, this is a more than 2 year sideways pattern. It's an accumulation period. There's a false start. Here's a false breakdown. And we got this giant markup phase. We've got a little sideways high tight flag. We ran a range, false breakout, boom, the COVID markdown. Here's the daily chart. I wanted to go back so we didn't see the same pattern with the COVID breakdown. Here's 2003, big markup. 2004, quick range. I mean, by quick, we mean 6-7 months. Big markdown phase, a reaccumulation range, and markup again. So understanding where we are in these giant phases, even if you trade on a 5-minute chart, check out the bigger trend on a daily or an hourly or a 240-minute. You want to understand what is happening big picture and then zoom down and trade with the trend. That's where the profits are. So the big takeaway is understand the phase on the larger time frame, zoom in and trade with the trend. Next we have John Bollinger. Here he is. This is us on a trip to San Francisco for a retreat actually just 2 months ago. He's a living legend, and he was in the first group of CMT charter holders in 1989. And because he already had a CFA, he was the first dual charter holder in existence. So John Bollinger, we've got work from him in all 3 levels of the curriculum. And one thing he teaches is 2-bar reversals. And I want to share this with you because it's really helpful. This is mean reversion trading. 2-bar reversals. So price closes outside of a Bollinger Band, either the upper or the lower, and then the next bar, boom, closes right back into the Bollinger Band. Those are the 2 bars. It could happen on a weekly, on a daily, on a monthly, on a 1 minute. So 2-bar reversal, price closes outside of a band. The next bar, it closes back in the band. Does anybody have a guess about the biggest question I hear about Bollinger Bands? It's how do you know what to do when price touches a band? Is it mean reversion, trend continuation? So let's take a look. 2-bar reversals. So this is a daily bar chart of the triple Qs. This is current price action 2 days ago. So 2-bar reversal. Here we see a bar close outside of the upper Bollinger Band and then closed right back in. So here is a 2-bar reversal. It looks like I may have skipped a slide, but let me just explain this. So here is underneath is an accumulation distribution oscillator. This John explains in the curriculum. I'm not going to tell you exactly what it is because I want you to write me or to sign up and take a look at the curriculum, but it's measuring supply and demand. It's using volume. And so when price closes above the upper band, closes back in, we want the money flow here, the accumulation distribution to be negative. That's going to give us clarity and confidence that price is going to go down and at least touch that middle band. Here we have price closing below, right here, the lower band, and then price closing back in the band. This was a monster bar. And price accumulation distribution was positive, showing in confirming the idea of a move higher. Now this was a rocket ship, but even if you didn't trade it, it would have given us some idea that, okay, maybe it would help us make a market call. We could expect prices to move higher the next few bars. So the previous example showed a touch of the bands, foreshadowing mean reversion. So we had that accumulation distribution oscillator to give us a little confirmation about that. When is it a continuation signal? Well, you may have heard of Wells Wilder. He developed an indicator called the ADX line, and the line moves higher when the trend is strengthening. When the uptrend is strengthening, the line moves higher. When the downtrend is strengthening, the ADX line moves higher. And in the curriculum, John Bollinger tells us that when ADX is greater than 20, it's a trending environment, and when it's less than 20, it's a non-trending environment, and touches of the bands in a trending environment will likely be the start of the move higher or lower, whereas when ADX is below 20, touching the band will likely be a mean reversion signal. As always, he tells us wait for confirmation, use a stop loss, risk management. So here we are, a daily chart of the Qs, 20-period Bollinger Bands, our accumulation distribution oscillator, and an ADX line. I would bet you this is in MetaStock. And once you know what the accumulation distribution oscillator is, I'm sure you can program it very easily. So here we go. We've got a close outside the lower Bollinger Band, a close back inside with a negative accumulation distribution oscillator. Here was a mean reversion to the band. Now, ADX, this line is the 20 line. So if the green line is higher than this horizontal 20, you'd expect trend continuation. So we had that. We had a touch, and here's a touch and a touch. And listen, this wasn't perfect. No indicator is perfect. We had mean reversion here. It's just not perfect. But here, ADX is above 20, and we get a touch of the bands. Accumulation distribution oscillator is negative. We get a touch of the bands, negative. Touch of the bands, negative. So touch of the bands here, price was walking down the bands. The oscillator was confirming that with a negative reading, and greater than 20 was also confirming that. Here's a little nuance, and this would have been really hard to pick up in real time. Price closes below the band, and then here's a lower closing low, but price is back above the band. That's a positive divergence. But it would have been really hard to get long there because accumulation distribution was negative, and price was, and ADX was higher than 20. So that was a tough spot, but you know, nothing's perfect, and trading is all about probabilities. Here's a great example of a touch of the band, and this is not a 2-bar reversal because the oscillator is positive. So here's a touch of the bands with positive. We would expect trend continuation. Here's a touch of the bands, touch of the bands, and as these are touching the bands, ADX is rising and lifting above 20. So the takeaways: recognize the environment. If ADX is greater than 20 or 25, we're trending. We're likely to have trend continuation. If it's below 20, price is likely going to be mean reverting, and those type of signals will work better. And this is also an example of using indicators that avoid multi-collinearity. That's a big word to say things that do the same thing. Multi is many, co is together, linearity same. So the point is, if your chart has an RSI, a stochastic, and a MACD, and a rate of change, you're looking at the same thing. But John, Bollinger Band is volatility. Moving average is trend. Accumulation distribution is money flow bringing in volume. And ADX is strength of that trend. So when you're thinking about using trends and developing your style and your systems and understanding the market, you want to make sure you're using indicators that give you different information. Brian Shannon, you probably heard of him. He's one of the world's greatest living traders, and he's known for popularizing the VWAP and AVWAP. He also wrote for the curriculum in 2 of the levels, and he shares about trading with these tools and how institutions use them and how we can use them. Here's the daily chart of Uber. One thing about using an AVWAP or a AVWAP is where to anchor this to. If you anchor to previous highs, what you can do is buy break above them. Brian Shannon, he always talks about don't buy the dip, buy strength after the dip. And this is a great way to find strength after that dip. So price was moving higher, we had a high, you know, price comes, oh, that was a significant high, let's anchor to it. If we got long here, it would have been a whipsaw. But anyway, price was moving down. This was about the time where the S&P 500 bottomed. So big breakout, get long. We would have been really happy for a month or so. Here's a high, and we could anchor to there. Boom. Price breaks above it, strength by strength after the dip. This also would have been a spot to get in if you hadn't gotten in here. Price continued higher for months. Price starts to pull back. We already and we saw a high, so we anchored to the previous high. This was already on our charts. Brian describes this as an AVWAP pinch where they're coming together. Boom, break above, get long. So we found some support here at this AVWAP, but price made a lower high. These are lower highs. So this would definitely put us on warning that we're in a larger range. We kept finding support, you know, from this line we had drawn months and months ago. But then we see a break below. You'd sell some of your position, if not all, on this break, and then some again here. Then we had an earnings gap, and now price has gapped above both of these lines, which we've had on our charts for 1, 2, 3, 4, 5 months. And this would have been a great buying opportunity. So one great way to use the AVWAP is to anchor from big important highs and buy strength after the dips. Okay, here we go, NVIDIA. Daily bar chart. Here's NVIDIA's previous all-time high, and it doesn't matter when. This was the bear market in the S&P 500, anchor to that high. And when price finally broke back above that high after that big low in the market, this would have been a whipsaw probably, but we're persistent. We trust our indicators and our process. Look at this bar. This would have been an incredible buying opportunity, and finally price gapped up. And this would have been where traditional breakout traders buy. So using an AVWAP anchor to previous all-time highs is a great way to get you in early. We would have had 80% gain. We would have, from this bar, this close to this gap up, we would have been ahead in this trade 80% of where classical breakout buyers would have taken notice. So price continued higher, and here we had an important high. We would anchor to there. We would also anchor to an important high, our breakout, and price was range bound, ranging for a couple of months. Price never closed really below this low, so nice range, pretty clean range. If price gapped up here, if we bought here, it would not have been wrong. It would have resulted in a whipsaw, but our methodology was sound. We would have gotten back in here. That would have been a great spot. And by the time we had our traditional breakout, we would be 15% ahead of the traditional breakout buyers. So another great use of the VWAP is to anchor it to all-time highs and by strength above it ahead of the traditional breakout. So anchor to swing highs or all-time highs and by strength after the dip. These are incredible lessons from Brian Shannon. I want to touch on behavioral finance a little bit because it's so important. We can't push our emotions away, but we have to be aware of them. And we have to be aware of others' emotions and be able to read them in the chart because it'll give us an edge. When we understand how others are feeling, we can do the right thing. Buying, selling, or holding, it's the heart of what we do, whether we're investing for the long term or trading on a 1-minute chart. When do we buy? When do we sell? When do we hold? It's the heart of what we do. And this decision requires an understanding of both price action and human psychology. Let me ask you, here's an investing decision. 100%, you're going to get $55,000. That's choice A. Choice B is you can get $57,000, but it's got a 90% chance. Are you going to choose A or B? Are you going to take the certain gain, or are you going to take a little bit of uncertainty for a bigger gain? Second investment decision, second choice, you're going to lose $55,000. You are 100% going to lose, ouch. Or you have the option of losing more. Instead of 55, you're going to lose $57,000 with 90% certainty. Which are you going to choose? Did you choose 1A and 1B? Be honest, which are you going to choose? 1A and 2B are the natural choices. And you know what? This is okay. Let me explain. It's human tendency to be risk averse. We prefer gains over losses, and we prefer sure things over probabilities. We would rather, in choice one, in scenario one with the two choices, 55,000 for sure or 57,000 plus with a 90% chance. Most of us want the sure thing. And taking this sure thing, well, it's not risk seeking, it's risk averse. And taking it a step further for choice B, we would prefer to take the 90% chance of losing more than the 100% certainty of losing less. So what am I saying? How does this translate to trading? We have a gain. Our natural tendency is to lock in that gain. I'm back to break even, or I'm 5% ahead. We are being risk averse with our gains. And when we have a loss, have you ever been this where you have a loss and you don't sell? You say, this is going to come back. I'm going to hold till it breaks even, till it comes back. Well, that's risk-seeking behavior. That's the equivalent of taking the 90% chance of losing more than taking the 100% chance of losing less. This comes out in our trading and decision-making throughout the day. Our friends, our family, ourselves, all day, okay? So understanding that this is how we're programmed to operate can make a world of difference. It'll help you let your winners ride, and it'll help you cut your losers faster. Understand that your first choice, your instinctual decision in terms of logical probabilities is likely to be wrong. And it's okay. Recognize it is going to make us better at trading, investing, and decision-making in general. Daniel Kahneman, the Nobel Prize winner, Thinking Fast and Slow. We also discussed it in the curriculum. You should check it out. Okay, it's essentially understand our tendencies in order to make better decisions in markets. Biases are thinking errors, okay? We can group them into 3 categories. Belief preservation. This is where we tend to cling to the default or the easy answer. Information processing. This is our tendency to not react appropriately to new information, to hold on to old beliefs, etc. And then we have emotional biases, and this is our tendency to be irrational, frankly. Okay, I'm going to give you 2 examples of each one, and hopefully this will just get you excited about this kind of information and help you make better decisions. Confirmation bias. This happens all the time. This is where people have a belief before doing the research. And this belief before doing the research shapes the research. So instead of considering the evidence, we look for information that confirms our belief. It confirms the belief we want to be true. We ignore or undervalue information that is contradictory to our belief. So we believe stock Y is breaking out, and we get long, and we want to get long. Here's the breakout. There's a small bullish candle. The candle was confirmed by volume, so we've got a breakout, we've got some volume, but we've got an RSI divergence. We've got a MACD that's flattening and starting to roll over. And we also have overhead resistance where we've got this little breakout, but there's a lot of overhead supply. So we buy the breakout anyway. It's because we're letting the evidence that confirms our desire to get long overwhelm the other evidence that's contradicting our belief. This happens so much. Confirmation bias, where we look for information to justify our belief and we underweight evidence that is counter to our belief and our desire to act. This is cognitive dissonance. Cognitive dissonance is when things are not making sense. We have contradictory information, and we go to great lengths to get rid of that dissonance, whether it's ignoring or overweighing, giving more weight to just certain pieces of the evidence. All right, so we've got a breakdown. We're long and we get a breakdown, but we don't exit. We don't exit. Oh, this is a healthy, normal pullback, or we zoom out. Oh, it's fine on the longer term time frame, and so we feel discomfort of not acknowledging we're wrong. So we make up things and justifications to remove that cognitive dissonance between us being wrong and the distance between us wanting to be wrong or to be right. So cognitive dissonance, we do crazy things to justify situations where logically that's not happening. So markets behave in probabilities, and that's uncomfortable. So embrace the cognitive dissonance, embrace your emotions, and say, there's something going on here. This extreme emotion is telling me I need to be more logical right now. I got long, price broke down, and maybe it's okay on a longer time frame, but I'm a shorter term trader. I need to exit this now. Information processing, recency bias. This goes back to all those charts I showed in the beginning. Inflation's out of control. The mudslinging and campaigning has never been this dirty. And it has, just not recently. Recency bias is the tendency to overemphasize recent events. Okay, so we've got a sharp price decline, and we sell. And we sell everything. We sell our short-term positions. We sell our long-term positions. We sell everything because of a short-term movement. And we're making long-term decisions using short-term data. And this is recency bias, or an example of it. Recent things we remember more, okay, but also weigh things that haven't happened recently. US outperformance. I'm sure everyone's been hearing about that. Is this a turning point? Well, don't overweigh recent actions. Weigh all the actions and make decisions in real time. Don't let just the recent past guide your decisions. Anchoring bias. This happens in negotiation all the time, where someone throws out a number and now you're negotiating around that number when that number might not have any bearing on what you want to spend, on what it's actually worth. You can anchor when you buy, when your buy price, that's your anchor. Everything for you is about that buy price. Are we above it or below it? And you zoom in, you stop considering the big picture. So anchoring, it's a phenomenon. It's so real. So price bounced from 63 times. We've got a horizontal line at 60. Price came down and touched 63 times. And now it comes back and we say, okay, 60's been holding for the last month. It's going to hold here. And then it doesn't. And you weren't wrong for getting long there because it's good probability. But it's you anchoring to that. Maybe if you zoomed out, you would see that that 60 level is less significant than you thought it was. So be careful. Don't get too caught up in just recent price action, and don't get too caught up on one price, on a price that's important to you for whatever reason. We've got emotional biases, and these are the tendency to react irrationally. Loss aversion, this is what I was talking about earlier, where we prefer to, we are risk averse to letting our winners run, and risk seeking when we're at a loss. We want to hold on until it comes back. So it's a paradox, but it's real. I'm going a little faster. I see we're running out of time. Overconfidence bias. This is when we view ourselves overconfidently. When we win, it's because we're skilled. When we lose, it's because we're bad. The luck is bad. It's not that. It's probabilities. You can make the right decision and get a bad outcome, and you could make a bad decision and have a good outcome. So don't be overconfident. When you win, it's not because of your skill. It's because of probabilities. And when you lose, it's not because of bad luck. It's because of probabilities. Trading is about probabilities. It's about skill and luck. Okay. It's always a combination of probability and luck, skill and luck. So I could talk all day. I'm going to stop here. I could rave about how awesome the curriculum is. I could share more from the curriculum. I could tell you it's the best decision I ever made was to pursue the designation. But I want to tell you instead how you can learn more. So the best source of TA education is the CMT program. We've been around for 52 years, and it's backed by decades of research. The exams are psychometrically analyzed. We're recognized by FINRA. If you pass levels 1 and 2, it's an exemption to the Series 86, which is required for financial analysts in the entire country. And the program, it's not just theory, it's practical, it's hands-on. It's a roadmap for succeeding in trading, in investing, in thinking. So the program, it's self-directed. You study on your own, and you're going to master the basic knowledge of TA if you study. And then you pass the exams, which are offered every June and December. You have to have professional work experience, and you apply for professional membership status. cmtassociation.org. There's exams in a few months, but you can, the December exams would be what would be of interest if you're going to pursue level 1. And here's the opportunity wheel. And you could do so much with a charter. You could work for a bank. You could work in education, in tech, RIA, hedge fund, pension, mutual. You could do research. You can be in media. It is so applicable to such a wide wheel of diverse applications and professions. So it can open doors. It's a differentiator. It'll give you knowledge to position your investments and your career for success. And it's incredible. You can use it with fundamental, if that's what you've been doing, with macro, with quantitative. It's a complementary tool set. And if you want to get started, listen, even if you're not sure about, do I want to do the whole thing? Do I want to earn my charter? You can still join as an associate member. You don't have, it's no commitment. You just join. And then you get all of the educational materials, the entire curriculum, which we call the reference library, just as an associate member. So all you have to do is sign up and you could view and study the entire curriculum on your own, even if you don't want to pursue the exams. You'll also be able to attend all our meetings and events, and you'll get the Journal of Technical Analysis and the monthly Technically Speaking. So consider being an associate. You get the whole curriculum, and you don't have to study, you don't have to take the exams, there's no commitment. cmtassociation.org. Our next event, we just had one in Tampa in January. We had one in San Francisco in March or April, and we had another in New York City last month, and we've got a global conference in Dubai in September. So those are really cool. cmtassociation.org. So thank you so much to MetaStock. Thank you so much, Jeff. Thank you for everyone watching. And visit cmtassociation.org. Here's my email. If you're going to sign up, send me an email. I'd love to make sure you have full access to everything. Happy to answer any questions you might have. So that's the end of my presentation. Thank you so much.
Thank you. I liked the tariff chart. That was particularly insightful. We don't have a lot of questions for you, Lewis, but Ezra said great insight, and Walter says great event. Thank you very much. So thanks for being here.
Thank you so much.
All right, we can do this.
Lewis, this is Norman Hallett here. Listen, I'm the next speaker, but I just wanted to say
he's not here.
Oh, he's gone. I'm so impressed.
Yeah. What happens, Norm, is just so that people don't accidentally shut down the event, we eject them.
I've done that before. I know what you're talking about.
Yeah. All right, but let's go ahead and kind of. What did you have to say to Lewis? I'm kind of curious.
I was just going to tell him that it's so nice to see somebody else leaning into the mental and emotional part, the part that people hang on to their original decision to make it right, no matter where it is in trading, where you take on a position and the market is doing something else, and yet you look for all the kinds of reasons to be right, as opposed to looking at the probabilities, like Lewis was saying, keeping all the probabilities on your side. I mean, that's really just the crux. That's really where people go wrong. They hang on to a decision that's not working out to try to make it right. They move stops. But Lewis, in his technical mental way, he still did it in a technical way, talking about the mental and emotion. I just thought it was terrific.
Cool. I'll let him know.
All right.
I'll drop him an email.
Drop a long email.
Since you're in here and your mic's on, I'm gonna have you help me, but give me just a sec.
I'm sorry.
I do want to say thank you to our sponsor, Stocks and Commodities Magazine. Stocks and Commodities Magazine, great magazine. They've been publishing since 1982. An annual subscription, I think, is in the neighborhood of about $90. I don't think is very much at all. It'll get you an article every month. They'll give you access to all of their trading archives, all 17,000 articles. Great sponsor. We want to say thank you to them for being a supporter. We've talked a lot about MetaStock today. We're going to talk a little bit more about it as we get on today, but I want to remind you all of the promotions that we've got, including the buy one, get two free offer that we have. For MetaStock, it's available at metastock.com/conf promo. You can give us a call at 800-882-3040 and metastock.com/sales-chat. Norm, are you ready to give me a hand?
I'm ready to go. I'm always, as you know, you and I are always ready to go. So
Yeah. Okay. So one of the things that we do is we do a lot of prizes. We give away as many prizes as we can. Between every speaker, we give away a prize. And if you're watching us on YouTube right now, hi. After you get done liking and subscribing to the channel, liking the stream and subscribing to the channel, what I would recommend that you do in the pinned comments at the top, it's going to say register now. And if you register, we have a couple prizes we're going to give away still, and that'll put you on the list of registrations. Norm, the book I'm going to give away now is written by Steve Bigelow, High Profit Candlestick Patterns. And what I need from you, the help that I need from you, let me go over here to my spreadsheet. I need to get a number between 2 and 6,937.
wow. I would say 1,704.
1,704. Okay. That is Jeff. Jeff Gibby one. No, I'm kidding. Jeff O with a Comcast address in the USA. I'm going to email you, make sure I have a good address for you. Send you that book. It'll be next week. All right. Let me go ahead and kind of just
the late Steve Bigelow. The guy had a lot to say about candlesticks. That's a great book. It's a great giveaway.
Yeah, Steve was such a great technician. We've been talking about how much we loved him and miss him all week. So with that being said, though, our next speaker is Norm Hallett. Norm is a good friend of MetaStock. How long have we known each other now, Norm?
I don't know. I think the first time I saw you, you were sharing a booth at the, at the expo. I think we were both doing that. But yeah, it's got to be 20. Could it be 20 years? I think it could be 15.
It could be. I'm looking at the calendar. I think I'm on 28 years now at MetaStock, so it could be 2 decades, yeah. And it's been a while since. It doesn't seem like those shows have been as big as they used to be, and it's been a minute since it has been.
Well, the advent of the the internet and so on, less in person,
I kind of miss the in-persons, but I love the online stuff, obviously, too. I love
when we get on stage, when we put us the speaking. That was the fun part.
Yeah.
They always used to put me first because I'd run around and talk about the mental and emotional part, and those were good times. But I think they're needed. I think you've got to, hopefully, I do webinars, but I also like to. I also like to have the meetings where everybody's in their boxes. It kind of gives that same feel that we used to have when when there's an audience. I think it helps us as presenters, and it helps everybody else as being part of a group.
Oh, absolutely, yeah. I just said you as a presenter, so I should ask you. Oh, there you are. You're on top of it. And you're going to talk to us about the benefits of having being prop traded and how it might make sense for you.
That's it.
All right, I'm going to get out of the way then. Your turn. Go.
Thank you, sir, and thank you very much. Much appreciated. And I'm going to shut my face off so that I just wanted you to see I looked exactly the same as that picture that was taken 15 years ago. But I wanted to, I've had a fascination the last couple of years with the idea of prop trading because it's given so much possibility to traders, especially who are not trading a lot of money. If you're trading $5,000, $10,000, $15,000, maybe even $20,000, $50,000, to be able to trade multiple $50,000 accounts, you can literally be trading millions of dollars and getting the vast majority of the profit. And they do that. They're willing to give you all or most of the profit in many of these prop firms because most traders are not successful in the funded stage, where they where if they can make a little bit of money with the money they've been granted, they can actually start asking for the profit. It really doesn't take much, but there are a lot of mental and emotional stresses that come through, and I want to go through some of the physical techniques that you can do to offset what is stopping you or getting in your way as a trader. You know, Lewis, I love I only saw the last half of this presentation, but the idea that we tend to bring up in our own minds reasons to stay the way we are in a trade, even though the chart is breaking down, because we've got an ego to protect. And you know, I think traders will give it lip service that's important, and they do something about it, but most just don't. They don't do meditations and other kinds of things that have been proven to help traders. But even, you know, so I've turned primarily to also helping traders construct their trading plan in such a way as to fit who they are as an individual. Meaning that, you know, if you are a trader who is prone to lack of patience, there are certain things that you can do in trading to kind of offset that, to make sure you get your triggers more frequently, a lower time frame, markets that are more active, and so on and so forth. So I've always been trying to help traders, of course, to win, but always from the angle of the mental and emotional. And when you're funded and trading somebody else's money, you know, you would normally think that would be a lower of the cortisol level, because if you lose, hey, it's their money. But the truth is that, you know, most traders are rightfully more responsible than that. I think in a way, when you lose your own money because of what you've done, it's a better feeling than losing somebody else's money, in a sense, if you're a responsible person. So in this particular trading presentation, I want to talk about how not to blow up your funded account. Meaning to stay away from those mental and emotional situations at certain points in the funded account and in the evaluation stage. But the funded account is really where the pressure's on. Now you can actually start earning money from your positive results in your trading. So let's get to it. Appreciate your being here today, and appreciate Jeff having me. Let's get into first the very short disclaimer that futures trading is risky, can result in substantial loss. Only risk capital should be considered. And furthermore, past performance is not indicative of future results. And the testimonies that you see are just that, testimonies from individuals, and not necessarily will be your result unless you follow the simple rules. I went to the University of Cincinnati, graduated in mathematics. About 7 or 8 years later, I was running one of the largest option firms in the country. This was not an exact picture of it, but it looked very much like it. This was already, now I'm talking about the mid-1980s. Left them in 1988. So from about 1981 to 88, in the middle, I was graduated to a regional vice president, of which I was responsible for 63 individual traders' performance for their clients who gave them money to trade on their behalf and make money for them. These were all commodity trading advisors and other licensed people who could actually trade other people's money. In any event, this taught me what a good trading plan is and what it isn't. They were allowed to do their own trading plans. We had a research department that gave them some guidance, but in the end, it was a matter of them doing what they did with their trading plans. And it was the simple trading plans, the ones without all the hurdles, the ones that stuck to the basics of trading, of technical analysis, that consistently did better. The more hurdles you put in, the more indicators you have, the more you need a trade to expand in order to prove itself, and therefore you usually have a little bit more risk and less profit potential. But in any event, there's a combination of that. You do need some confirmation, but there are better ways to do it than 5 different funnels to pass through. After my stint with the option firm, I decided to take an offer from Payne Weber, where I was a commodity trading advisor for a couple of years, and so I had to practice what I was preaching to all these other people and manage money. At that time, they were paying me 20%, and I was running, of course, $7 million multiples. and 20% of what you make in even a conservative firm in the way that we were asked to trade, it was considerable. I had some good years there, but imagine making 90% of the money that you're given, and that's what is possible, or what is happening in the prop trading universe. I've written several books. This book is actually one of the more recent, even though I wrote it about 15 years ago. It's about how to design and construct effective trading plans. That's still on Amazon. I think books have been written. Jeff and I were talking about the expos, and this was taken from many of my appearances on the expos. Some quotes, somebody put it in book form and produced it. But I started the Discipline Trader about in 2000, in October of 2000. So it's been around almost 25 years, over 25 years now, and where I concentrated on helping with the mental and emotional piece, because it's the most neglected and really the most important piece of trading. And we opened, let's call it a subsidiary in Their Money Your Profit, which is concentrating solely on the area of prop trading. So let's get into the presentation, except for to tell you that I've written so many books and papers recently in many of the publications and so on. You may know me from the 4-minute drill for traders that have over 1 million views in this, and there are over 200 of these 4-minute shots right between the eyes. We really tell you the truth about trading, not only mental and emotional, but also the structure of trading plans. So you can see all of that on YouTube. And if you wanted to see the younger version of me, because the last one I did was about 11 years ago. In any event, an overall recognition is that we, as we move through this presentation, we're going to be recognizing the importance of the mental and emotional aspects of trading. The specific trading techniques I give you will be laced with the understanding that without that mental and emotional control, and apparently the spelling control here, it looks like I spelled this incorrectly, you're not going to succeed as a prop trader. I think we all know that, and somehow most of us give it lip service. So this is a good way to continue to give it mostly lip service, but have it built into your trading plan, and some of the things I may suggest. Anyway, at the conclusion of the presentation, I'm going to be giving you a special offer because you spent your valuable time with me, and I think it's an offer, in fact, I pretty much know it, that you've never seen before. Most trading firms are afraid to make the kind of offer I'm going to make to you. So stick around to the end. I think you're going to really enjoy that. So let's get started at the end, okay? And when I say that, it's very important as a prop trader, as any trader really, to vision what is in our future, as opposed to getting so wrapped up in the losses of the gains or losses of yesterday and today. So you want to keep what the potential of prop trading is in front of you. I want to talk to you about the basis of a $50,000 prop trading account. I'm going to be talking about Apex, but the parameters are pretty much the same with most of the other, whether it's Top Step and others that are reputable prop trading firms. But in a $50,000 account, I'll just give you some general math that's true in just a couple of percentage points back and forth of all the trading firms that use prop trading. You've got to, once you're qualified, and the qualification stage is another discussion. It's fairly easy actually to qualify. The rules are fairly loose. But once you qualify and you're given $50,000 of actual money to trade, you need to move that equity from $50,000 to $52,600. Once you close a trade and your equity is now, your balance is now over $52,600, you can actually start requesting money, okay, from the firm, and you can request it twice a month. The 50,100 is a red line level. That level is the level where you cannot breach. In other words, if I'm now at 52.6 and I have a few losing trades, and it's now 51.6, now all of a sudden I'm only 5,200, or I'm only I've reduce the distance to that red line, because if you breach, if your equity goes below 50,100, you're busted out and you've got to start the evaluation stage again. I don't want to get too much into the weeds. I just want to talk about this presentation is really based on those that have been through this a bit. Those that haven't, just follow the numbers. I think they're not that complicated. But at 50,000, at 52,600 and forward, you can start requesting money, and that red line stays there at 50,100. So, you know, if you get to 52,600, you really don't want to request $1,000, because that'll immediately, instead of a $2,500 distance that we have in this, what I have in front of you between 52.6 and 50,100, that 2,500, if you reduce that your equity to 51.6 by asking for $1,000, now you only have $1,500 between you and that red line. And if you breach that red line, you're going to have to start from the beginning again and qualify to trade real money. So you want to be very careful in this particular case. I actually support taking out about $500, which is the minimum that you can usually request, because I do want you to see that money in your account. Once you have the money in your account, it's very enlightening. You know, listen, trading can seem a battle, as you good and bad trades, and of course, if you've got a responsible trading plan, the wins are going to surpass the losses, and over time you'll do well. But there are periods of time where you can have setbacks. Okay, so the idea is keep your distance from the red line. But I want to go more into what you're really looking for. You're just not sitting here fearing the red line. As I mentioned, now you have a $2,500 distance at 52.6, where you can start asking for money from where you are to the red line of 50,100. The good news is, as you continue to build that 52.6 into 62.6, etc., as you continue to build it up, that red line stays there. So all of a sudden you can kind of start loosening up your trading from the standpoint of position sizing and so on. So in that same $50,000 account, if you were to trade it to 60,000, you still have the red line at 50,100, and therefore now you've got a nice, almost a $9,900 distance between your equity and the bust out line. Now you shouldn't go nuts. You know, you want to think of this as long-term income, okay, where you can take a couple of weeks off, a month off, take $3,000 or $2,000 from a $60,000 account and go on well, $2,000 will be a very short cruise for two. But if you can build that same to 75,000 without depleting it by taking money out, if you can keep that open trade equity at 75,000, then now you've got a distance of almost 25,000 to the red line. Now you can take out $10,000 and have that trip to Europe and still have 14,900 between where you are and the red line. So I think you see where I'm going here. This is not something where let me get to the point where I can start taking out money. Yes, it is like that, but you really want to look at this as a long-term adventure. The truth is that in most of these trading firms, you don't have to trade every day. You don't even have to trade every month. Once you're qualified, you can stick with, I know it's with Apex and TopStep, not sure of others, but they all have similar rules to the top dogs. And so the idea here is I want you to think about this 24/9. I want you to think about the $75,000 account that you've created from your original 50,000. Maybe it'll take you 3 months, maybe it'll take you 6 months, but once you get there, now all of a sudden you're trading without the fear of that red line, because the red line is really where the problems come in. Okay, so let's talk about prop trading challenge number 1, that red line, the overall drawdown limit. The issue is with the tight drawdown limit, starting with 50,000, you can't breach 47.5. There's that $2,500. That differential follows you along the way. So you want to make sure that you stay as far as you can from the 20, or at least maintain the 2,500. In this, if you were to build the 50,000 to and you had a trade that was doing very well, and all of a sudden it was at $1,000 open trade equity, and you took it right there on the way up, now you have a balance of 51,000, and that red line is 48.5. So yes, you've gotten a nice, you've made some nice progress between the 50,000 and the 52.6 that you have to make before you start taking money. But that red line is going to follow you. You still have that $2,500 distance from now, 51,000 rather than 50,000. And the reason they do this, when I first started doing this and talking to traders and coaching them, there was some anger about open trade equity counting against you. And in Apex and some other firms, open trade equity counts against you. In my example, if you were to take that $50,000 starting equity and had an open trade equity of $1,000, say you have an open balance of 51,000, but you don't take it, you let it come down and you put in a break-even stop, and you still have a $50,000 equity when you get stopped out. If it was your own money, you'd say to yourself, hey, that's great, 50,000. At least I should have taken the $1,000, but I didn't. But I still have $50,000. That's not the way they look at it, and that's not the way we, as a commodity trading advisor, the way we would look at it, or that isn't the way I look at it when I was managing 63 professional traders. That's not you can't give away that kind of open trade equity and not suffer from it. So in the game of prop trading, if you go from 50,000 to 51,000 in an open trade equity and let it come back and to break even and don't take it, they will count that against you, meaning that now that $50,000 doesn't have a floor of 47.5, it's 48.5, because the $1,000 that you didn't take is counted against you. So because of that, you need to have a different way of approaching trading when you're dealing with prop trading than your own account. You can get away with it with your own account, but you can't get away with doing the wrong thing in a prop trading account, because they will count it against you. So that's the issue here, this tight drawdown that we've discussed. Now, as you're working towards your goal of that $2,600 profit on a $50,000 account, the closer you get to the red line, the more stressful your trading becomes, often pulling you off your plan. I mean, if that $2,500 distance to the red line that you start with becomes $500, you're saying, oh my gosh, maybe I'll take a shot here and try to get back, and I can always buy in or reset. But you can't reset a funded account. You have to go back to the testing ground before you can, in the valuation account. So you really don't want to blow out this account. You don't want to get that close to the red line. Okay, so the solution is every trade, I believe, should include a scalp in part or whole. Why? Because in my example of that $1,000 gain, if you had a scalp, if you put on two positions, for instance, two contracts in the position, and on the way up, as it passed, say 500 on that, you can take that scalp, and usually it's not quite that much. But the idea is that when you take a scalp, you're taking it on the way up in a long trade, and by doing that, you're actually padding your distance from the red line. So, and you're increasing your equity line also. So the idea of having a scalp in part or whole, I like to take on a couple of positions, a couple of contracts, letting one, if I take a minimum of two, which is always the minimum that I take, one is a scalp and one is what I call a runner. The scalp is there to pad my distance from the red line, because that's the low-hanging fruit, and you might as well employ low-hanging fruit with your approach to prop trading, because when you do and you take that low-hanging fruit, in other words, the less that you ask from a market, the more you're likely to get it. And as Lewis was talking about beforehand, in the previous conversation, the more odds you can put for you in a trade, the better off you are. And in this case, you're putting the odds of this in the structure of prop trading. You want to do as much as you can to keep away from the red line so you can trade on track with your trading plan without being pulled off by emotions. Okay, that's really what I'm talking about here. So the less you ask from a trade on initiation, the more you're likely to have that favorable outcome. Okay, so each successful scalp pads the distance between your balance and the red line. Okay, you use that scalp runner combination upon the execution of its trade or using scalping exclusively. When I say that, when I coach traders to trade in the prop trading arena, I make sure that each trade in a $50,000 account is, you don't, each trade that you make, and a trade in these examples that I'm talking about are 2 contracts. You're making one effort at a trade, that's the trade, and it involves 2 contracts in the futures market. And if you don't, and I don't want you to risk any more than $250 on that effort, on that trade effort. Okay, so if the parameters that you set to set your stop exceeds $250 because you're taking on 2 contracts, take on 1 and make it a scalp. Okay, in other words, if you have a responsible trigger that you can trust, gives you the movement in your direction that you want, say 2/3 of the time, okay, then you want to take on that position. But if you can't fit on, but it's more important, it's just as important, if not more important, it is more important to make sure that you're minimizing the risk. So if you're putting on a position where I suggest 2 contracts and it exceeds that 250, put on 1 contract and make it a scalp. You're lining up a lot of positive things. First of all, you're putting on a contract where you have a trigger that's working for you. And the second thing is that you're asking it to be a scalp so that it's much more likely to have a positive outcome because you're asking less from the trade. I think you get what I'm talking about. So when you're approaching the overall red line, you want to include a scalping element. Okay, this is my view from managing many people and trying to thousands of traders, I'm sure, along and maybe 1,000 professional traders. I'm sure in my career, it's been 4 decades now. I'm sure I've reached that number. But the idea here is this is what I've learned that and I've never been a scalper. Before I started prop trading, I've never been a scalper. But it occurred to me from the success of somebody that I was training that scalping really works to keep you from that red line, to keep you on track, keep you doing the right thing, okay? You need to identify a set of frequent, reliable triggers. That's part of this process, because unless you have a trigger that you can count on at least 2/3 of the time, giving you a pop, you're not, a pop means a movement in your direction enough to take a scalp, a decent scalp, not just $50, but 100, 150, 200, something of meaning, okay? In order to keep the reward to risk ratio in line, a reliable trigger, one that gives you a pop in your direction upon application, at least 65% of the time, is needed. Now, a pop means one that moves in your direction within a few candles, the first few candles, okay? The trigger also must be frequent. It's got to be a frequent, reliable trigger, meaning that the trigger appears often enough not to challenge your patience as you wait for it to occur. And I know I'm talking to about at least half the audience where patience winds up to be the #1 mental and emotional issue that pulls you off your trade. You're looking for a trade, you only have 2 hours to trade in the day, and it's already an hour, but you're really not getting the full trigger, but maybe I should take it. Hey, this is a strong trend, maybe I'll look to find something. Didn't quite give me all of the indicators, but I've got 2 reasons to get in based on my 4 reasons in my play. Let's get in. I only have a half hour. You start making compromises in your trading plan because you want to be in it. We're here to be in trades, okay? Although there's a famous expression, I'd rather be out of a trade wishing I was in than in a trade wishing I was out, and I think you got to keep that in the back of your mind. But you want a trade to meet your criteria. And so if you have a criteria that involves a trigger that is reliable and frequent, now you're not only do you have something that you've tested that works, and we've got 2 of them in our loaded gun simple trading plan, but you're also dealing with you're also dealing with the fact that it's frequent and it offsets any tendency you have to do the wrong thing because of infrequency, and it's reliable. This means that you can be confident that every 3 times you put this trade on, you're going to get the pop in your direction enough to take the scalp. Whatever happens with the runner happens. It winds it. You've got to manage it in a responsible way. We can talk about that in another discussion. But I just need to talk about the places of angst in trading that pull you off your trading plan. One, is this red line. And if you can identify, if you have a frequent and reliable trigger, one that 2/3 of the time gives you that nice pop to take the scalp, now you're taking your scalp, you're padding your distance for the red line, and you're keeping your emotions under control. Okay, so the solution is to have at least 2 of these A+ triggers. I call them A+ triggers. I won't name an A+. We're working on a 3rd one, but I need to test it in real time. It takes me literally 3 or 4 months to test it in real time, because I've got to put the time. I got to put the time aside, and I've got to, you know, and to do that, you've got to have at least several hundred, if not 1,000 occurrences of what you're doing. So it sometimes can take 6 months. That it's been tested thoroughly and frequent and reliable. Okay, if you trade a single market, changing time frames can expose more triggers. For example, 2 short candles, when I say short candles, I mean 2 small candles, can combine into a longer candle to be identified as a trigger. This is another offset to that lack of patience that I'm talking about. I wanted to throw that in there. If you're trading, say, a 2-minute candle chart, you may want to take and you see the market moving in a direction that seems to start to be defined, and you want to get in early. Sometimes you can move to a 5-minute. It's going to combine some of those 2-minute candles, and you can expose a trigger that you know that wasn't there when you looked at a different size chart. So expanding time frames and collapsing time frames can for patient traders that have a very short period of time to trade, 60 minutes a day, an hour before they go to work, 90 minutes, whatever. It's good to know that you can expand and combine trading candle sizes in a chart in order to expose more triggers. So that's another technique to expose more trigger. Most of it is going from a longer term chart to a shorter term chart. You'll get more triggers in a 2-minute candle chart than you will in a 5-minute, and the 5 will give you more than the 10, and so on. Or just by, I think if you think it through, just by definition. I'm not a fan of the 1-minute candles, although there are some traders that use our techniques and do very well. I think I'm just not fast enough. So whatever, but you know, the shorter the time frame you use, the more exposure you're going to get to see more of your triggers. Trade more than, or you can trade more than one market. This is what I like to do. I like to stick to the 2 and the 5, and say the NQ and the S&P. You can have both charts up, waiting for your trigger to happen. 2 markets means twice as many of your triggers to be created. I sometimes like, for a new trader, I like disassociated markets. In other words, look at the crude market and look at the NQ. They're associated in a certain way, but they don't move like the NQ and the S&P move most of the time together. And you can't even say that about those. The tech-rich NQ moves sometimes with its own pace and direction, and leaves the Dow and the S&P and the Russell behind. So, but my point is that disassociated markets also gives you a diversification that some would consider. I know Lewis before me would consider it more of a spread of risk, which makes all kinds of sense in trading. But my idea here is just to think about trading, having 2 or 3 charts. I have 6 charts on I'm watching gold, I'm watching the micro gold for my smaller accounts. I'm watching the Japanese yen. I'm watching the euro dollar, and I'm watching the S&P. So I have those markets on my screen all the time, in the 5-minute usually, or the 2-minute. And because it's a signal that we use in Loaded Gun that is very easy to identify, and you can see it coming. You can watch several markets, or just watch one market in different time frames. Whatever it is, do the things to help you to offset the problem of lack of patience. And again, all of this that I'm talking about here is really emphasizing the need for the scalping as well as the runner. Okay, this is what the Loaded Gun Simple Trading Plan chart looks like. This is simplicity that I was talking about, and you can see that that it's going to give you, even in a 5-minute chart, a couple of trades every couple of hours, usually a trade every hour, and really just wanted you to see the simplicity of what we do at Loaded Gun, because I do think that simplicity is important. Trading signals that are easy to recognize. Okay, so let's continue on. The number 3 challenge of prop traders, and nerves increase as you get close to the finish line. Remember, I said you got to build the 50,000 to 52,600. When you get to 52,300, you start getting very cautious. When the account balance gets near the finish line, nerves start to increase, leading to being too careful, causing hesitation and mistakes. And the solution to that, I find, is to trade 2 accounts at the same time. I keep mentioning a $50,000 account. I always suggest that once you qualify, go ahead and qualify for 2 $50,000 accounts, and you can trade the same contract, but using different contract sizes. You may want to take you want to trade maybe one with a mini and one with 4 micros or whatever. You can use different commodities and different indices. Trade them a little bit differently using the same trading plan. And I think that once you start to do that, once you get pretty good at this, diversifying what you're doing is an important part of it. The positive results in both accounts. In other words, and I think the simple version is you're trading, say, the NQ, and you're trading the micros. So maybe take 2 micros in one account and 4 micros in the other account. Same direction, same trade, okay, but different strength in each account. If you're right, if you're both a positive result in both accounts may break you through that one that's close to the green line. In other words, take the pressure off that particular trade by having two trading entities that you're trading. I find that it kind of diversifies your emotions. It gives you courage to do a little bit less in the one that's close, a little bit more in the one that's further away, and therefore, if you win, you positive breakthrough in both accounts, you're going to break through with that one account. A negative result, yes, they'll both come back further, but they'll be less further in one account than another. So you're diversifying results in this. I find that doing that kind of takes your attention away. Ooh, I got this one account. Ooh, I'm close to the line. What should I do? So that seems to work. It works very well for a lot of the traders who have angst, and most of them do when they get close to the green line, where they start getting paid. Okay, adjust your trading plan to match who you are. In other words, your emotional truths. In addition to training your subconscious mind to strengthen your weaknesses and emphasize your strength. I mentioned that the Disciplined Trader started in 2000. For the first literal 20 years, we did nothing but help traders with meditations and other techniques to keep them on track. The problem is that we were keeping traders on track for lousy trading plans. That's why I decided to go back to my roots, where I was building trading plan and written books on it, and came out with Loaded Gun Simple Trading Plan about 3 years ago. And we have been just cruising with that trading plan now for three years. And the more volatile the markets get, the more this trading plan does seem to operate. So I wanted to show you some contracts to consider. We've got about, I guess, about 15 minutes. We've got about 20 minutes here, but I wanted to give you an idea of what Loaded Gun is. But before that, I wanted to give you some futures contracts to consider, whether I never see you again. Prop traders tend to take on contracts that are too big, or they're not the wrong kinds of contracts, at least in the beginning, to get qualified and to move past that 52.6 so you can start getting paid. There are actually some contracts better than others. We know that the micro, NQ, and ES are very flexible, very flexible in your exposure, but can add up a bit for round turn fees, which some traders complain about. I never do, and I don't think you should too either. If you're a person that worries about $2 on every side round turn, $4 round turns on accounts, it's really forest through the trees, or whatever that expression is. You're tripping over pennies to get to the dollar. Listen, when you're a successful trader, when you get this right, you're better off paying a little bit more on more fees and keeping your risk down and keeping your profit potential down than taking on a big contract and only paying $4 instead of $16 because you took 4 contracts. It's just doesn't make sense. So in the long term. So don't worry about the round term fees. So the micro, NQ, and ES allows you to really take on bite-sized pieces, but still has the potential. I had a contract twice last month where 2 micro ES contracts, one was not, I took a $900 profit from 2 contracts, where one of those contracts I took out as a scalp and only let one run. Same with the other. One was $700, one was $900 on micro 2, and then eventually 1 micro contract left after taking the scalp, and it still wound up to be a total win of $700 on almost $1,000 on another trade that I did, because I caught the top of a market when it was very positive, and it was almost 100 points up at the time in the S&P, and wound up to be almost 100 points down. Those are the kinds of moves that can happen, and so don't underestimate the power of what can happen in these micro contracts. Okay, but don't overdo it, don't underdo it. Give yourself the prop. It's all about measuring the risk. If you're wrong, if you're right, a lot of good things can happen. If you're wrong, you want to keep that under control. So the micro, NQ, and ES, very nice contracts. Some contracts that the traders don't necessarily think about are the euro contract, FX, the currency, and the Japanese yen. It's 6E and 6J in some, I'm not sure what the symbols are. I used to know them in Meta, but the idea is to get to the small contracts, the semi contracts in the Japanese yen and the euro, and you're liable. What you're going to do here is to have full contracts. They're full contracts, but they're only 125 dollars for 100 points, which is a considerable amount in these currencies. I mean, the currencies can move 700, 800 points in a day. So if you catch it right, there's considerable potential here and considerable ways to take on multiple contracts without risking too much. So I like those 2 contracts. And then I mentioned that the currencies tend to trend, which I really like about, remember, we're taking the scalp first and then we're letting the other run. The personality of the euro contract and the Japanese and all currencies, they tend to run. Once they take on a direction, they tend to run. Okay, the other contract I didn't want you to be without is the mini crude oil contract. So find that one in the platform that you're using, and these are half contracts. So they have micro contracts, but these half contracts has really nice volume, and they trade 2.5-cent increments as opposed to $2.50 increments, $2.50 increments rather than the 1 cent increment that the full contracts trade. So it's still a bite-sized piece. And these half contracts, you can quick in and quick out. You take on 2, take out 1 with your scalp, and really give you a nice size scalp. Crude oil, they tend to run also. But the thing about crude oil is it tends to run quickly. You can have, in a 5-minute situation, you can have a movement of $1 easily in crude oil. So once you have a responsible trigger, take on your half contracts, take 1 out in the initial move and let the other one run. Very good contract to do that. So I wanted to give you those 3 contracts for yourself to make sure that you have, whether I never saw you again. Let's get into a little bit about why I'd like you to consider the Loaded Gun Simple Trading Plan. I know you've heard about it. Most places that come out with trading plans have a new one and a new one. And no, I really believe in taking a trading plan that works, and then, if needed, emphasize one of the rules and the market and your position sizing to honor what's happening in the market if there are any changes. But the Loaded Gun Simple Trading Plan has had very few changes in this 3 years. It's been responsible and courageous the whole time. So the core Loaded Gun Trading Plan is only 2. It's really only 2 videos, and both videos add to about an hour and a half, and that includes all the examples. You saw how simple the chart is. In fact, all of the rules fit on 1 sheet of paper. The exit rule, entrance rules, exit rules, you'll print that out too and have it on your side. So it's a simple trading plan. You saw what the chart looks like. It's very simple to operate, but you got to operate it with intention, and you can't be straying. Then there are these things called nuances. This is something that I developed when I was with Payne Weber, actually before Payne Weber, but I brought it, I shared it with some of the other CTAs that were responsible at Payne Weber, and we professional traders, they love the idea of nuances. What nuances are, again, the mental part of trading is the most important. If you are a person who lacks, who has a fear of losing, or you're a person who has revenge trades, or you're a person with lack of patience, there are certain things, small adjustments that you can make to the trading plan to fit who you are as an individual that don't add any significant risk to your trading, but fit you as an individual. And that's important because the more a trading plan fits you as an individual, the more you're liable to stick with it, because it's jumping off your trading plan, that 1 or 2 trades that blows everything up in prop trading and any other trading. So these nuances, we have 7 of them right now. I'm testing 2 more right now, but 7 of them that I'd like you to go through, and each one of us is only 10 or 15 minutes, but it's a technique in trading that I've learned from managing all the room and more, and trading myself, and talking with other professional traders. These nuances are small shifts that you can make to offset your tendency to pull off your trading plan because of some neurosis that you have, whether it's lack of patience, whether it's over trading, whether it's so there are 7 of them right now. I'm currently testing 2 of them, but nuances is something that differentiates us. I think that makes our traders that have been unsuccessful in other trading plans that are good trading plans successful in ours, because it fits them. And why can somebody give you a trading plan? They're making all this money, they're showing it to you, well, of a guru or a fellow trader or somebody in the trading room. They show you and then they give you the trading plan, you use it, and somehow it's not working for you. It's because it's not a fit. And these nuances allow you to make it a fit. Okay. We have monthly get-togethers. Every last Wednesday of the month, we get together and we talk about, I update you on some of the things that I'm looking at, maybe a potential rule that I'm considering, and maybe some of the advanced traders. We have many professional traders that trade through Loaded Gun and trade the Loaded Gun Simple Trading Plan. And they have, they tell me some of the things that they're testing on it. So listen, we're a community. We're in this together. We share our experiences. We have a concert pianist who gave a suggestion about a year ago, and I tested the suggestion. It's now part of the plan if you want to add it to the plan. Okay, if you miss these monthly meetings, you can make the recordings. Okay, you can take a look at the recordings. So that's what we do. I want to give you an update. I want to give you 2 bonuses. The first one is me helping you. 90 days of unlimited private one-on-one coaching. I will spend as much time as you need with you privately, one-on-one. First meeting will probably be about an hour. The second meeting and third and fourth, probably 15 minutes. It doesn't take much. It's a simple trading plan. But listen, everybody has their own quirks and things that they do or don't understand, or understand too much of, or stick to something, or Frankenstein something into a trading plan from another trading plan and ask me if they can do that and if it's going to ruin the plan. Sometimes no. Sometimes I say, look, if you want to look at volume, go ahead and look at it. But I don't want you to look at volume to take a trade or not take a trade. I want you to look at volume to maybe impart more positions, your position sizing. So, but I like it to stick to the trading plan on taking a trade and exiting a trade, maybe use it for position sizing. So, I'm flexible. Listen, I've worked with so many different traders. I don't want to take away who you are, but I do want to help you adjust your lack of success to success by adjusting some of the things that match you in trading. And so this 90 days, and the 90 days incidentally doesn't start until our first meeting. So if you've got something to do in the next month, you're taking a vacation the rest of May, take advantage of what I'm going to show you, because I think you're going to really like it. Nobody does what I'm about to do and show you. I want to show you what that is, and take advantage of it now, and then go ahead and take your vacation, look at the videos, and then when you come back from vacation, we'll make our meeting, and that's when the 90 days start. Listen, people don't really need the 90 days. I put in there just so you're comfortable to have it. It's usually 1 or 2 meetings. If you're a new trader, maybe it's 3 or 4 meetings. But if you're a if you've had any reasonable experience, 1 or 2 meetings is all, but I want you to have an open door. Look, I've got a couple of traders that I don't think have any friends. So they they meet with me every couple of weeks. I'm fine with that. You know, they make up a question. I'm okay with all of that. And if you're listening now and that I'm talking about you, don't take it too hard. Listen, everybody's got their thing, but I'm just saying it's so you and I are going to work together, and the 90 days start with the first meeting. So unlimited as many sessions, just get my calendar and you'll make the meeting. Okay. I'm going to be with you every step of the way. The second bonus is equally important. In fact, maybe more important. Again, and that is a private session with my wife, Tisha, who changed my head. She is one of the world's, if not, I'm going to say the world, she's one of the world's top subconscious trainer. And I mean, cover of psychology magazines through her entire career. And she worked from when we formed the Discipline Trader in 2000, she came with me and helped traders with the mental part. So you're going to get a private one-on-one session with Tisha to eliminate whatever the primary mental and emotional issue is that's causing you to be your own worst enemy when you trade. That's a picture of her. Still looks exactly the same. Whether it is fear of losing, lack of patience to wait for your ideal setup, revenge trading, hesitation to pull the trigger, overcoming fear and greed, whatever it is, Tisha will have that one-on-one meeting with you to uncover your particular issue. Okay, everybody has an issue if they're not I would just say that the majority of traders who lose have a pretty good understanding of how to trade, but they don't have an understanding of how important it is to consider the mental part of trading as strongly as the structural part. And I'm giving you the structural part in Loaded Gun Simple Trading Plan, a tested one that matches what we need to do as far as prop traders are concerned. I give you all the techniques. We share them every Wednesday, every monthly Wednesday. A lot of these guys partner up and gals partner up in these meetings, and so they're doing stuff without. In fact, some of them run a trading room. We have another one, looks like it's starting June 1st from one of the traders. It's not an official trading room, but it's a loaded gun trading room started by a professional trader who just loves to share his success. So all of the things are happening, but you've got to have the mental part happening, okay? The fear of losing, lack of patience, these are all kill your trading. You'll sit down with Tisha, you'll have two of you, will have the box, just you and her, and she will ask you the tough questions, and you need to be honest with her, and she'll know if you're not honest because she'll see your face. She's a mind reader also, and she will record a specific subconscious training for you. Let's call it a meditation. It'll be 6 or 7 or 8 minutes long. She'll record that for you based on your discussion. You'll do it there right on the meeting, and then you'll get the recording to use. Either that, or she'll use what she calls an EFT session, emotional freedom technique. It's an Eastern session using a really tapping points where they stick the acupressure type points while you're saying certain things. It loosens up these the energy waves. Listen, you know, as a neurotic math person, you got to prove everything to me. It's been proven to me over time. You may not believe in any of this, but I'm telling you that the Eastern philosophy is just as responsible and effective as the Western philosophies. And meditation is another Eastern philosophy, but I'm just saying that these approach the mind and how it works, and working with the subconscious mind. So she'll choose which modality to use with you, whether it's EFT or creating a subconscious training for you, aka meditation. But you will leave this meeting with your personalized solution in recorded form, okay? And to reverse these situations. This is something that we charge $500 for 2 hour institutional clients. Again, I still work with institutional clients. We still do traders from my old connections. And the firm, to be honest, the firm usually pays for the majority of it or half of it. We do offer it on special for our clients for $250. In fact, last week I just offered it to I remind those who are owners of Loaded Gun, if they need it, or anybody that's in any of our programs or mental program, this is something that we discount. I'm giving this to you, whether it's $500 or $250, I'm giving it to you, okay, as part of this package. to eliminate the situation for you. Okay, so what traders are saying, I've passed the apex 104 days, I've made 6,000 in 4 days. That's Mike. Sandra Wood, who was a good trader before I met her, but was getting in her own way. She's doing very well in this particular writing, which is already 4 or 5 months ago. She got her first couple of payouts on 2 of her accounts. She's very good at trading multiple accounts. And Ken is a more aggressive trader. He was testing for 5 accounts at a time. He made $21,000 in real money in the NASDAQ. This is not typical. He's very aggressive. He's had his good and bad. And he's had these accounts, I think, wiped out because he got too aggressive. Now he's back doing a much more, he's on the track that I want him to be on. Sometimes I have to slow people down, okay? You'll see when you go to the offer page, you'll see these people just like you who have taken the time to record 60-second and 2-minute testimonials for Loaded Gun. These are, in fact, these 2 are professional traders. This is the one he had a trading room and he just stopped because he and his son are investing in something bigger. And he's about to start a trading room for us again, unofficially. But he just said, could I do it? Could I do it? He and his son. He's got his son trading. So all of these people, you can read their testimonials. These are the only 2 professional traders. These are other traders that have done very well over time with us, okay? And so you'll read all about that. The simple trading plan, Loaded Gun, I mentioned the core, all the nuances that I've tried to evaluate for you, monthly get-togethers, the unlimited one-on-one coaching for 90 days, the special issue and eliminating session with Tisha. I'm telling you, this is really the crux of what you should be getting this for, besides of course having a responsible trading plan that works for prop trading. I am so confident that you're following the Loaded Gun simple trading plan is going to result in you getting funded by your prop firm so that you use their money, not yours, and still receive 90% of the profit you generate. Just share your experience with me that you followed the rules and it didn't work for you. Just show me a few days of trading where it didn't work for you and I will refund your purchase price plus 500 fee. In fact, this guaranteed works through your getting paid. You got to get paid, otherwise this is not worth it. Okay, so here is my offer to you: Loaded Gun simple trading plan, all the core nuances, the monthly meetings, the one-on-one coaching for 90 days, all of that, the special elimination session with Tisha. Okay, all of that in a package. If you add up all of the value here, you're talking about $5,247. I always reduce it for Meta, and I reduce it even about the same this time, $100 less, $1,397. But I don't want it all up front. And here's the difference. This is what I've seen nobody do. All I want is half now, and the other half from your profit. Actually, it's $700 if I do the math correctly, but $697 is fine. $697 now is all I'm asking for. You get everything, and I will never ask you for the other $697. It's on the honor system. I don't have time to chase you for it and so on. And the reason, my experience from having done this now for 2 months is that I don't have to worry about it. So I don't worry about it. I'm never going to ask you. I don't even look where the money's coming from. You're going to want to, if you're like others, give us what we're worth, and because we've helped you in your success. So the disciplined trader just is giving you this link: theirmoneyyourprofit.com. theirmoneyyourprofit.com. You'll see all those testimonials and more. Use the coupon code GETMEPAID. Okay, that will reduce the $24.97 all the way down to $6.97, and then the rest, the other half, is on the honor system. Again, not going to chase you for it. Let's work together on it. Because of the nature of I'm only getting half now and I'm waiting for the other half, I can't do this for everybody. So only for the first 10 traders that do this. I believe with the crowd here, we may get all 10. It may bleed into tomorrow, but don't chance it. Because this is an opportunity for you to get in on the cheap, really, but in a trading plan that has worked and is benefiting others. So I think I'm within my time limit. Yeah, that is all I've got to say. You can give away another prize, but I want to thank you for having me, and I want to thank everybody really for spending your Saturday with me.
Norm, I got a question for you, if you don't mind.
Mhm.
Murray wants to know. Murray says some prop firms are collecting bad reviews. They close people's accounts even though they're on requirement, but they don't like the schedule. Do you have suggestions on how to find a better prop trading group or recommendations? Most give simulated accounts, then they decide what trades they want to use.
There are many prop trading firms out. In fact, just going to spit it out. I've done a comparison of prop trading firms, their fears, where their red lines are, where how they pay, and so on. I took the 7 top ones. It's about a year old now. But if you write me at admin, short for administration, at thedisciplinedtrader.com, admin@thedisciplined fast tense trader.com. If you write me there and just request that study, be glad to send it to you. You can see the different comparisons. Now I've landed on an Apex and Top Step, and the reason I've landed on them is because they've been around the longest, and they pay out increasing amounts to their followers, meaning that I want a trading firm that is growing, one that is paying out more money to more and more traders. I like that growth. That was weighted for me when I've decided which ones I wanted. But you can weight the figures that you see that you'll get in this study any way you want. So admin at thedisciplinedtrader.com. Be glad to send you a copy of it.
Cool. The only other comment was from YouTube. Thank you for a lovely welcome, and may God bless you.
Thank you, and hi to the girl. Hi to your daughter, your beautiful daughter.
Will do. Which one?
The one that's the comic partner.
All right. Cool. Thanks, Norm. Appreciate it.
Take care.
All right. Go ahead and do this. All right. Let me make me the presenter.
Did you make?
It keeps happening. Bye. All right. Thanks for being here, everybody. If you have questions, make sure you ask them and that kind of stuff. The link is in the comments. Do want to invite you, if you haven't yet, you still have time to join the free Online Traders Forum community. You can chat with other traders. Lots of information about technical analysis, candlestick patterns, a pretty active market chat where I get a lot of good ideas from, actually. You can join, it's free to join, thetradersforum.com. www.thetradersforum.com. Of course, we are MetaStock. We've talked a lot about how you can scan the markets, test trading ideas, get forecasts for probable price movements, get real-time alerts, commentary. All that starts at $75 a month. Any of the conference specials that we have direct from MetaStock today can be found at metastock.com/conf-promo. You can also go to metastock.com/sales-chat, 800-882-3040. Erik, I can hear you already. Do you want to help me give away a prize real quick?
Hey there, Jeff. You heard me breathing?
I could, yeah. Your mic's on right now. But since you're here, we're giving away prizes for people that register for the event. And the next prize that I'm going to give away, let me just grab it real quick, is what's from Larry McMillan. It's a 3-month subscription to his Option Strategist newsletter. So Larry came in a little bit earlier. He wrote the book on trading options. I'm pretty sure you're probably familiar with Larry.
Yeah, absolutely.
Options is a strategic investment is what that was called. And so what I need from you, and then I'll introduce you and get you on your way. I just need a number. That number can be anywhere between 1 and 6,937.
Oh, so like a random number generator.
Okay. Yeah.
How about 2?
You're gonna go with number 2.
Yes.
That's Juan O in the USA. He just won it. So I'll go ahead and make a note of that. Our next presenter is here for the very first time. Good to see you, Erik. Erik started Alta Vest Trading. He started it in 1993, I think. I'm trying to remember from your
97.
1997. Okay, now I've got your stuff up. We've talked a little bit. I talked a little bit to Erik about kind of the technology that they do to kind of set up option trades for people and kind of how it works and that kind of stuff. Sounded super cool. So I'm really excited to see what he has to say about it. Erik, I'm going to go ahead and make you the presenter now.
Okay, well, the pressure's on.
If you want to share your screen.
Okay, and I need to pick the appropriate screen here. So let's take a look.
The one I've got is the presenter view right now. And now I've got Theta Trader dashboard. And
well, hold on one moment. Let me do this. Let me start with the presentation. Now you should see the title slide.
Yeah, I do like yeah, already, Erik, because your browser had more tabs open than I do.
Oh yeah, I'm good at that. All right.
I'm gonna go ahead and get out of the way. It's your turn. Go.
All right. Very good. Thanks for having me, Jeff. And we're going to talk about automated options trading. We have a proprietary algo that will pre-build these spread trades for you. You're going to look at some trading alerts that you've probably never seen before. And we have an autopilot risk and profit management mechanism as well. So you don't have to screen watch and babysit your trades. And we like to look at the professional types of strategies, not the rookie strategies. So we're going to show you what we mean by that. And then to bring this all together, you're going to actually be able to work with real people, not robots and chatbots and all that stuff. But remember, we are speculating, and speculators always accept risk when we're trying to profit. So there's always risk involved with trading. So do take a moment and look at that risk disclosure. In fact, you could probably take a screenshot of that or picture of that if you wanted to put yourself to sleep one night and read it. But the main thing is there is always risk of loss when trading. You should always use risk capital, and past performance is never a guarantee of future results. And we started AltVest, like Jeff mentioned, in '97, and we're a registered introducing brokerage firm. We've traded tens of millions of contracts along the way. That's a picture of yours truly there on the trading floor with some of our staff on the S&P 500 options pit. And you can see the people filling orders. These were some of our floor traders, and they would fill our option trades for us. But it does not look like that anymore, folks. We're going to talk a little bit about that, actually. We created the Dragonfly option strategy as well as the proprietary order execution technology to make that happen. And we're regulated and registered with the CFTC and NFA, and we're located in California. And maybe you've seen us in some other presentations, some other venues, including today. Thanks for having us again here, MetaStock. But we sometimes get quoted in Market Watch, for example. Here's a comment here about gold. Just last month, we talked about a pullback in the gold market being a gift for anyone. We've been bullish on gold since late last year, actually. So this is from April again. And just a little bit about myself. I graduated from University of Southern California, my degree in business degree, and that's the Trojans, if you're not familiar with the Trojans, and co-founder of AltVest, and has some licenses in the past with securities, Series 6 and 63, and insurance, and I currently have my Series 3 commodity futures license as well as my Series 65, and that's for the investment advisors. Okay, we're going to jump into the presentation. These are the top 3 barriers that seem to get in the way of traders, and this is sort of based on feedback from thousands of traders we've worked with, as well as just my own personal perspective. I think we all kind of have a similar feeling about this. Confusion. I think there's a lot of noise, conflicting targets, opinions, narratives, complicated choices. I'm not going to spend a lot of time on this, but you know, this one, I just keep it up here. This is a guy here from December of 2022. So Bitcoin's either going to $250,000 or it's going to 5,000 next year. And I'm not criticizing him for being wrong, but I'm not sure how valuable or helpful that information is. Why is that even a headline? What are you supposed to do with that? So anyway, you know, and then you get these price targets from all the banking institutions, and here's our S&P 500 forecast, and again, what are you supposed to do? Who would you believe? I don't know. And then meanwhile, we already broke down below 5,000. Of course, it's a year-end target. A lot can happen, but I just think it's absurd, actually, that any of this stuff actually makes headlines is considered somewhat useful. I don't know how it is. Okay, number 2. How about time? Well, I think it's impossible to track so many variables. This is kind of an example of a workstation where people sort of seem to think they need. I don't agree with that, because our minds can only keep track of so many things at one time. And you really probably don't want to sit there and screen watch all day anyway. We're going to come back to that picture in just a second. Here's a guy who says he sits in front of his computer full time from the market open until the close, even after market hours. That's probably not what we'd like to be doing. And really, we get in our own way, and that's kind of what Norman was talking about in large part. We become our own worst enemy, and we're all human. We all have human emotions, and the fear and the greed get in the way of our trading and managing our money. And you get on that roller coaster, when you're making money, everything's filled with euphoria. You start losing money, you become despondent, and then you kind of repeat that cycle again. So we want to stay off of that roller coaster. And to do that, we need to identify who are we trading against, not only ourselves, but really machines. They run on automation, they have built-in controls, and that's our competition. 70% of the market is algo driven in the American stock market volume. And Tier 1 Alpha says 50% of global trading is controlled by computer algorithms. So traditional analysis is no longer enough. I think they're absolutely right. So we really can't compete with the algos on a even playing field. So maybe we ought to use some technology to help us trade along the way. And that's what we're going to look at with option strategies. And we want to trade options like a large institution might. And for example, if you were an insurance company, that's essentially what they do. They trade options by collecting premium, or I would say they would trade options if they were trading options by following their own model, which is collecting premiums, selling, managing time. They're hedging themselves. They're consistent and they're patient, and they look at probabilities and math along the way. You've got the statistics and actuarials and number crunching. That's what kind of drives and informs how they do things. They just look at the mathematical odds to be in their favor over a long period of time. So we can adopt their model and collect premium by selling options, managing risk and reward, using experienced people along the way to help you have the correct automation tools. And a lot of these strategies are going to be, using the baseball analogy, base hits and not grand slams. And these are short option strategies to collect premium. And these can be applied to any market situation, whether it's bullish, bearish, or even non-directional choppy markets. Every outcome has a predetermined risk and target. And remember, the Wall Street pros I mentioned earlier, this is how they trade. They trade multi-leg option spreads and they collect premium. And I'll show you this woman a little bit later. She was on CNBC and she made such good points, I decided to use her in this presentation and her comments. So an option spread is buying and selling different contracts. It's a common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's used by Wall Street professionals for decades. So before we jump in, let's learn a couple of the Greek letters in the Greek alphabet. How do we determine probabilities when trading options? Well, first of all, we'll look at the delta, and that is how much does the option value change with a change in the underlying index, or in this case, the index or the underlying asset price. It's also the approximate probability of an option expiring in the money, and that's how option traders look at delta. So here's an example, 0.25 delta. That means 25% chance it expires in the money and a 75% chance it expires worthless. And remember, delta is always moving as prices move and as time goes by as well. And this is important here. A delta, the number or the delta of any option is not the probability of a winning trade. So let's keep that in mind as well. And then the other letter is theta. So that represents sensitivity to time when you're talking about options. Remember, options have limited lifespan. So theta is a negative number. It equals 1 day of what we call time decay. So if an option premium's at 10 points and theta is negative 0.05, so all things remaining equal, the next day, after you lose 1 day, the premium would drop to 9.95, and the next day after that, 9.90, and so on and so forth. Here's what it might look like on a graph. So as you approach time 0, the amount of the premium remaining drops and drops and drops at a more rapid rate until eventually there's no more life on that option. So here's some option spreads. We're going to look at a few examples, and then we'll jump into the software demo here. Real simple, basic selling, in this case, an E-mini S&P 500 call spread. And we'll talk about the E-mini S&P 500 and those stock indexes and why we're so interested in those. But to kind of, I guess, jump ahead, the reason why is there's volume. That's where so much trading activity is. So anyway, here's an example. Bearish or moderately bullish or non-directional. So you sell this out of the money call spread. So that 64.10 call is the red line. And you collect 4.5 points for selling it. You put that money in your pocket, but then you have to take some money out of your pocket and buy the 64.30 call spread in this example, and you pay 2.25 points. So the net result is you collect $112.50 minus your commissions, and you look for the market. You see kind of chopped around here, dropped and up and down, and basically look for the market to stay below that red line. You know, and then at some point, as theta decay works, you would close out the trade right on that vertical bar here. And you can see the expiration date back here. But we'll look at this in detail a little bit more in just a minute. Here's selling a put spread, just the opposite. I won't go into all the details here, but here's your out of the money put spread you sell. You collect $100 and put it in your pocket. And, you know, in this case, the market just chopped around and that trade worked out. Here's an iron condor, and it's the combination of the put spread and the call spread we just looked at. And that's all it is. You do those simultaneously. It's a non-directional strategy. Here's what it looks like on a graph. You're selling this out of the money call and put spread, and then you collect premium on both sides of that trade. And you can see the market kind of chopping around. And then after theta decay works its magic, you know, you can see here, and I'll point out this little blue box here called the RTI, and I'll show you that here in just a minute, but that's the signal to close out that trade. And this can be automated, so you don't have to watch the market. These orders can be placed automatically for you when you get that profit-taking trigger. And then here's the dragonfly. This is the strategy we created. It's really a variation on the condor strategy, a non-directional strategy. It's a little more risk averse, and the profit potential is a little bit lower because of that. But here's what it looks like, the structure. So you sell 4 calls, you buy 3 further out and buy 1 closer to the money. And then you sell the same thing with the puts on the downside. And you do this all simultaneously as one order. And then what happens here is after theta decay, the market, you know, kind of does what it's going to do. It starts going up, going down, up and down. But after theta decay, same thing with the condor. The way it works, eventually you're going to get that profit-taking signal here, and then you close out the spread. So you sell it, and then you buy it back for less than what you initially received for it. So we're going to jump into a demo of a trade alert too. We're going to show you how to respond to a trade alert in just a second, where you just simply touch accept on your smartphone or your email response. And there's unique bullish and bearish option strategies that are more than just non-directional, something we call a bull or a bear hedge. And I'll show you that in just a second. But really what this amounts to is if you're bullish, you can buy an out of the money call spread, and that's a debit spread. You pay money for that. But to finance the purchase of that, you could sell an out of the money put spread. So it's just a combination, and we'll show you that in just a second. And the same thing with the bear hedge. And a lot of people kind of consider this for maybe hedging their stock portfolio too, because you're long a put spread down here, and to pay for it, you sell an out of the money call spread. All right, but here's the thing. You're probably just as confused now as this chap here, and I think that's Jackie Chan. Anyway, but like, where do you even start? How do you know where to begin? What strategy to apply? At what price? You know, what's your timing on your entry? Now, how do you manage it? How do you manage the risk and the profits on this type of strategy? You know, there's millions and millions of possible permutations and combinations of options trades that can be made on any given moment. But our answer to that is Theta Trader. These are pre-built option spreads. Our proprietary algorithm creates what we call theta trades every day, and as well as the one-touch responsive trade alerts. So bull, bear, and flat market conditions, any strategy can be applied to any market. And then we use automation to manage your profit and your risk with something called the risk thermal indicator. So that's color-coded for your exit strategy, whether it's a win or a loss. So I'm going to have to switch screens, and we're going to jump over to the Theta Trader dashboard. Okay, so here is Theta Trader, and this is just a demo account I use for presentations, but you can see we do have some trade alerts that populated the dashboard here, and I'll show you that in just a second. But here's the Theta Trades section itself, and you see there are bullish and bearish and neutral or non-directional strategies that are already kind of set up for us. And we're looking at these three markets at the moment. Theta Trader focuses on the E-mini stock indexes. So the E-mini S&P 500, NASDAQ 100, and Russell 2000. And simply put, that's where all the volume is on these options in the options markets. And that gives you the better bid offer spreads. So down below here, you'll notice open short positions. So these are all the short spreads that have been placed in this demo account prior. And you'll notice different colors here, and I'll explain that in just a bit. Then any open bought or long positions are right here. And then here is your account details, I guess you could say, your account info pulled directly from your AltaVest trading account. So Theta Trader is integrated with your AltaVest trading account. And then your prices up here on those indexes we talked about. But why don't we take a look at, we looked at the Condor and the Dragonfly. And here are two examples of a Theta trade for today. And the algorithm sometimes will have just a couple trades, or sometimes it might have 5 or 6 with more time till they expire. This happens to be kind of a little bit shorter data than normal, but we'll go ahead and just click on this. This is the May end of month expiration. We're going to drill down. You can see it's chosen the strike prices for you. It's already calculated your profit potential, and this is called your targeted annualized return. So it's there to compare one trade to another. Sort of like an apples to apples comparison, I guess you could say, in terms of if you want to look at condors, you might look at the idea of, well, what's my maximum profit potential? What's the targeted annualized return? So on and so forth. But first thing I like to do before we look at all these numbers is look at a graph. I don't know, there was a gap in the data here, but you can see this is what it looks like. Here's the current market price. You're selling this out of the money call spread, and you're selling this out of the money put spread. And here's the expiration date here, that vertical purple line. And then you'll notice here, 18 days till expiration, the premium, the put risk, call risk, commission, cash required, profit potential, targeted return on cash, and then your targeted annualized return. And let me show you the strike prices here. You're selling this put, you're selling this call, then you buy a put and you buy a call for protection or to hedge the position. But I wanted to point out is, look at the put you're selling. It has a delta of 9.99. So that means there's over a 90% probability that this put you're selling to someone else will expire out of the money. And then you can see the call has a delta of 2.85. So, 97% probability that the call that's being sold is going to expire out of the money to whomever else you sold it to. And that's I guess that's kind of the key behind these kind of strategies, is the higher probability mathematically here that these options will expire out of the money. So you notice $920 cash required, your maximum profit potential is 71. So it seems a little bit inverted, like you're risking the maximum of 928 to only make 71, but that's why these deltas are important to look at, because the math says there's a high probability of that trade being a winner. So that's the distinction there. Then it's a condor that we're selling, so it always defaults to a sell, and then you can change the quantity here, go up or down. We'll just say, for the sake of this demo, we'll do 8 of these. Or did I do 8 or 9? Looks like I did 9. And because we're in a demo, it just assumes you're filled. So that's how that works. Now, if you wanted to look at a dragonfly, we can do that too. And then I'll show you a really great feature with a trade simulator. You can kind of go backwards in time. I'm not sure why it's taking its sweet time here. But what I could do is point out the trade alerts. You see the active trade alerts. So these get sent depending on market conditions, once, twice, 3 times a week. It just depends. And you'll receive those on your dashboard. You'll see them here like this, or you'll receive them also with an email, and also on your phone. You'll get a text message, and it will take you right to that alert. So we'll go ahead and look at one here. I loaded this, so you'll see here is an alert for a dragonfly spread, and there's a little commentary about it. And you can see the graph here, the calls on the dragonfly, the puts on the dragonfly. Here's the expiration date. It has 34 days till expiration. And this is the June expiration, June week 2, I should say. And the quantity is already pre-selected whenever you receive a trade alert, because obviously Theta Trader knows what you've got in your account, and the alert's going to come to you based on what other trades you have in the account. So you won't get the same trades, you won't have any concentration risk, I should say, and you'll be kind of diversified among strikes and expirations and markets. And then the quantity here, you can see it's pre-populated at 7 in this example, but you could go lower if you wanted. You cannot increase the risk. You cannot increase the exposure on the alert, but we'll go ahead and do accept here, and you can see that's just how that works. I don't know why this is still, I'll just refresh the screen. So that's how the alert works, and I think we had another alert here as well. Yeah, so here's a week 3 dragonfly, and this has 41 days till expiration. We'll go ahead and accept that one as well. So that's just that easy. And now I'll go ahead and show you a dragonfly. I typically just choose the trade here that has the most days till expiration when I'm doing a demo like this. So this is the mini S&P 500 dragonfly for the July week 3 expiration. You can see your maximum profit potential is $438.50. We'll look at a graph. You can see your expiration date here, and we're always going to be out of these trades before expiration date, whether it's for a win or a loss. But it's good to kind of look at the graph, I think, just to get a perspective on where we are. And you can see the cash required is higher than a dragonfly. It's because you're selling a minimum quantity of 4 puts and 4 calls. If you were to do 2 dragonflies, it would be 8 puts and 8 calls. And the ratio of all the others, of course, would move up accordingly. But you're looking to make $438.50 you're putting up $4,561.50 as your margin. But again, you look at the delta, 9.48 and 5.73 on the puts and calls that you're selling. So over a 90% probability and 96% probability that these puts and calls that you're selling are going to expire out of the money. And then maybe we'll do 3 of these. You can see your cash required moves up or down depending on the quantity. And we'll go ahead and place that order. And that's how simple that is. Okay, now I want to show you a time machine. Let's say we can go back in time and look at some of the trade results and the strategy and how it would have performed in different scenarios. And you can do that under what we call the trade simulator. And I've loaded a couple already for us. Right here. Let me squeeze the screen down. So this is a February end of month iron condor, and you've got these tools, controls down here. You can go forwards or backwards in time. And this trade would have been from January 15 of this year with 45 days till expiration. Or you can go directly to the end, or you can just press the play button. We'll kind of watch this play out. And you see the RTI is changing colors. Yellow means slightly elevated risk, but do nothing. You can see the P&L on the trade is negative, and that's pretty typical because theta decay hasn't worked yet. Not enough time has passed. And now you can see the trade is turning positive. It's starting to move a little bit higher, a little closer to that upper boundary, but then it turns blue, and that means take profits. So when the RTI gives you a blue profit signal, you can have this automated so that an order is placed for you automatically to close out that position. So here you would get out of this trade with 8 days remaining till expiration on that iron condor. Now let's look at a dragonfly. Now that's the end of month February condor. And what if you also had done an end of month February dragonfly? Kind of looks similar. It gets yellow, then the RTI goes back to green. But then look at this, it turns blue. You get a profit taking order with 22 days before expiration. And you compare that to the condor, you had to wait in that trade, what is that, 14, almost, 2 weeks, I guess, 2 weeks longer before you had an opportunity and it matured enough to take profit. So we really like the dragonfly a lot. It's a little more risk averse. Your potential is a little bit lower, but you can also close out the trades earlier oftentimes. Or a dragonfly may not have a loss when a condor might. So it's just a trade-off, risk and reward. And here's another one. I've kind of forgotten actually what's going to happen in all these, so let's find out. Here's another condor. And then it turns orange, so even more elevated risk. You can see the trade is losing money, and you can see why. It's getting really close to that upper boundary, that short call. But then it pulls back, and then it finally turns red, and you get a signal here that says there's too much risk, close out the trade, and this would be a losing trade if you took that exit signal. And of course, if you stayed in it the next day, maybe, oh, gee, I shouldn't have gotten out, but that's all hindsight, right? But this can be automated so that you get out of that trade automatically. So that's the week 3 July condor. So here's the week 3 July dragonfly. And look at that. You actually have profit taking signals with 22 days till expiration. So that's kind of a good example of you can have a condor that ends up taking a loss, but the same expiration, same strikes on a dragonfly actually becomes a winning trade. So, again, you own this call right here compared to the 4 that you've sold. This has a higher delta and you own it. So it's going to increase in value more rapidly, and theta decay won't negatively impact it as quickly. So totally different risk and reward characteristics there. All right, let's let me show you something here on. Let me do this here. Let me just move that out of the way. Okay, so I pulled up my MetaStock charts here, and you might be thinking, well, what is the trigger? Why? I see what you're doing with the options tool and these strategies, but when would I ever place a condor or a dragonfly or sell a call spread or a put spread or what have you? You know, some of you probably have your own triggers in your own systems, and you know, MetaStock's a very powerful tool to build all that as well. But you can also do something. I think the benefit to some of these strategies like a dragonfly is there's a wide margin of room for error. So you're not necessarily having to really pick a direction, you know, with an up arrow or a green arrow or down arrow, red arrow, whatever that might be. And here's an example of what we sometimes do. It's just one small element of what we do when we're looking at trade setups, but we might look at a Bollinger Band and an RSI on a graph, and then we'll look at the close, and if you have two consecutive closing sessions below the lower end of the Bollinger Band, and this is just the default setting on the Bollinger Band here in MetaStock, but so you have two consecutive closes here. At the same time, you have an RSI that's deeply oversold. You know, it's below 30 at this point. So if you have these two elements in combination line up, that might be a good opportunity to think, you know, I think we're oversold, and we're going to go ahead and, you know, place a trade, and maybe we'll sell an out of the money put spread, or maybe we will place a dragonfly spread, and you know, with the idea being that there's probably some mean reversion possible. So looking here, this is March 11 or March 12 would be the next day. So what I did here is I just went back to that date. So this is March 11. And let's take a look at a dragonfly and see how that worked. And look at that. It only took not even a week before it matured and you had a profit-taking signal. So that's just kind of one of those things where you're not necessarily looking for a particular direction. You're not looking at something to make a, you're not buying a ticker in this case and trying to pick the bottom necessarily, but you're thinking, well, there's a good chance we can get some mean reversion or some consolidation or something to that effect. And you can even look at the NASDAQ. We had a similar situation. Looks like right here, you know, 2 days below the lower end of the Bollinger Band, and then also deeply oversold, you know, down around 25 on the RSI. It's like, okay, well, there's probably going to be some mean reversion in that case, and so we'll jump over to the NASDAQ. I've got that lined up here. So let's say we did a dragonfly, and then again, you get that profit-taking signal with 15 days till expiration. So that's how we kind of like to just start as a kind of a first look, I guess you could say, when you're looking for some of these trade setups. And then what do you do? What kind of strategy do you apply after you've got a setup? And we really like the dragonfly a lot. And of course, you can do call spreads, put spreads, or buy premium as well. But here's something else I want to show you. And I mentioned, you know, there are bearish and bullish and non-directional strategies, but here's something called the bear hedge. And really, it's just a combination. And I think I pointed it out earlier. I don't even need to really show you here. We'll just show you in the simulator here. So what you've got here is you sold an out of the money call spread, and with the money you collect, you buy an out of the money put spread. And you can usually do this for even money or even a credit. So the trade doesn't cost you anything. That's really the beauty of it. Now, of course, it can still go wrong, and you have to cover your risk, but you can usually get into this trade for no money or even money. And these colors are all going to be a little different because of the nature of the spread here. One side is a debit spread and the other side's a credit spread. So don't worry about the colors so much. Just look at the P&L. And you can see in this case, market dropped. This bearish strategy, is going to work well in that case. So of course, if it ran higher, you'd have to cover the risk on the short call spread, and you'd probably end up with a loss. But just wanted to give you some idea on how that works. I want to show you also under the account settings here, you can activate your risk manager, and that's the automation. And you can activate and choose between the red and orange or a custom level of risk. So the red is the default, that's the 50 delta, or you could go down as low as 20 if you wanted. I'm sorry, 25. But keep in mind, if you do that, there's nothing wrong with that, but you'll take more losses, you'll have more frequent losses, but they'll be smaller. Each loss will be smaller. So I just use the default trigger here, and then you activate the profit directive by doing that, and then you would save your settings here. And that's just that simple. So Theta Trader will scan the account every day for you, monitor it, and according to your risk and profit directive, it will then submit those orders for you. Also want to point out we have our daily commentary and daily research for you. We do this providing an overview on what's going on in Asia and in Europe, and of course in the US, and then we look for what's on the calendar ahead, and also any of the economic calendar data points, earnings and that so forth. And then we also have something called Trade Scope, which is looking at a few charts. And a market outlook going forward. And we follow some options research as well. We convey that in Trade Scope. So that's all part of our proprietary data and research that you have access to when you work with us. And then also in Theta Trader, there's a great help file. I just want to point that out. There's videos here on how to use the software, place orders, education, and also there's a glossary which will really help you get a handle on the color coding. We're not going to go into all the details, but it's real simple, and some more definitions on all the spreads if you need it. So that is all part of Theta Trader. And let me kind of go back and make the screen a little bigger. Okay, so there you have it. And also you can go back and look at your closed positions here. Let's take a look at what these look like. And again, this is just a demo account, so don't put too much weight in it. You can see on the page, you've got 20 trades, there's 14 winners, 6 losers, with your profit. But this is interesting. This is sort of, you've got 14 short positions here on the screen, 11 winners and 3 losers. And then you have 3 bought positions that were winners and 3 that were losers. So it sort of makes sense that we talked about the higher probability outcomes are going to be selling premium, collecting premium, and it sort of shows here again, but don't make too much out of this. This is just a demo account. You saw how I'm just randomly placing trades. And if you want to go back in time, maybe you can just click on any one of them. So you can see the one highlighted there, and you can go back and you can see, okay, this was done on April 10, had 22 days till expiration. You can see day by day goes by. RTI is green, it means good, do nothing. Then it turns blue and take your profit, and then you're out of the trade. So all of that is available to you as well. You can go back in time. Now let me show you how the alerts work on your phone. And I see some comments and questions coming in, it looks like, or maybe I saw something blinking, but anyway, if you have any comments or questions, feel free to put them in there and I'll get to them. But let me show you really what I think is the best feature of all. Go back to the screen here. So this is what it looks like on your phone. You receive that alert. These are one-touch responsive, accept or reject. And these are integrated with your AltaVest trading account. So there's nothing else for you to do. You don't have to log into another platform or brokerage account somewhere else and try to replicate the order and type it in or build it. It's already done for you. So here's what it looks like. You'll get this text message on your phone. And of course, you touch that link. It takes you right to the alert page. You get the graph of it. You get a description of it. You can see the quantity there is pre-selected for you. Each alert is tailored to you and your account. You can see the entry price here, the quantity of 9, and then also the amount you're collecting here, premium, cash required, days till expiration. Then you like what you see and you just simply touch accept, and that's all you have to do. So there is a brief overview of ThetaTrader. I think we covered a lot of ground. And let me show you how to get involved. You become a lifetime ThetaTrader member. So you get everything we just talked about with the ThetaTrader software. So that includes the Theta trades, the RTI, that's the color coding and the automation, and then the trade simulator, valued at over $3,500 on that software. And then of course you have the trade alerts, that's all part of ThetaTrader. Again, everything is integrated with your account. You just touch accept, or if you don't want to place the trade, you can just touch reject, that's fine too. And then once you have that order filled, then you saw how the color coding of the RTI, the risk thermal indicator, will then automate the exit for you. So you don't have to babysit. You're just getting your account scanned every day by ThetaTrader. So you have everything we just talked about, the software, the alerts, valued over $8,000, and then you have us. So I think that's a big distinction. You actually have a coach, and I heard Norm, before I spoke, talk about kind of a similar setup he has with, he'll get on the phone with you and share the screen and give you that coaching. So we do the same thing here with our options trading. We'll do these 1-hour screen sharing sessions. We're all Series 3 licensed and experienced. So you kind of have a co-pilot is kind of the way we look at it, and we can discuss your trading with you. I think that's really invaluable. I know people have spent, not people have spent. I do talk to people, and they, yeah, I've spent $20,000 or $25,000 on this or that education. But you know, with ThetaTrader, that's all part of your ThetaTrader membership. So just to summarize, everything we just talked about, valued over $15,500 on the software. And then remember the research that I mentioned, the proprietary research, that's all part of it too, $2,900 value there. And then I mentioned those online video tutorials, that's just part of the ThetaTrader software. You probably won't even need them because it's so user-friendly and intuitive. But again, this is a lifetime membership to ThetaTrader. Software, the alerts, and the coaching, and all the research, $18,504 value. But of course, that is not what we're going to offer this at. This is a live in-person event. In the past, we used to do this at $4,000 in these live conferences and so forth. And our retail price on the website's $997, but we're going to do much even better than that. One payment, $497. So there is the link, cf.altavest.com/meta, short for MetaStock, of course, where you can use the QR code. And that's my name and number. So if you had any comments or questions along the way, you can always reach out to me. And let's see here. If you want a free membership, people love to take us up on this as well. If you have an account with us of 100,000 or more, you'll get a 100% rebate, or 25,000 to a $99,999 account, you get a 50% rebate. But take us up on that offer, and 30-day money-back guarantee. So if you sign up and something happens 29 days later, just let us know. We'll refund that. That's no trouble at all. A few FAQs. We mentioned why the E-mini futures options. Well, that's liquid, they're efficient, they're cost-effective. here's your annual average daily volume. You know, you're talking almost 1.5 million contracts in 2024, and it just keeps growing. So that means you get superior execution and cost savings compared to SPX options, and that's based on an article from the CME Group. So you get those tight bid offer spreads, and then you get that deep liquidity and a wide array of maturities. So densely packed strike prices and 100 annual expirations gets you that granularity and coverage. And what that means is when Theta Trader and the algorithm is looking for calls and puts to sell and buy, it's going to find them in these markets. If you try to do a dragonfly in a typical securities market, there's lots of reasons why it won't work. But you can see here, you know, calls and puts here, and time goes by and another set of calls and puts, and Theta Trader it's always going to find what it needs. You know, this is where the volume and price discovery is, by the way, on the S&P 500. So the E-minis, listen to this, it's almost 10 times the value traded across the S&P 500 ETFs. So the E-mini contracts represent 10 times the value across all S&P 500 ETFs. So it's pretty amazing. And there's no day trading restrictions when you're trading futures and options with us. So you don't have that regulatory scrutiny and limitations when your account drops below a certain amount, and you know, then you're prohibited from making further day trades when you get designated as a pattern day trader when you're trading securities. So something to keep in mind. Margin use is efficient, and there's tax efficiency as well when you're trading futures options. So for example, I won't go into all the numbers, but in this example here, if you're trading futures options versus a stock option, you're going to have a big tax savings in this example. And that's because your capital gains, your 60% of the gains are taxed at the lower capital gains rate. The IRS treats the gains differently. It's section 1256 contracts. You could look those up if you wanted, but always consult your tax professional. Another advantage here is no more itemizing. You just get a 1099 with your end result for the year and use that for your taxes. So again, always consult your tax advisor. And IRA, absolutely. We have those accounts transferred to us all the time. We mentioned why the Dragonfly with us. Well, you can do a Dragonfly. That's 6 legs of an option. You do it as one trade at one order, one price. You don't leg in. If you do this with securities, you're going to have to leg in and do 2 separate orders. And I think it's a bit of a nightmare. And this is really a sophisticated option strategy. So that's what Theta Trader gives you access to. Now you compare that to the retail stock options crowd. And of course, none of you are in this category. But you know, she's talking here again about retail investors only have access to the most basic call and put option strategies. They don't have option spreads or other more sophisticated strategies available. And that's for most retail options traders. And the pros are not just buying options. That's what rookies do, or the you know, the beginner, novice, or someone who wants to hit a grand slam. So it's really the worst strategy to rely on, because if you only buy those options, then time or theta decay is always working against you. And she mentions again here, the appeal for retail investors to buy options is that they're much cheaper, but potential for profit is not that high. This is interesting. In 2021, 11% of Robinhood's active users made options trades, but of that 11%, fewer than 1% actually made a multi-leg options trade. So I thought that was a crazy statistic. It's a few years old, but I think it's very similar. So more advantages into doing what we do, kind of tooting our own horn here, but it's easy to track just a couple markets, not thousands. There's a clear cost structure. There's no payment for order flow. There's no margin calls with covered option spreads, no naked options. So no unlimited risk and no margin calls. You don't want this phone call coming in there from margins, right? And this was a good joke here. She says, who is margin and why does she keep calling you? So none of that with us. Every strategy is covered in advance. Fees are 5 1/4 round turn, and that's all inclusive. So that covers all fees. here's an example where it looks on the surface like, this is a big box brokerage firm and this is their rate. It's 2.25. It's, a much less than you guys. Well, read the fine print, and that's only per side. That's only half in. You pay that in, and you pay more, the same thing when you go out. And then you have other clearing fees and exchange fees, and it ends up being more than what we charge. So our rates are very competitive, and everything is net of trading cost in Theta Trader. I should have pointed that out. And everyone has their own trading decision, so everyone has different results using Theta Trader. And you can do, again, IRA, corporate LLC, individual joint, all those types of accounts. I've got just a couple minutes. I think I'll finish right on time and wrap it up. But having something like Theta Trader as an alternative, it's not relying on any direction. So it may improve diversification and lower portfolio risk. And risk of what? Well, of course, risk of a lot of things, but how about inflation? Look at this. The dollar's down 99% since 1971. I thought that was astounding. And here's the $1 million house when we were all kids, and now this is what it looks like today. So that's inflation for you. And then remember too, stock market drawdown is going to last decades. You had that NASDAQ was down about 80% in 2000 by 2003, I believe it was. And it took 15 years to recover. So if you were unlucky and bought at the worst time there, near the highs, it took you 15 years to recover if you were just passive. So we think Theta Trader is a great alternative, non-correlated. You got strategies for all conditions, wide margin of error on some of these non-directional sort of condor and dragonfly approaches. The automation saves you time. You can diversify. Then you get those one-touch responsive trade alerts. So strategies for any market condition. You get that wide margin of error. Look at the big wide and the spread there, 1,450 points between the calls and puts that are being sold. You can save time. This guy spends 10 to 12 hours a day. You probably don't want to do that. We think it'll help you diversify. You don't always have to be just passively long. So we think it makes sense to have a slice of that alternatives pie there. And people love those responsive trade alerts as well. You just touch accept or click on your screen, and then that's all you have to do to place that trade. And you use that link here and you'll get you signed up, you get your login credentials and get your account started. And it's just that simple. So that's going to wrap it up. Let me see if I had any other comments or questions in there.
There is one from Jonathan. He was curious to know what your win rate is for the system.
Well, again, that's it's not a system per se. It's one of those things where it's generating a menu of possibilities, and then everyone's going to use it differently. So that's really the best answer I can give. We're not managing the money for people, so we don't have any performance per se to publish, if that makes sense.
That makes sense to me.
Yeah.
So I didn't include the cf.altavest.com/meta. We've got it out in the chat. Erik, thanks for joining us.
Yes, thank you very much for having me, and have a great day.
All right, thanks for joining us on Saturday.
Yeah, that was fun.
All right, cool.
Talk to you soon. Bye-bye.
Bye. All right. Go ahead and kind of come back over here. I'll make myself the presenter, show my screen, turn on my camera. All right, cool. There is a bonus session that we're going to kind of, that you're welcome to stick around for if you want to. I'm going to be talking a little bit about how to go in and do some customizations to MetaStock. So if you're a MetaStock user, you want to learn a little bit about the formula language, the next session's for you. But before we do that, I want to say thank you to the CMT Association and all of our sponsors, cmtassociation.org, Stocks and Commodities Magazine. You can find them at traders.com. If you haven't yet, join the Traders Forum at www.thetradersforum.com. And I want to remind you that you can sign up for the extended trial for MetaStock. You can get that buy one, get 2 free months. You can give us a call. All of the information on how to get in touch with us. If you want to If you want to call us, 800-882-3040, metastock.com/conf promo or metastock.com/sales chat. It's been rated the best software in its program price category for 32 years in a row. Pricing on it starts at about $75 a month. With it, you can scan scan the markets, test trading ideas, get forecasts for potential price movements, all that kind of good stuff. Greg, I think it's about time we do another prize. Are you ready?
I think it's about time to do another.
All right. And you know it's the last prize of the day, so you know what that means.
That means it's the best prize ever.
Yeah, it means it's going to be the MetaStock Mega Prize.
Hmm.
Oh. Okay. I do, hold on, before we do that, I just realized I didn't save Juan's information. He was the winner of the last prize. Why don't you tell customers a little bit about what MetaStock is? We're going to give 3 months of MetaStock away with Zenith and learn MetaStock. So do you want to talk a little bit about that, or do you want me to?
Yeah, it's MetaStock RT.
Yeah.
Okay, yeah, MetaStock RT, of course, is our flagship version of MetaStock. It's, in my opinion, the world's very best charting and analysis software. It answers questions like, what should I trade? How can I test my trades before I spend my first trading dollar? Where's prices going to come in? It's utterly customizable. And I think one of the interesting things is one of the most intimidating parts about MetaStock, there's so much and it gives you so many tools. And one of the most intimidating parts probably has to be formula writing for full customization, which what is Jeff Gibby going to talk about in just a moment. So that is awesome. And of course, it is powered by Zenith, a world-class real-time marketing data and news that you really can't get anywhere else at this price, definitely not at this price. And what else is there? Oh, there's a training by Kevin, right?
Yeah.
I don't want to say we're giving anything away. Okay, training by Kevin Nelson, the hands-on trading, a premium trading subscription to learnmetastock.com, as well as, because we never want to leave you high and dry, you have access to our support team who'll give you white glove training and setup to get you up and running quick with MetaStock.
Great job, Greg.
Okay.
Now the question I have for you is, do you have your Google automatic random number generator?
I think I do. Yes, I do. It's right here.
All right. Any number between 2 and 6,939.
By the way, I thought that was interesting that, was it Craig that just chose 2 as the number?
Yeah.
that is actually random. Randomness is an interesting concept. Anyway, the number chosen by Google Random Number Generator is 120, which is also pretty low.
That is very, very low. So This is, I'm going to do my best for this. The last name that was registered was Tashepo Hope. First initial is R in South Africa.
Well, I'm sure, I don't know if that's a common name in South Africa, but it's not one I've heard before. So if they're listening, they probably know it's them.
Yeah. Okay, perfect. Thank you very much, Greg. We're going to do, like I said, just a little bit of a bonus lesson here. And I'll try and keep it light, even though I asked to do it formulas.
As light as you can with formula writing.
Get out of my presentation altogether. Yeah. And really,
I'm here if you need me. Break a leg.
Yeah, thank you. And really, if you are interested in MetaStock and kind of digging a little bit, the reason I put this last is because if you're interested in digging into MetaStock and kind of doing stuff like, creating a pre-filter exploration and that kind of stuff, it's actually not that intimidating. It's not that hard. It's not something that you should be nervous about. So very quickly, I'm going to read a legal disclaimer. I'm going to kind of walk you through kind of some basic concepts. I'm going to try and keep it a little bit light. But let's go. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees should have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in this presentation should be construed as investment advice or the solicitation to buy a security. Okay. As we get started, I'm just going to remind you, we've said this already. We're so proud of it. 32 years in a row, MetaStock's been rated #1. I kind of figured I'd kind of cut out all the here's what MetaStock is. We've been talking about that all along. I wanted to set this up as a bonus class so you guys, if you're interested in kind of just diving a little bit deeper into formulas, you can, and you're definitely welcome to. And so if you're still here and you kind of want to watch how to kind of create like a custom scan, I'm here. I'm going to be your guy for that. So today what I want to talk about, some basic formulas, how to create them, some practical workflows for that. And then, well, we've already done the special offer, just those two things. So in any case, we're going to start to get this through a little bit. Well, we're going to keep it really basic. Very basic functions of MetaStock: open, high, low, close, volume, and math operators are very, very, also and or. And what I want to kind of do, a lot of people like to do scanning in MetaStock, but they want to be able to set up what I call a pre-filter exploration. A pre-filter exploration is like, I want to be able to scan all the optionable stocks, but I'm only really interested in stocks that are above like $5 and under X amount, right? I want to be able to set up a pre-filtered exploration so that when I run my scans, they run a lot faster, and I weed out some initial stocks that I'm just not interested in. So that's where I'm going to start, because I think that's the most useful of what I'm going to talk about today in terms of ways to easily kind of go in and kind of manipulate MetaStock. I've got MetaStock open. I'm going to go ahead and click on it over here. I'm going to go ahead and bring it over here. And we're just going to work on that custom exploration. I'm going to go ahead and click on the Power Console right here. I'm going to bring it over to where you can see it. And I'm going to go straight down to the scanner. There's a button right here that says New Exploration. This is easy to do, okay? For this, I'm going to go ahead and name it. You can name it anything you want to. If you have a lot of your own custom scan explorations that you're going to be writing, if you start it with an explanation point, it'll bring it up to the very top of the list for you. And I'm just going to call this the pre-filter scan. Okay, and again, you can kind of put anything in here that you want. For this, I'm going to put some notes in here. I'm going to write this scan to have screen out any stocks that are less than $5, or more than $5, more than $5, and then less than 50. So we'll say that's the range that we want to kind of scan for, and have an average volume. Let's say 250,000 shares. Okay, right. Your notes can say anything. Just really kind of remember that when you kind of hover over them, or if you're going to come back here in the future, that's just going to help you remember what you did with this one. Okay. Down here we've got filter, and that's where we're going to really put some criteria. The criteria we put in here should equal 1, true or false. So in other words, we're going to say, okay, these are the conditions that I want to be true. So if I want, the first thing that I want is I want my close to be less than $5 or more than $5. So I'm going to go ahead and put in CLOSE. Okay, I can put close. I can also abbreviate. I can spell it all the way out. I can also abbreviate it. I can say I want the close to be less than $5. Okay, I'm going to say and. That's all I have to do. And I want the close to be less than 50. So I'd have it greater than 5 and less than 50. I'm saying the wrong things, but close is less than 5 and greater than 50. And for volume, usually what I'll do is I'll look for volume. Volume can be somewhat erratic. It can jump around. So I'll usually, instead of just saying volume is greater than a number, I'll pull an average number of volume. And here's where I'm going to kind of get into the functions of MetaStock, because there's hundreds and hundreds of different indicators, functions that you can use. I'm going to go just pull a moving average. We won't spend a lot of time working with these functions, but if you want to pull like stochastics or moving averages or anything like that out of the program, you can find them all right here under functions. And what I'm going to do is I'm going to come in here, all kinds of functions that I can access, In this case, I just want to find the moving average. Okay, for that, I'm going to come to indicators. You see where, since I've searched for moving average, it's available right here. And right here, it's going to tell me exactly what I need. So I'm going to go ahead and grab that. And I'm just going to go ahead and kind of fill it in. So the moving average would be the date array. You could make a moving average of close, open, volume. In this case, we want our volume. We'll do just like a 50 period. And I'm just going to leave it, this means exponential simple. I'm going to leave it simple for that for now. We just want it simple. We're going to keep things fairly simple right now. Okay. I'm going to say I want that moving average, I want that volume of the moving average to be greater than 250,000. That's it. That's my pre-filter scan. That's ready to run. I don't have to do anything else to it. I can actually run that against all the optionals or against all the stocks, and it'll filter out all the stocks that don't kind of meet that criteria. Now, if I want to add a couple more things, we do have the columns here. You've got column A, B, C, D, E, etc. If I do want to be able to see what the close is, I can click into A right here. And I'm just going to put C for close. And if I double click on A, I can kind of just type in close right here. Okay. If I want to see the volume, I'll click in the B column right here. And I'm going to type in V for volume. And then I'll double click into the column here and just say volume. Okay. Now I'm not going to run this against a huge list just because like it'll take a few minutes and you know, but I want to just kind of give you an idea of what that's going to look like. So I'm going to go ahead and click on OK. It says there's a mistake, and you'll notice it says, and that wasn't on purpose. I just made a mistake. I forgot to add the word "and" here. So now I want the close to be less than 5 and the close to be greater than 50. And I want the moving average to be greater than 250,000, okay? And that looks okay, except for this is the wrong way. No, that was the right way. One of these is wrong. Close is greater than 5 and close is less than 50. Okay, so now I've got it correct. I'm gonna go ahead and click on OK. My new exploration, if I just type in here, there's the pre-filter scan that we wrote. I'm going to go ahead and click that. Now, I actually have a few scans selected, so let me go ahead and unselect them, and we'll just select that little pre-filter scan. Those notes, if I hover over it, it'll tell me exactly what the notes were for that. We go ahead and select that. And then just to kind of keep things fairly quick, I'm just going to run it against a very small list, so I can kind of show you how to save that list. So I'm going to go ahead and I've got right now the Dow Industrials, the NASDAQ, and the S&P 500 selected. I'm going to go ahead and run that exploration. I'll go ahead and kind of move this over here. It's going to go through, and it will reject any of the stocks that don't meet that criteria. Okay. And then I can also see if there's any mistakes because we're rejecting a good amount of these. So I think there might be a mistake in the formula, and that's okay. We'll be able to figure it out pretty easily. If you guys have questions as we go, let me know. Yeah, 84% seems a little bit high. So anyway, right here we've got 84. Close is 9, 14. So anything between 19 and 50 is correct. The volume appears to be correct as well. Okay, all right. So there we go. We've went in, we've created that pre-filter scan. If I wanted to save this, what I can do is I can just right here, I can save this instrument list. Let me go ahead and do that. Go ahead and click on New. Oh, actually, you see I have right here a pre-filter already. I'll go ahead, click on New, or you can add it to an existing list. I'll go ahead and click on New, pre-filter New, and we'll click on OK. And then on a day-by-day basis, when I'm running the scan, instead of scanning the whole universe, I can just scan this pre-filtered list. So that's the way that that works. Okay. And as Greg says, if you have questions as we go, I'm very good about answering questions. So that's how you do a little bit of a pre-filter scan. There's a couple more different workflows just to kind of get you an idea of how things work. And so what I'm going to come in here and do is, we created an exploration. Where is my, there we go. Right now, I just want to kind of give you an idea of how to create an indicator, and then we'll do some things with that indicator that might be a little bit of a fun. Okay, to do an indicator, I'm going to basically draw out a pivot indicator. Okay, a pivot indicator, if the pivot midpoint is if we took the high of the day, the low of the day, and the close of the day, and added those values together and divided it by 3. That would give us the pivot of the day, okay? And then you have R1s and R2s and all that kind of stuff are calculated above that. But if I wanted to just create a pivot indicator, if I had an idea of some math that I wanted to create and I wanted to show it on the chart, I can actually create it. In this case, this is the MetaStock code. So let's go ahead and kind of put that in as a indicator real quick. I'm going to go ahead and just click right here in the indicator builder. I'm going to go ahead and click on new. Okay, I'm going to say this is the pivot indicator for conference. Okay, and we'll do some other stuff with this, but for right now, what I'm just going to say is I want to take high plus the low, plus the low plus the close. I'll take those 3 values, add them together, and then I'll divide those by 3. Okay, I'm going to go ahead and click OK right now because that's what I need. I'm going to go ahead and click on close, and now we've got the pivot indicator for the conference. Okay, I'm going to clean up this chart real quick. I'm going to detach the expert advisor. I'm going to delete all the indicators on this chart already. Indicators, close empty windows, and we'll just plot that indicator. So that easily, oh, I think I hit indicators, close the empty inner window. Okay, so now we've got a fairly clean chart. That easy, we were able to kind of go in here, and I'm going to go ahead and push this as a dot. I'm going to make it here. We'll go ahead and click on OK, and we'll display a new scale on the left. Oops. Actually, didn't want to do that. Where did it go? Let me go ahead and plot it again. I'm going to do it as here. I'll do it as a line this time with a little bit of thicker. Click OK. Yes. I want to merge this with the scale on the right. Okay, there it is. So there's my pivot indicator. I've got it all calculated, et cetera, et cetera, et cetera. Okay. The next thing I'm going to play with this, just to kind of show you how it works, is let's make a moving average of that pivot indicator. Okay, we made a moving average of the volume real quick before. If I wanted to do a moving average of anything, I can do a moving average, and we just basically kind of use that as a function list. Okay. In this particular case, what I'm going to do is I'm going to come back into the indicator, and I'm going to actually define my pivot indicator as a variable. So let me come in here. Okay, whoops, where is it? Let me come into here to the properties dialog box. I'm going to come back to the formula for that. And the way I'm going to define this as a formula is I'm just going to call it X for now. I'm going to say X semicolon equals, and then I'm going to say, okay, my pivot value. Okay, so now, and I'm going to finish this statement by putting a semicolon. Now, instead of typing the pivot formula every time I want to use the pivot formula, I can just use X. Okay, so I've defined that as a variable. Okay, now what I want to do is I'm going to come back into the functions dialog box. I'm going to come back to the indicators, and this will list all the functions that I can use. Again, I'm going to keep it kind of simple today. What I'm going to do is I'm going to do a moving average. Let's say I wanted to calculate a moving average of that pivot that we're using. Okay, so here we go. I'm going to do a moving average. I'm going to have it paste the argument in there for me. So I'm going to go ahead and click on OK. And then it's just going to remind me what it needs. So I want to do a moving average. In the moving average, I could do open, high, low, close, volume. I could also do X because I've defined X as my pivot. Okay. For periods, I'm going to keep it at about 12. And I'm going to still do I won't do exponential. I'm going to do a simple calculation here. So a simple moving average. I'm going to go ahead and click on OK. And now what I've got is a moving average of that pivot point. Hopefully this is easy for you. Hopefully you're following along, but it's actually pretty easy to put together. And now all we have is we've got a moving average of our pivot value. Okay, we're going to play with this a little bit more. So what I'm going to do is I'm actually going to take this actual formula. I'm going to put it, oops, I'm not going to take it completely out of there. I'm going to put it on a notepad because there's a few things as I kind of teach you how to kind of work with some of these power tools that that we're going to work with here. Okay. So I'm gonna go ahead and click OK here.
Hey, Jeff?
Yeah.
Do you think it would be helpful to copy the formula into the chat?
We could do that. Yeah.
Or maybe when you're done, the final bit, not periodically.
Yeah, there's what we've got right now.
Okay, there you go.
Yeah. Okay, let's kind of jump in here a little bit more. And kind of the purpose here is to kind of just show people how easy it is to do. And hopefully it's easy. Does it seem pretty easy, Greg?
Yes.
Okay.
Very
simple. So we just defined our variable. We did
so simple that Greg could do it.
Yeah, there you go. Good. Now, what I want to do now is just show you how we can take that simple formula and make some changes to the way the chart appears. If this is something that we want to use, or if we want to create our own custom highlights or symbols on a chart, I'm going to show you how to do that using an expert advisor. Okay, and then we'll do a system test and then we'll be done. So let's go ahead and go into the expert advisor. Right here, I'm going to make a new expert advisor. Again, I just want to give you some ideas in terms of the way that this can work. So I'm going to come into the expert advisor. I'm going to click on new right here. Right here, there's the new expert advisor. And over here, we have a dialog box. Okay. I'm going to name this is just conference expert. And I just want to give you an idea, demonstration purposes. Okay. Okay. We're going to just make up some stuff to kind of just show you how this works. We've got a trend ribbon. I'm not going to really mess much with the commentary today. We can do that if you want to see that. We could do that at a future thing. I'm going to show you how to do highlights. I'm going to show you how to do symbols and even alerts. So if you have simple things that you want to create that are like this, you can. The first thing I'm going to do is we're going to come back to my pivot code that I put on the thing. And what I'm going to do is I'm going to come to the trend ribbon here. Okay. And I'm going to say that if it's above, if right now the price is above, let's say the close is above this value, this moving average value, I'm going to say that that's bullish. Okay. I'm going to take this value out exactly the way that it appears. Okay. And I'm going to say, okay, if this moving average, right now it's just telling us what the moving average value is, but I'm going to say if that moving average is lower than the close, that's bullish. I'm going to take the same criteria. I'm going to say if it's greater than the close, then that's bearish. Okay, yeah, bearish. So greater than the close. Okay. Over here, I'm going to click on the ribbon. I'm going to take the patterns out of them because I don't particularly like them, but I'm going to go ahead and click on OK. I'm going to go ahead and click on OK, and then I'm going to attach this to the chart. And you can see that easily we can see where we are. When we come up above the pivot, we're bullish. When we come down below the pattern, we're bearish. Okay, so that's the trend ribbon. Okay, let's play with it a little bit more. I'm going to go back into the expert advisor and play with the properties. But let's say I wanted actually to change the colors of the bars. Okay, I'm going to go ahead and do that. I'm going to use exactly the same bullish criteria that we had before. In other words, I'm going to say this, if the moving average is greater than the close or less than the close, then I want to have green bars. Okay. I'm going to take that to my clipboard. We're going to click OK, and then I'm going to make another one that's bearish. And I'm just going to say that if our moving average is less than the close, it's bearish. Now I think I might have had that wrong. So what I'm going to do is I'm going to click OK. I'm going to highlight the chart and see what happens. So yeah, we did have it a little bit wrong. I'm going to zoom in a little bit here. when we're down below the close, it should be red. And that's just, I think, a problem with the way I have my code in here. So let me double check it real quick. When it's bullish, we want the moving average to be less than the close, right? Mm-hmm. Yes, okay. And when it's bearish, we want it to be greater than the close. Wait. I think, let me go, hold on. I'm confusing myself. I want the close to be greater. Okay, let's check. Okay, now I've got it correct. Okay, I always have to remember the trick that when you want greater than or less than, Pac-Man is gonna, you view the greater than as Pac-Man wants to eat the larger value. So that always helpful. But now you can see kind of we have a highlight where as long as we're up above our pivot value, we're gonna have that above the close. Okay, we can use the same things. I'm actually gonna go ahead and grab this real quick. Actually, no, I'm not. We can use the same type of idea if I come in here and I wanted to actually go to the properties dialog box. And what I want to do now, I'm going to introduce you to a new function that's called cross. Okay. If I wanted to get an annotation on the chart when something happens, like when it went from being down below to above the moving average, I can use a function that's called cross. Okay. So what I'm going to do here, this is a cross. And I'm going to use the same type of functionality, but instead of looking at the greater than or equal to, I'm going to say when there's a cross on the chart of that moving average and the close, this is how you write it up, then I want to put a notation on the chart. Okay. In this case, what I'm going to do here, I'm going to come over to the graphic. I'm going to make it a dot. I'm going to make it kind of bigger. You go ahead and click on OK. And then I'm going to delete that space because it can't be there. Okay. I'm going to go ahead and click OK here. And then I'm going to do another one for when it crosses under. Okay. When you're using the cross function, in this case, you're looking for the moving average to cross up. In other words, you'd be looking for the price to come down while the moving average crosses up. If I put the close first, then I'm looking for the other cross. Okay, we'll go ahead and click on OK. I'm going to go ahead and click on OK. I'm going to go ahead and I didn't have to refresh the chart. You can see where those crosses happen. So the cross up defaulted to a thumbs up because I didn't set it as a circle, but you kind of get the idea. It's very, very easy to kind of come in here and get these types of of notations on your chart. If you want to set up an alert, you can set up an alert. It'll pop up an alert. You can have it send an email to you and that kind of stuff. But you use exactly the same programming type of a thing. So for example, if I want to be alerted when that cross happens, I'll come into the expert advisor again. I could take these cross functions and literally paste them over here to alerts. And now they're turned on to alert me when that happens. Coincidentally as well, if you want to scan for these crosses, you can take that same code and put it in a filter like we did with the filter exploration, and all of a sudden you've got a scan. So once you kind of have the math written out for the way that you want it, it becomes very, very, very easy, very, 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 very easy for you to identify when that happens, okay? I want to show you one other thing. Again, I don't want to get too, we have some pretty cool resources for learning about how to do this stuff. But once you kind of figure out how to do it, you can use any of the indicators. You can easily create your own buy and sell system so you can see how well they work. And you can test them. And while we've talked a lot about testing, I'm coming over here. I'm going to take the criteria that we have for our crosses. And what I'm going to do is I'm going to show you how to take that same criteria and make a system test out of it so that we can test to see, okay, well, if we buy when it crosses up above this, is that good? So this right here would be our bearish cross. Okay, I'm just going to make a note for me later because we're going to do this. And I'm going to take the same criteria that we've got for the bullish cross, and we're going to create a little system test. That's all. And then we're going to kind of go and enjoy our Saturday Okay, so like, let me go ahead and grab this bullish cross. We'll click OK. Okay. Now I'm going to go and I'm going to take those exact same functions and I'm going to put that in here too. And we'll test it. We'll see how well this works as a trading idea. Because again, it's not that hard. Okay, move this over here for now. I'm going to come in here and come to the power tool called the system tester. Okay, what I'm going to do is I'm going to create a new system test. Okay, under general, I'm going to name my system. I'm going to call it the conference May demo. Okay. Okay, I can put whatever notes I want on here. And then I'm just going to take that buy order, okay? The buy order, if we want to test every time there's that bullish cross, this is the bullish cross. I'm going to say that's our order to get into the market, okay? Let's say that I want to sell that order, okay, when the other cross happens, okay? So I'm going to take the other criteria. Where's my other criteria here? This would be the bearish cross. I'm going to put that in the sell order. And let's say, okay, so this right here will get us long when we cross up above this pivot. It'll get us out of that long position when we cross back down, so right here. And then when it crossed back up, it would get us in, okay? Let's say I wanted to also go short, okay? So this will get us out. If I say I want to open a short order, I'd use the same code. So by putting it here every time we cross under, not only will we exit a long position, but we'll take a short position on, okay? I'm going to come over here to the buy order, and I'm going to say when it happens, when we get the buy signal, we're also going to exit our short position. So we've just basically put it in so that every time we come up above this moving average of the pivot, we'll go long. Every time it comes back down, we'll cover that long position and go short. Every time it comes back in, we'll cover that short position and go long. Hopefully that makes sense. Okay, I'm going to go ahead and click on OK. And I'm just kind of curious in terms of how well this works. But that was, oh, wait, but wait, there's more. I forgot to actually kind of just mention a few other things while we're in there. For the conference, oops, May demo, let me just kind of review some of the other tabs here. We do have stops. So if you wanted to come in here and put in stop losses, you can do like a maximum loss, a profit target. If it's not changing, you can have it get out of the position. You can put in trailing stops, and it's very, very easy. Like if I wanted to add a trailing stop, I can say put a long stop, or put a long trailing stop and a short stop, and I'm willing to risk 5% or 10% or whatever it is. So it's very, very easy to add those as well. So I'm gonna go ahead and click on OK. And that system test is actually ready to go. Just for fun, I'm going to kind of run it against Tesla. Okay, I don't know that it's going to perform well. We just kind of, it's like an example system, but let's just kind of, I'd want to, we could compare it. Let's just run it. So that easily, we were able to create the system test. We're able to test it. And on Tesla, if we just kind of wanted to look at the report, this particular system worked about, well, it gave us about $7,348 of profit. Our performance would have been about $7,300 or 73%. Annualized, we must have tested 2 years. I didn't even look at the settings, 3685. Here's how many trades we had. So that easy, if you kind of understand a few things and you just want to create methodologies, create your own scans, create your own systems, it's not very hard. So I don't see any questions coming in, but that's I think what let's see if I had anything else in here in terms of the things. Yeah, I think that's it. We talked about the scanner. We talked about the other thing. If this is something that you want to learn a little bit more of, I just wanted to really kind of give you a flavor for it. But if you go to this website, metastock.com/customer resources, there's a formula primer that was written by William, first and second version. There's a whole bunch of formulas you can grab. There's some video tutorials. And if you don't really want to kind of mess with it, or if it looked a little bit more technical for you, I'm just grabbing this to put it in our chat. The other thing that we do that's really cool is if you say, hey, I want you to create a scan for me. Here's kind of what I want. I want stochastics to be doing this, and this, and this. They'll create it for you, okay? If you want to just create the filter scan, if you want to get in touch with us, I've actually written a step-by-step guide on how to do that, so you could watch this. I think it's pretty easy to do, but if you want a step-by-step guide, we can give it to you as well. So there's some really good additional resources if you want to be able to kind of create your own systems for MetaStock. If you want to create your own scans, your own expert advisors, whatever it might be, it's just not that hard. And then if you don't want to do it, if you're not very technical and you want somebody else to do it for you, we'll create almost any formula that, within reason, that you want for like $30 through our support team. So in any case, that's what I wanted to show. That's actually not too bad. Again, MetaStock has been rated #1 in its price category 32 years in a row by the readers of Stocks and Commodities magazine. I'm going to go back and talk about all of our partners. I want to say thank you to CMT Association, cmtassociation.org. I want to say thank you to Stocks and Commodities magazine for supporting all of the shows that we've done for 15, 20 years. If you haven't yet, join the Traders Forum at thetradersforum.com. You can chat, get MetaStock formulas. We're always putting up new formulas up there, just based on kind of stuff we're working on, stuff that we have out of our sessions. There's an idea that we have up there called railroad tracks, which I really, really like. It's a way of finding stocks that are in a pervasive uptrend or a pervasive downtrend. So all of that stuff free. It's a community of traders. We go in, we have fairly active chat. There's some pretty good ideas. Thetradersforum.com. And again, find out why MetaStocks, if you're not using MetaStock yet, find out why. It's been rated #1 32 years in a row. For $75, you can try it out for 3 months. If it's not helpful for you, you can just cancel your subscription. There's no commitment to keep going. It's about $25 a month to try it out. During that $25, during that 3 months, we're going to give you unlimited access to our support team. We're going to give you resources to help you get started. We're going to have somebody give you a white glove installation where they'll help you out with the questions you might have, and using the software, all that kind of stuff. And in addition to that, I forgot. In addition to that, you'll have unlimited access to our Unleash the Power of MetaStock trainings and tutorials and that kind of stuff. So you can do that. You can call us at 800-882-3040. We've got a couple of people that are waiting to answer any questions you've got. You can go to metastock.com/saleschat, or you can go to metastock.com/conf-promo. If there's anything you ever need from me, feel free to reach out. Give it a go. I want to say thank you again to all of our sponsors, Stocks and Commodities magazine. I'm getting tired. The Traders Forum, and then the CMT Association. Really appreciate them. I want to thank all of the speakers. I think we've had a really great session. And I've learned a lot. I hope you've learned a lot too. I want to say thank you for being here as part of it. Have a great weekend. Stay healthy, stay well, and I'll see you at the next one.